Hello students, how are you all? I hope you are doing well. The most awaited CA Foundation Accounting Marathon for May 2025 is live now. In this marathon, what we are going to discuss and how this marathon will help you and how many marks we can cover by watching this marathon and all these things we discuss now. And my humble request to you is don't totally depend on the marathon, because these marathons are with the presumption that you have studied the full concept and you have practiced the problems at least one time. Yes or no? Yes, sir. Now, look at what we are going to cover in this marathon. First, this marathon is going to be part 1 and part 2. What we cover in part 1 and what we cover in part 2, that we discussed for 2 minutes. And before watching this marathon, go and watch. I have made a video on preparation guidelines, CA Foundation Accounting Preparation Guidelines for May 2025. Please go and watch that video first. Why? Because there I have categorized the whole accounting syllabus, CA Foundation Accounting syllabus, in 5 groups. Group A, B, C, D, E. So based on that, this marathon is prepared. Now observe, in this marathon part 1, we are going to cover category A and category B chapters. Category A chapters: accounting for GST, bills of exchange and promissory note, bank reconciliation statement, inventories, capital and revenue expenditure and receipts, depreciation and amortization, rectification of errors. We have categorized these chapters into category A. Why? Because from these chapters we got 36 marks in June 2024, 45 marks in September 24 attempt, and 32 marks from January 25 attempt. And category B are financial statements of various entities. Here various entities covers sole proprietorship, whether it may be non-manufacturing entities or manufacturing entities. At the same time, financial statements of not-for-profit organizations and accounts from incomplete records. From these 3 chapters, if you observe, why I have categorized these chapters into one category means these are similar nature chapters. Similar nature means preparation of financial statements of the various entities. Financial statements, here we prepare financial statements of non-manufacturing entity, trading, manufacturing account, non-manufacturing entities, trading, profit and loss and balance sheet. Manufacturing, they include manufacturing account. What about NPO? There they will prepare receipts and payments account, income and expenditure account, and balance sheet. Accounts from incomplete records also, we should prepare trading account, profit and loss account, and balance sheet from incomplete information. That's why these 3 chapters are grouped into one category, that is category B. From these 3 chapters, 27 marks in June 2024 and September 2024 attempts, and 25 marks are covered in January 2025 attempt. Both put together, June 24 attempt 63 marks, September 24 attempts 72 marks, and January 2025 attempts 57 marks. So on an average, I hope if you average these 3, we get 64 to 65 marks. So by preparing these chapters, you can attempt comfortably 65 to 70 marks in the examination. 65 to 70 marks in the examination. If you attempt minimum to minimum 60 to 70 marks perfectly, then you can score easily 40 to 50 marks. They are your qualifying marks. Yes, sir. That it doesn't mean that you ignore the remaining chapters. No. Prepare these chapters well first. Prepare these chapters well. Whatever the question you get and however the question it may be, you are in a position to write the answer. Okay. Now, in part 2, we will cover entire partnership and LLP accounts and company accounts. In our categorization, partnership is categorized into category C and company accounts category D. From these chapters, partnership alone covered 22 marks on an average in all attempts, and company accounts covered on an average again 22 to 25 range. And both together 47 marks covered in all exams. So on an average, you are getting 47 marks from these partnership accounts and company accounts. If you prepare category A, that means part 1 and partnership accounts, you can comfortably attempt 90 marks. You can comfortably attempt 90 marks. Attempting, I am asking, sir, the question paper is for 100 marks, na sir? No, the question paper is for 125 marks, na? The question paper is for 125 marks. Sir, 6 questions, na sir? 6 into 20 only, na? 120. Yes. In 5th question, we are getting B two options. If we add that one more extra question also, internal choice, then we are getting total 125 marks. Then we are getting total 125 marks. Out of 125 marks, if you observe from this chapter, on average 65 marks covered and average 22 marks from partnership, so that easily you can attempt for 87 to 90 marks. Apart from that, some basic chapters now. Some basic chapters you observe. Here basic chapters includes, here I forgot to add cash book chapter and trial balance chapter. These chapters constitute 16 marks in June 2024 attempt and 6 marks in September 24 attempt and 21 marks in January 2025 attempt. Yes or no, students? Yes, sir. So these chapters you need not to prepare separately. Why? Because based on these chapters only, the remaining chapters depends. And without any preparation also, if any question is asked, except from theoretical framework, from the remaining chapters, if any question they ask in the exam, then you are in a position to solve it. So you can score easily 4 to 5 marks from here. So comfortably, if you prepare category A, this is category A, and this is category B, and this is category C. Category A, B, C, and these basic chapters, you can comfortably attempt 100 marks. Sir, what are you saying? Are you saying that a company accounts has choice? No, I didn't mean that. Because company accounts they will ask as 5C and 6A. 5C and 6A they are asking company accounts. One true or false statement. If you can take the whole question of sixth question, then comfortably you can take company accounts as choice. Okay. Next, sir, partnership is difficult for me, but I will prepare company accounts, sir. Partnership, if you observe, they are asking partnership problem in third question and fourth question. One part in third question and another part in fourth question, like company accounts. And the combination for this third question and fourth question is final accounts of various entities. So here the problem comes. If you take partnership accounts as choice, what is the problem here? Then you can attempt only part of final accounts problems. What about partnership? But if you look at company accounts, 6A they are asking company accounts and 6B one theory question they are asking for 5 marks. So here you can take it as choice, sixth question. If company accounts problem is very easy for 15 marks, then you can write a 6B theory question. If company account 6A becomes a very lengthy and a very typical question, then what about? So finally here we just give you the analysis part. So it is up to you whether you prepare or whether you take anything choice or not. That depends on you people. Okay. Now without wasting much time, we enter into our first and foremost chapter, accounting for GST. Okay. Look at, sir, why accounting for GST you are covering in the marathon, sir? Why? Because accounting for GST is not a separate chapter actually. Accounting for GST is a part of journal entries chapter. So here we have divided accounting for GST chapter from journal entries. Why? Journal entries is a basic chapter. If we discuss all the things in the journal entries chapter itself, the student will feel difficulty. That's why this accounting for GST is separated. Now, what is the advantage of this accounting for GST now, sir? Sometimes they are asking a question for 4 marks. They are giving some 3 to 4 transactions and they are asking journal entries. There they are asking GST also. They are including GST also. This GST concept is included in the new syllabus. In the old syllabus, we don't have this concept. Okay. So that's why I am going to cover this accounting for GST in the marathon. And one more thing, when we come to input GST and output GST, they are asking these two concepts are covered in the final accounts. So how output GST is set off against input GST, set of provisions. For that purpose, I am going to cover this accounting for GST. So this is going to be some around 25 to 30 minutes. Okay. Now look at first, sir, what is GST, sir? GST is nothing but goods and services tax. Yes, sir, goods and services tax. Very good. Then we try to understand first what is tax. See, tax is the voluntary payment, or tax is the amount paid by a person to the government. Tax is an amount paid by a person. The person may be individual or business, paid to the government. Here government may be central government or state government or local authority. Sir, why these taxes are paid by the people to the government, sir? See, government will incur various public expenditure. Public expenditure is nothing but most of the expenditure of government is on the defense. See, we have to protect our country. So government will not work na. So how government will get amount? This nothing but contribution in the form of taxes. And government will provide free education, healthcare and infrastructure facilities. To meet all these expenses, government need funds. So that government will collect amount from various people. The persons may be individuals or businesses. Yes or no? Now, how many taxes we have, sir? There are two types of taxes. One is direct tax and another one is indirect tax. Sir, what is the meaning of direct tax? If the tax is levied on the income earned by a person, here again person may be any individual or any company, right? So if the tax is levied on income or wealth of a person, then this is called direct tax. So here payment of tax is a burden for anybody, but the burden of direct tax is not possible to pass on. Burden of direct tax cannot be shifted. Why? Because it is the tax levied on income of a person. If you are earning income, so that you have to pay tax. So it is not possible to shift this burden to somebody. And another tax type of tax is indirect tax. It is a tax levied. See, it is a tax. Okay, why should we pay tax? It is a tax levied on the price of a good or service. It is a tax levied on the price of a good or service. And this we have two types. One is goods and services tax and customs duty. Customs duty. And here government will collect this tax indirectly from the persons, maybe from individual, again businesses. But direct tax, it is government directly collects this tax from the person who earns income. But indirect tax, government will not collect this indirect tax from any person directly, but indirectly they will collect. Here the taxable event in case of direct tax is income earning. If you earn income, you have to pay tax, provided it exceeds basic exemption limit. But indirect tax, if you consume goods or services, because this is the tax levied on goods or services. As an individual, as a human being, what we do in our daily life, we consume goods and services. So without knowing, we are paying tax to the government. That is nothing but indirect tax. Okay, GST, goods and services tax. Before GST, we have different types of indirect taxes. But after introduction of GST, all these indirect taxes are subsumed into this GST. Sir, what about customs duty? Customs duty is nothing but amount of tax or duty paid on export of goods or import of goods. The more details about this indirect tax and direct tax, you will get more clarity in your CA intermediate paper 3. 3A direct tax and 3B indirect tax. Now, the person paying indirect tax can shift burden to another person. But ultimately, who will bear this burden? The consumer. If you consume goods, then you have to bear the indirect tax. If you earn income, then you have to pay the direct tax. Okay. So here indirect tax first is paid. Indirect tax first paid by the either manufacturer or service provider or seller of goods. Because these people, they are selling goods or they are providing services. They are not consuming. Ultimately, goods are consumed by individuals or business people. Okay, if any goods is consumed by any person, maybe individual or business, they have to bear the tax. Now come to pre-GST scenario. Pre-GST scenario, what are the various different types of taxes we have? Simple. First, what is the taxable event here? Manufacture of goods. If you are manufacturing goods, then you are liable to pay excise duty. Who will collect tax? Central government. Suppose I am selling goods within the state. See, manufacturing is different from selling the goods now. Yes, sir. So I am selling the goods in the state. I have to pay central value added tax. Who will collect? State government. Suppose if I am selling goods to a different state, not suppose we are in AP now. I am selling goods within AP, then government will collect state value added tax once upon a time, but not now. Now government will collect GST. Next, sales of goods outside the state, then central sales tax is levied. Who will collect? Central government will collect. Suppose all these three are related to goods. Now service provided. Government used to collect service tax. Nowadays only GST, one tax only. Who will collect this? Central government. Okay, these are the various. Apart from this, we have more other indirect taxes, but all these indirect taxes are subsumed into this GST now. That's why the what is the slogan here? One nation, one tax. GST, goods and services tax. Next, look at introduction of GST. So it is a comprehensive indirect tax, single tax on the supply of goods and services. Look at next concept of interstate and intrastate supply. To levy GST, first we have to categorize the transaction into whether it is interstate supply or intrastate supply. Interstate supply means the supply of goods. Supply of goods means sale of goods. The supply, sale and purchase. The supply of goods means purchase and sale happened within the state, within the same state. Observe here, intrastate supply. A is in AP, sorry, A is in AP, B is in B also in AP. So here the transaction happened within the state. So that this transaction is called intrastate supply. Suppose if A limited is in AP, B limited is in Tamil Nadu. So A limited sold goods to B limited. So this is a purchase and sale of goods. This transaction is called interstate supply because between two states means between two states. Intrastate means within the state, interstate between two states. And do remember the GST is levied on where the goods are consumed. Where the goods are consumed. In which state the goods are consumed. That state will collect a tax. That state will enjoy the tax collection. So based on this, we can divide the GST types of GST into four types. One is CGST, Central Goods and Services Tax. SGST, State Goods and Services Tax. UTGST, Union Territories Goods and Services Tax. You know the concept of Union Territories now. Next, IGST, Integrated Goods and Services Tax. Simple. IGST is levied on the interstate supply. IGST is levied on interstate supply and remaining three are levied on intrastate supply. Intrastate, within the state. Interstate, between the state. When a purchase and sale transaction happened between the states, then IGST is levied. Who will collect this IGST? Central government. Next, if it is intrastate transaction means either CGST or SGST or CGST and UTGST. CGST and UTGST. Okay. Now, in these cases, who will collect the tax? CGST levied, SGST levied. CGST is collected directly by central government. SGST is collected by state government. UTGST is collected by union territories. Understood this concept? Yes, sir. Now come to types of taxes: central CGST, SGST, and union territories GST, IGST. Right? Now this is a flow chart you can observe. Now come to input and output GST. See, generally when we pay GST, then it is called input GST. When we charge GST from customers, then it is called output GST. When input GST is paid whenever we purchase goods or whenever we purchase any service or whenever we purchase any asset, we pay GST to the seller or service provider. When we charge GST, that means when we collect GST, when we sell goods or when we sell assets or when we provide services, then we should charge GST from the client or customer, and that GST is payable to the government. Now, what we do with this? See, here we are not learning in-depth knowledge of GST. That you will learn in CA Inter Group 1 paper 3B. So here we are just looking the basic transactions regarding this GST. Whenever input GST is paid, then what are the entries we record? First, when input GST is paid in case of purchase of goods, first one. In case of purchase of asset, second one. At the same time, in case of availing services, we avail service now. So in these three cases, we pay GST. Normally, what is the entry for purchase of goods? Tell me. What is the entry for purchase of goods? Sir, purchase of goods, nothing but purchases account debit to cash or bank account or creditor account, sir. Yes. Now, in addition to purchase price of goods, we have to pay extra amount in the form of GST. What we do? we have to record that GST transaction. In addition to the normal entry, observe here purchase of goods, purchases account debit to cash account. In addition to purchase of goods, what we are paying? GST we are paying. Whatever the GST we pay, first that becomes asset for us. Whatever the GST we collect, that becomes liability for us. Why? Because we have to pay that amount to the government. Whenever GST is paid, then input GST account debit. GST may be CGST, SGST or UTGST or IGST. When IGST is levied on interstate supply, and remaining GSTs are levied on intrastate supply. So before recording the entry, what you have to do, you have to classify the transaction into whether it is intrastate supply or interstate supply. If it is intrastate supply, then check whether CGST and SGST levied or CGST and UTGST levied. In case of interstate supply, straight away IGST is levied. Suppose the GST rate is 18%. GST rate is 18%. Okay. If it is interstate transaction, then whole IGST is 18 rupees. If it is intrastate transaction, then this 18% is divided between CGST and SGST. CGST 9%, SGST 9%. Observe this. Okay. Tax rate is 18%. In case of interstate supply, total 18% comes under IGST. Total 18% comes under IGST. If it is a intrastate transaction, this 18% is divided equally between central government and state government. 9%, 9%. If it is 16%, not 16, 12%, then 6%, 6%. If it is 5%, then 2.5%, 2.5%. If it is 6%, 3% and 3%. If it is 1%, then 0.5% and 0.5% in case of intrastate supply. In case of interstate supply, total amount is charged to IGST. Okay. Now tell me, what is the entry for purchase of goods? Purchase account debit, input CGST account debit, input SGST account debit. If it is Union Territory, then Union Territory GST account debit to cash or bank or creditor. If it is interstate supply, purchase account debit, IGS input IGST to cash or bank. If you purchase asset, normally what is the entry we record for purchase of asset? Asset account debit to cash or bank or vendor account. But here, in addition to asset price, we are paying extra GST. Na? Same. This input CGST or SGST account is included between the normal entry. This also we have to check whether it is intrastate supply or interstate supply. Normally, first, what is the entry we record? Asset account debit to cash or bank. In addition to that, we are paying GST. Yes, sir. So, input CGST or SGST account debit. If it is interstate transaction, then input IGST account is debited. Okay. Now, payment of expenses. Normally, what is the entry for payment of expenses? Expense account debit to cash or bank account. Expense account debit to cash or bank account. Okay. Now, in addition to that expense, we are paying GST. Na? So, input CGST. So, in the problem, they will mention what is the GST rate. Based on that, we calculate. GST is calculated on the transaction amount after deducting any trade discount. I repeat, GST is calculated on transaction value after deducting any discounts. Right. If it is interstate supply, then expense account debit to IGST to cash or bank. Next important concept is reversal of input GST paid. Here we have paid GST. Na? Yes, sir. When it becomes reverse, means we have paid GST, that becomes asset for us, and this we are treating as asset. Why? Because we are not consuming goods. If we consume goods, this is included in the amount of expense or consumption of goods. But we are not consuming goods. These goods are meant for sale purpose. If you are selling goods, you will collect GST from the customers. After collecting GST, you have to pay amount to the government. Na? Yes. At the time of making payment to the government, this amount can be set off. I repeat, look at, suppose if 1000 is payable, collected from customers, this 1000 is payable to the government in the form of output GST. Suppose I have input GST of 500 rupees. Means already I have paid some GST to the government, because here I am not consuming goods, I am selling goods. Okay, and remaining amount, how much I have to pay to the government? 500. Okay, now whatever the input GST here 500 is there, this becomes reverse, means you are not allowed to take it as deduction at the time of making payment to the output GST. In which scenarios this input GST becomes reverse, means here goods are purchased for sale purpose. If you consume the goods, you are not selling, but instead of selling you are consuming goods, you are using these goods in the business, or you are using these goods for your personal purpose, then you have to bear the GST now. That's why we are reversing this. In which situations this GST becomes reversal, means purchase returns. In case of purchase returns, this GST becomes reverse. Drawings, because purchase returns means we purchased goods and we are returning na, so we are not selling, we are returning. In that case, either earlier we have recorded entry for payment of GST, that becomes reverse. Next, drawings means goods consumed by the proprietor. So who has to bear this GST liability, GST amount? Proprietor. That's why the cost of goods plus GST both are debited to the drawings account. Next, goods distributed as free samples. In this case also, input GST paid becomes reverse. Next, goods distributed as gifts. We are not selling, we are distributing them as goods. Sorry, gift. Goods lost by fire or theft. Here also goods are destroyed. Input tax credit for supplies that are not allowed to be availed by the recipient. Under GST Act, they will clearly mention that if you purchase these things, then you are not allowed to take the GST as input. In those cases also, first we debit input, but later on we reverse it. In that case, what is the entry we record? Look at, in case of purchase returns, normally what are the entries we record? Creditor or supplier account debit to purchase returns account. We record the same entry. But in addition to that, earlier we have paid GST na, or payable GST na, that becomes reverse now. You need not to pay it. Okay, next, if it is interstate transaction, normal entry creditor to purchase returns, but what we do, we credit input IGST also. Next, when goods are used for other than sale, see, if any goods withdrawn by the proprietor, drawings account debit, free samples account debit. If goods lost by theft or fire, goods lost account debit. Two purchases, this is the as usual entry, normal entry. In addition to that, we have to reverse the GST on this value of drawings. Total GST is not reversed. Only the GST on the value of drawings, or GST on the value of free samples, or GST on the value of goods lost is debited. If it is interstate supply, then same entry, drawings account debit to purchases, but in this case we have paid earlier IGST na, that becomes reverse. So these are the various entries for input GST paid, at the same time reversal of input GST. Now come to accounting for output GST. Accounting for output GST is nothing but, now we have to pay, sorry, we have to collect the GST. We are selling goods. In which scenarios you collect the GST? Yes sir, sir I have sold goods. Yes, it is a sale of goods na, you have to collect GST from customers, pay that amount to the government. And sir I sold asset sir, okay, collect GST and pay to the government. Sir I have provided service sir, okay fine, you collect the GST and pay that amount to the government. Right. Now in case of sale, normally what is the entry? So here also we have to divide the transaction into intrastate supply and interstate supply. In case of sale, normal entry is cash account debit, cash or bank account debit to sales account, cash or bank account debit to sales account. In addition to that, what we do, we simply credit output GST. Output GST means we have to pay to the government. If it is intrastate supply, then CGST, SGST is levied. If it is interstate supply, then output IGST is levied. At the same time, sale of asset. Normally, what is the entry for sale of asset? Cash or bank or debtor account debit to asset account. Now, in addition to the sale value, we are also charging extra amount in the form of GST, that is credited. This is also calculated on the transaction value. Okay, if any trade discount is given to the customers, first you deduct that trade discount and charge GST on the remaining balance. If it is interstate supply, then cash or asset account debit, cash or bank or asset account debit. In addition to that, we are charging IGST na, IGST account credit. Next, on receipt of income, we have provided some services and we received income. Then what is the entry we record? What is the normal entry for receipt of income? Cash or bank account debit to income account. In addition to that, we are charging extra amount in the form of GST credit. And if it is interstate supply, then IGST account credit. So here, if you know the normal entries for this transaction, the only thing is adding input or output GST accounts. So in this chapter, our main emphasis on this concept only. Next, suppose if customers returns goods, here we are selling goods. Now this entry is nothing but what we sold goods to customers. That's why customers has to pay GST to us, and we have to pay that same amount to the bank. Sorry, government. Suppose if customers returns goods, then what happens? If customers returns goods, it is not a sale transaction. In that case, customers need not to pay any tax, and so that we also need not to pay any tax to the government. Yes, sir. So reversal of output GST. This concept is nothing but reversal of output GST charged. In which situations we reverse the GST? In case of sales returns. In case of sales returns, normally what is the entry? Sales returns account debit to customer account, to customer or debtor account. But earlier we have credited output CGST. Credited means it's a liability for us payable to the government. Now goods returned by customer, so it is not a sale. So that you need not to pay any GST to the government. So the liability is reversed. And this amount is calculated on the sales returns. Not entire liability is reversed. Only on the sales returns value. If it is interstate supply, then sales returns to debtor normal entry. On interstate supply, we charge IGST now, so it is debited, reversed. This is the concept of input GST, reversal of input GST paid, output GST, and reversal of output GST paid. Now the concept comes. Observe here. I have to pay 10,000 to the government. I have to pay 1 lakh total GST collection. Total GST charged 1 lakh. So this is my output liability. Output liability. This much of amount I have to pay to the government now. Yes, sir. Now check how much of input GST paid. Check how much of input GST paid. Sir, suppose input GST paid is 50,000, sir. Fine. Then how much amount you pay to the government? How much amount you pay to the government? Sir, we pay to the government 50,000, sir. Payable. This is the total amount payable to the government. But out of that already I have paid on my input of goods or assets or services, whatever it may be. Already 50,000 paid to the government. And remaining 50,000 is payable, sir. Yes, pay this amount. This is called set of provisions. This is called set of provisions. This set of provisions are very, very important. Look at here. For that, first understand the concept of input tax credit. So government allows input tax credit. Yes, you have paid earlier input now, that you adjust now against output. So credit of input GST already paid. Look at how we adjust this. First, here we have different types of GSTs now. What is that? IGST, SGST, okay, CGST, UTGST, various types now. Yes. First look at, come to the concept of IGST first. IGST. So we have paid IGST, sir. Yes. Payable output IGST. First, whatever the amount you have paid already, adjust against IGST liability. Suppose IGST credit I have 1 lakh, whereas payable 10,000 only. Payable 10,000. How much excess amount I have? 90,000 rupees excess I have paid. And this excess amount can be adjusted against CGST liability or SGST liability. First CGST, then after SGST. If you have any excess amount. Sir, I have short amount, sir. Then pay amount to the government. Next, utilization of CGST credit. I have paid already CGST, sir. Okay. First, this amount is utilized for payment of output CGST. If you have excess amount, then that can be adjusted against IGST. Sir, reverse situation, sir. Means you have less amount. Suppose input 10,000, whereas output 25,000. Means you have to pay extra 15,000 rupees to the government, na? Pay amount. Or if you have any IGST input, excess IGST input, then you can adjust this. This is adjustment provision, students. So when final accounts problems comes, there we discuss. Next, utilization of SGST. So we have input SGST and output SGST, both things. First, input SGST is set off or utilized for output SGST payment. If you have any surplus, then pay to IGST liability. Suppose if you don't have any surplus amount, still you have to pay some amount to the government, pay accordingly. So these are set of provisions. Okay. But CGST credit cannot be utilized against, SGST credit cannot be utilized against CGST. At the same time, CGST credit cannot be utilized against SGST. These are important provisions which are helpful for you in case of final accounts problems. Now, observe here, utilization of input tax credit towards payment of output tax. See, output GST we are utilizing for input, set of provision. Next, if you still payable amount to the government, then output GST account debit to bank account finally. So this is the concept of GST. Now we solve one or two problems on the concept. Look at, generally in the examination we get these type of problems. In the examination we get this type of problems. Look at illustration 10 from journal chapter. Record the following transactions in a journal assuming CGST, SGST 6%. They have given itself na CGST, SGST 6%. If it is IGST, then it is 12%. So CGST, SGST means it is intrastate transaction. First one. Sold goods to Mukesh at the list price 50,000 less 20% discount. Normally, what is the entry we record? Mukesh account debit to sales account. 50,000 na 50,000 minus 20% first deduct 40,000. On 40,000 we charge 6% GST entry. Mukesh account debit 40,000 plus 12%, 6 plus 6, 12%, 4,800. So we collect total amount from Mukesh 44,800. Next, to sales 40,000, output CGST 2,400, output SGST 2,400. Next, sold goods to Mukesh at the list price of 1 lakh less 20% rate discount and 5% cash discount. So if cash discount is given, it is nothing but which transaction? Cash transaction. So 1 lakh is the goods minus 20%, remaining amount receivable 80,000. On 80,000, GST is calculated before deducting cash discount. After deducting trade discount, before deducting cash discount. So 80,000 plus 12%, 9,600. What is the total amount receivable? 89,600. Look at total 89,600 debit. But this cash discount is always calculated. Important point. Cash discount is always calculated on the normal value of goods, not on the GST. On GST, we will not allow any discount. So 5% nothing but 5% is on 80,000. 80,000 into 5%, 4,000. So discount allowed 4,000. Remaining amount we receive. Sale value 80, GST 4,800, 4,800. Next, sold goods to Mukesh at the list price of 1,50,000 less 20% rate discount. 1,50,000 minus 20% means 30,000. So sale value 1,20,000. Out of the amount due, 60% received. 60% received means 1,30,000 into 60%. 1,30,000 into 60%. So we received 78,000 rupees. And remaining amount is on credit. So first calculate 1,20,000 into GST. 1,20,000 into 12% GST. How much? 14,400. So 1,20,000 plus 12%. Total 1,34,000 we have to receive. How much amount we have to receive? 1,34,000. Look at here, simple calculation. List price minus trade discount. Remaining amount receivable 1,20,000 into GST. Total amount receivable 1,34,000. Out of 1,34,000, we received 60% amount, means 80,640. Remaining amount is on credit now. Remaining amount how much? 53,760. But here the question says, 60% is received, out of which 3/4 is received by check. What is the amount received here? What is the amount received here? Yeah, what is the amount received here? 80,640. Out of this 3/4 check. 3/4 check. remaining amount cash. So what is the entry now? Cash account debit 20,160, bank account debit 60,480, Mukesh account debit 53,760, to sales account. Sales account is how much? 1,20,000 sales, CGST 7,200 credit, SGST 7,200 credit. This is how we record the entry. This type of problems they are asking in the exam. Or sometimes they may mix purchase transaction, purchase returns transaction, sales transaction and sales returns transaction also they may mix up. So like this you try to solve the remaining problems, small problems here. Now look at PQ6 also we try to see. Purchased goods from Sonu for 3 lakhs at a trade discount of 10%. Immediately from 3 lakhs you deduct 10% trade discount, 2,70,000 payable. Plus CGST, SGST 6%. So on 2,70,000 you charge 6%. Entry purchases account debit 2,70,000, input GST debit and total amount payable on credit basis. Next, sold goods to Mohit for 1 lakh and charged CGST, SGST. It is also intra-state supply 5%. Out of the amount due, 40% received by check immediately. 1 lakh into 5%, 5% GST, 10%. So 1,10,000 is the total amount receivable from Mohit. Out of that 40% received. 1,10,000 into 40%, it comes to 44,000. Remaining 66,000 is on credit. Look at bank account debit 44,000, Mohit account debit 66, sale value only 1 lakh. Remaining amount output CGST, output SGST. Output CGST, output SGST. Next, goods costing 25,000 withdrawn for personal use. Drawings na, so reversal of GST paid. Entry drawings account debit. Earlier drawings account is debited only with 25, but this time drawings account is also debited with GST paid. And drawings account debit 25,000 plus GST 6 plus 6, 12% na, plus 12%, total 28,000 drawings account is debited. To purchase value 25,000, earlier we have paid GST na, now reverse input CGST and input SGST. See, drawings account debit 28,000 to purchases to GST. Next, machinery purchased from Messrs. Bright Industries for 2 lakhs plus CGST, SGST 9%. Paid 1 lakh immediately by check. Say 2 lakhs plus 9 plus 9, 18% means 2 lakhs plus 18%. Total 2,36,000 we have to pay. Out of that 1,000 rupees paid immediately by check and balance after 2 months. 2,36,000 minus 1 lakh. 1,36,000. Entry. Machinery account debit 2 lakhs. Machinery account debit 2 lakhs, not 2,36,000. Machinery account debit 2 lakhs. Input CGST, input SGST. 18,000, 18,000. To bank 1 lakh. To Bright Industries 1,36,000. This type of problem also important from examination point of view. So this is the concept of GST. I hope I have given some inputs to you for understanding the GST chapter. Next, we start our discussion with bills of exchange and promissory note. This is also very important chapter. So don't miss the video. Hello students, how are you all? I hope you are doing well. Previously we have completed accounting for GST. Now we start our discussion with bills of exchange and promissory note. This chapter is very important from examination point of view. Sir, what are the important concepts in this chapter, sir? First one is very important, accommodation bill. Second one is renewal of bill. Renewal of bill concept. These two concepts are very important from examination point of view. Remaining concept comes under third priority. That means retirement of bill, insolvency of a drawing. All these things comes under next. Now, without wasting much time, we enter into the concept. Before entering into the concept of bills of exchange, now we discuss a small concept of transaction. As you know very well, we have two types of transaction. One is cash transaction and credit transaction. Cash transaction means receipt and payment. Cash received, cash payment, cash paid. Credit transaction means credit received. How can we receive credit? By purchasing goods on credit. We receive credit. How can we allow credit to the customers? How can we allow credit, or how can we give credit? By selling goods on credit basis. You may ask, sir, what is the relationship between this transaction and bills of exchange? Yes, there is a link. The credit transaction is the basis for bills of exchange and promissory note concept. Why, sir? Suppose, let us take one example. Goods sold to Mr. A for rupees 1 lakh on credit. 2 months time allowed. What is the entry in the books of Karan? Karan is the seller, assume. Mr. A is the buyer. First, what is the entry Karan will record? A account debit to sales account. A account debit to sales account. For the same, Mr. A record purchases account debit to current account. Purchases account debit to current account. If A pays amount after 2 months, then in the books of current, what is the entry? Cash or bank account debit to Mr. A account. In the books of Mr. A, current account debit to cash or bank account. So here the account is settled. Yes or no? When we sell goods on credit, how a customer is settling his account after some period of time, either by paying cash or checks. But sometimes what happens is seller is unable to allow credit to the customer because of any reason. Suppose if some of the customers may fail to pay the amount after some period of time, or some of the customers may refuse to pay the amount due to any reason. So in this type of situations, the seller is unable to grant credit to the customers. At the same time, customers are not ready to pay the cash immediately because all customers may not buy the goods by paying cash. In that situation, what is the remedy for this? In such a cases, the seller may ask the buyer. I repeat, the seller may ask the buyer to give written promise. The seller will ready to sell the goods only when buyer gives written promise. Only when the buyer gives written promise. And if the buyer gives written promise and this written promise is in accordance with the Negotiable Instruments Act 1881, then it becomes a bills of exchange or promissory note. Here the concept comes. So the transaction of bills of exchange and promissory note comes from the credit transaction, either credit purchase of goods or credit sale of goods. Both are same. From one point of view, it is credit purchases. From other point of view, it is credit sales. Yes or no, students? Yes, sir. Now look at. Seller asks buyer to provide a written promise. If this written promise is in the form of bills of exchange and promissory note, when they are drawn in accordance with the Negotiable Instruments Act 1881, then they becomes bills of exchange and promissory note. From accounting point of view, bills of exchange and promissory note both are same, one and same. But from legal point of view, these two are different things. And slowly these commercial practices, they made these bills of exchange as financial instrument or valuable financial instruments. Means what? This bills of exchange or promissory note is equal to cash or money. This financial instrument, bills of exchange or promissory note, is equal to money. Why, sir? Here Mr. A agreed. Mr. A has given written promise. After 2 months, I will pay the amount. After 2 months, I am promising to pay the amount. Yes, sir. Now, after 2 months, you receive amount by showing this document, na? And this document is named as either bill of exchange or promissory note. When it is called bills of exchange and when it is called promissory note. Simple. Look at. Okay, promise to pay the amount. The document may be written by the buyer himself. First, who has to give promise? Buyer. Because why? He is purchasing goods, na? He has to give promise. If the document is prepared by the buyer himself, then it is called promissory note. If this document is prepared by the seller, to be accepted by the buyer, document is prepared by whom? Seller. Here buyer is not preparing the document. The written promise is preparing by the seller, but it should be finally accepted by the buyer. If this is happened, drawn by seller, accepted by buyer, this document is called bills of exchange. If the same written promise is drawn by the buyer himself, there is no need to accept the same. Then it is called promissory note. Observe here. Mr. Karan, Mr. A. The relationship between Mr. Karan and Mr. A exists only with the credit transaction. Okay. Before credit transaction, Mr. Karan is Mr. Karan, Mr. A is Mr. A. That's it. There is no relationship. After selling the goods, Karan becomes seller or creditor. Mr. A becomes buyer. Okay. Look at first transaction. Karan sold goods to Mr. A for 1 lakh. It's a credit transaction. Karan records the entry. A also records the entry. Now what is happening? Karan is drawing a bill on Mr. A. For 1 lakh rupee. A is also accepting the same and returning it to Mr. Karan. If this is happened, this document is called bills of exchange or A is drawing a document and it is sending directly to Karan. First, what happened? Karan has drawn a document and it is accepted by Mr. A and it is sent to Mr. Karan. If this is happened, it is bills of exchange. Or second option is what? Mr. A directly draws a promissory note and it is sent to Karan. This is a promissory note. Okay, after drawing the bill, Mr. A is called as drawer of the bill. He is the person who draws the bill. And after accepting bill, Mr. A has to accept now. He will be called as acceptor or drawee of the bill. Sir, who are the parties? Tell me. Drawer, the person who draws the bill. Drawee or acceptor, the person on whom the bill is drawn. And there is another party, that is payee. Just a minute. There is one more party, that is payee. Payee is a person on who will collect amount on the due date. Look at drawer, acceptor and payee. Payee is a person who collect the bill amount. You may ask, sir, generally who will collect the bill amount? The person who is drawing a bill. Yes, but sometimes the bill may, see, this bill is a financial instrument, so it can be endorsed or it can be transferred to some other person. That's why the bill amount may be taken or received by drawer himself on the due date or somebody. That's why the person who receives the bill amount is called payee. And this bill is a financial instrument. It can be transferred from one person to another person easily. So if this bill is transferred to some other person, then who are the parties in this transaction? Two parties. One, the person who is transferring the bill. Another one, the person to whom the bill is transferred. The person to whom the bill is transferred is called endorsee, and the person who is transferring the bill is called endorser. These are the two more parties. Okay, next observe. Yeah, this is a simple concept. Now come here. Format of a bill of exchange. Format of a bill of exchange, it contains the details of parties involved, drawer and drawee, and amount of bill, how much amount of bill we draw, date and place of issue. Next, due date for payment, on which date the bill becomes due, and payment terms, any terms and conditions, and signatures of both the parties. This is a specimen of bill of exchange. The bill of exchange may be any format, but it should have the terms and conditions mentioned under Negotiable Instruments Act 1881. If it is drawn as per Negotiable Instruments Act 1881, then they will be called as bills of exchange or promissory note, and these are valuable financial instruments. Look at one format of bills of exchange. So here the place and the date of drawing the bill. Next, here signature of parties. Next, here the amount of bill. Stamp is very important. See here what are the things they are mentioning. 3 months, it is a time allowed after the date. Pay to me or my order the sum of rupees 1,50,000. It is in words only for value received. It's a sample format of bills of exchange. Next, these are the parties. Observe parties: Sri Kumaresh, Rohit Guru. Who is accepting the bill? Who is accepting the bill? Accepted by Sri Kumaresh. He is called drawer, and the other party is nothing but drawing the bill, drawer of the bill. Two parties. Now look at bills of exchange definition. It is given in Bills of Negotiable Instruments Act 1881. A bill of exchange has been defined as instrument in writing. See, all written promises must be in writing. Instrument in writing containing an unconditional order signed by the maker who is making the bill, drawer, directing a certain person to whom we are directing, drawee, to pay a certain amount. So in the format of bills of exchange, the amount is certain. Yes, sir. A certain sum of money only to or to the order of a certain person. Either the amount of bill is payable to me, drawer of bill, or my order. So I will order somebody, so you pay amount to so and so person, or to the bearer of the instrument. Bearer of the instrument means ultimately on the due date, the person who is holding the bill, he will be called as bearer of the instrument. Is it clear? So it's a simple bills of exchange definition. Don't expect this definition in the exam. When such an order is accepted in writing, it is just a document. Before acceptance of bill, It is just a document, piece of paper. Once it is accepted, it becomes valuable financial instruments. Unless it is just a piece of paper, it is not a valid bill of exchange. Next, for example, you get A orders B to pay 50,000 3 months after a date, and B accepts this order by signing in his name, then it is a bills of exchange. What are the characteristics of bill of exchange? Whatever the definition contains various points, the same becomes characteristics. It must be in writing, it must be dated, it must contain an order to pay, and it is unconditional. Next, the money must be payable to definite person or his order to the bearer. The draft must be accepted for payment, properly stamped, legal currency of the country. Actually, we have two types of bills of exchange. One is inland bill. We discussed this concept, inland bill and foreign bill. Inland bill and foreign bill. The bills are drawn in India and payable also in India. They will be called as inland bill. If all inland bills must be payable in Indian currency, if bill is drawn and payable, drawn in one country and payable in other country, then those bills are called foreign bills. Okay, so the bill must be payable in the currency, legal currency of country. Next, parties of bill of exchange we have discussed. Another very important concept, terminology used in the bills of exchange. See, every bill, generally whenever we sell goods, we allow some credit period to the customer. Na, that is nothing but term of a bill. For how many days or how many months you are allowing credit period? This is nothing but term of the bill. The term of a bill of exchange may be of any duration. Any duration means either in number of months or number of days. Any duration is nothing but 1 year, 2 years, 3 years. No, it becomes the tradition of the business. Generally, it will not exceed 90 days. So sometimes it is expressed as 30 days, 1 month, 2 months, 50 days, 60 days, 90 days, 3 months, like that. It's a term of the bill. Next, due date of a bill. Due date of a bill means on which date the bill becomes due. We have given 2 months time. We have given 2 months time. Yes. When this 2 months time expires. After expiring 2 months time, whatever the date we get, that is nothing but due date of the bill. The date on which the term of the bill expires is called due date. And days of grace. See, let us take for example, here observe bill drawn on 1/1/2024. Bill is drawn on 1/1/2024 and it is for 3 months. It is for 3 months. Now, when this 3 months expires means January January month na, so add January month plus 3 months. What is the date we are getting? 1/4/2024. This becomes the due date. Sometimes exactly on this date, the person drawee may not pay the amount. That's why what we are doing is we are allowing some grace days. This is actually due date. On this date, drawee has to pay the amount, but we are allowing some grace days. Those grace days are known as 3 days of grace. Time bill means the bill in which the time period is allowed. These are called time bills. Every time bill will have 3 days of grace. After adding grace days, whatever the date we get, that is called maturity date of the bill. After adding grace days, whatever the date we get, that is known as maturity date of the bill. Look at, yeah, next concept. Due date of bill, days of grace, dates of maturity of the bill. Next, bill at site. Sir, what is the meaning of bill at site? These bills in which there is no time period mentioned. Because whenever I present the bill, you have to pay the amount. I am not mentioning days, I am not mentioning months, but whenever I demand for payment, then you have to pay the amount. These bills are called bill at site or demand bills. It means instruments in which no time for payment is mentioned. A check always payable on demand. Next, bill after date. This is very important. Bill after date. Bill after date. What is the meaning of this? Suppose See here, bill is drawn on one date. Bill is drawn on one date and it is accepted. It may be accepted on other date now, because today I am drawing the bill. If drawee is in other place, I have to send physical bill to the drawee. For that it takes some time. Again, drawee has to look the bill, he has to go through the bill and he has to accept it. For that there may be some 2-3 days time delay. Now here the question comes, from which date the time of the bill is calculated. Here the time of the bill is 3 months. Here the time of the bill is 3 months. From which date these 3 months are calculated? From the date of drawing the bill or from the date of accepting the bill? I repeat, from which date this time period is calculated? From date of drawing or from date of accepting? That depends on the type of bill. If the bill is after date, I repeat, if the bill is after date, then the time period is calculated from the date of drawing the bill. From the date of drawing the bill. See one example here. Here the bill drawn on 1/1/2025, accepted on 5/1/2025. Drawn on 1/1/2025, accepted on 5/1/2025. Time allowed 3 months. If the bill is after date, sir, how can I know whether the bill is after date or after site? It is mentioned in the problem. Don't worry. It is mentioned in the problem. Clear? Now, if bill is after date, then how can we calculate time period? Tell me. 1/1/2025 plus 3 months. 1/4/2025. It's a time bill, na? We allowed grace days. Now the date is 4/4/2025. Suppose if the time period is calculated from the date of acceptance of the bill, then it is called bill after site. Bill after site. In case of bill after site, the time period is calculated from the date of acceptance of bill. If bill is after site, look at on which date the bill is accepted. 5/1/2025 plus 3 months. We get 5/4/2025. It is also a time bill, so that we add 3 days grace. 5/4/2025. If you observe this, 8/4/2025. Observe, 8/4/2025 is the due date in case of bill after site, and 4/4/2025 is the due date in case of bill after date. How many days gap? 4 days, na? Why this 4 days gap? Because bill is drawn on 1/1/2025 and accepted on 5/1/2025. Here how many days difference? 4 days. That's why here also 4 days difference. Hope you are following. So this is the concept of bill after date and bill after site. Sir, if nothing is mentioned about the bill, then what I can do? Always it is treated as bill after date. Always it is treated as bill after date. Right? Next, how to calculate the due date of the bill? To calculate the due date of the bill, first we have to see whether the time period is expressed in number of days or number of months. See, calculating the due date of the bill, we have to check whether the time period is expressed in number of days or number of months. See, here it is number of months, already we discussed this. Next, if it is expressed in days, then how do we calculate? How do we calculate? Look at, if the bill is time period is expressed in days, 60 days, then how can we calculate? Look at, bill drawn date 1/1/2024, bill accepted on 4/1/2024, time period 3 months. If it is bill after date, this is the calculation. If bill after site, this is the calculation. But if it is given in number of days, then how can we calculate? Look at, if it is bill after date, the time starts from 1/1/2024. Okay, look at, if the bill is after date, 1/1/2024 is the drawing date, 60 days to complete. In that case, you do one thing, total time duration 60 days, also add 3 days grace. Total days to complete 63. Now count the days from January. To complete January month, how many days left in January month? 30 days. Minus. Remaining days left 33. After January, next month February. February month we have only 28 days. Minus 28 days. So February month completed. Next month March. So 5 days to complete. Nothing but 5th March 2024 is the due date of the bill. This is how we calculate if the bill time period is expressed in number of days. You may get a doubt, sir, if it is a leap year, then what we do? Irrespective of the year, whether it is leap year or non-leap year, take number of days as 365 days. Take number of days as 365 days. Next. If the bill is after, suppose if the number of days are allowed 90 days, then total how many days to complete? 90 plus 3 days. 93 days should complete. 93 days. Bill is drawn on 1/1/2024 minus January month. In the January month, how many? See, one day bill drawing date must be excluded. Bill drawing date must be excluded. Remaining days in January 30. Now 63 days to complete. February month we have 28 days minus remaining days left 35 days. March month we have 31 days minus remaining days left 4 days. After March, next month is April. So 4th April 2025 is the due date of the bill. Is it clear, students? Yes. Next question comes, if the maturity date of the bill, when do we get maturity date? Maturity date after adding days of grace. If the maturity date of the bill is on a public holiday, if the maturity date of the bill is on public holiday, then we take, see, on public holiday we will not take this date as maturity date. Preceding date to the public holiday, that is suppose 15th August 2024 is a maturity date of the bill. Assume it is a public holiday. Before this date, preceding date, 14th August 2024 is considered as maturity date of the bill. Is it clear? Suppose 26th January is a Republic Day, public holiday. Before date 25th January 2024 is taken as the maturity date of the bill. Suppose if the maturity date is an emergency holiday, see, all these are just for on record, but off record what happens, we will not bother about that. Okay, in our exam if we write like this only we get marks, but off record what is happening, sir, we don't know. Okay, look at maturity date is a emergency holiday, then succeeding date is taken as the maturity date of the bill. That means next day is taken as the maturity date of the bill. Suppose 5/1/2024 is the maturity date of the bill, but on this date it is declared as emergency holiday. Then next day, that is 6/1/2024 is taken as maturity date. You may ask, sir, how can we know that which date is a public holiday and which date is the emergency holiday? It is mentioned in the problem, students. If you get that public maturity date on the public holiday or emergency holiday, accordingly you have to calculate the maturity date of the bill. This is the important concept of how to calculate the due date of the bill. Next, come to the concept of types of bill. To understand the types of bill, here I have given, look at types of bill. A sold goods to B. A is drawing a bill and B is accepting the bill. Why B is accepting? Tell me. B is accepting the bill. Why? Because he purchased goods from A. So B received some consideration, and this bill is drawn and accepted for trade transaction. For trade transaction between A and B, there is a transaction. What is that? Trade transaction, purchase and sale of goods. That means if the bill is drawn and accepted for trade purpose, these bills are called trade bills. These bills are called trade bills. And the concept of bills of exchange, observe the concept of bills of exchange. We understood that the bill is a valuable financial instrument. The bill is a valuable financial instrument. It is equal to money na? It is equal to money na? Yes, sir. Now, if a bill is drawn and accepted, the bill is drawn and accepted for meeting financial needs, then these bills are called accommodation bill. There is no trade transaction between these two parties, A and B. There is no trade transaction between A and B. Only it is drawn and accepted for mutual accommodation purpose to meet the temporary financial needs. If this is drawn, these bills are called accommodation bills. In case of accommodation bill, there is no trade transaction. Maybe the relationship between A and B are friends. Hope you are following. Accommodation bill we discuss again later. Now we discuss first trade bills. Look at trade bills. Observe, accounting for trade bills, accounting for trade bills. Now one party is drawing bill and another party is accepting the bill. There are no two bills now, only one bill. There is only one bill. One party is accepting, another party is drawing. The party drawing the bill, he will consider it as bills receivable. Why? Because this bill is equal to money now. On this bill he will receive amount, so this bill nothing but asset for him. This bill nothing but asset for him. One for one party this bill is asset and another party is accepting the same, and he has to pay amount on this bill, he has to pay amount on this bill. So this bill becomes bills payable for one party. For one party it is bills receivable. To whom the this bill is bills receivable? To the drawer of the bill. It is a new asset for him, he will treat it as bills receivable, and the person who is accepting the bill, he will treat it as bills payable. In that case, what are the entries are recorded by both the parties? In the examination, they may ask the entries in the books of drawer or the entries in the books of drawing, or sometimes they may ask only the entries in the books of drawer or only the entries in the books of drawing. So you have to be very careful that first check in the problem that who is in whose books we have to record the entries. Next, you have to check in the problem that whether the required entries are in the books of drawer or drawing. Now tell me how this bills of exchange concept comes with the credit transaction. So first we record the entry for credit purchase and sale of goods in the books of drawer and in the books of drawing. First transaction, goods sold and purchased. Seller is selling goods, buyer is purchasing goods. Seller will record the entry debtor account debit to sales. Buyer will record the entry purchases account debit to creditor. Okay. Next, seller is drawing the bill and it becomes bills receivable for him. Bills receivable is asset for him, so that he will debit bills receivable. From whom this bills receivable is received? From debtor. So debtor account credit. If you observe these two entries, here debtor account debit, here debtor account credit, means debtor account is closed. Now we should receive amount only on the bill accepted by debtor. Clear? Next, for the same transaction in the books of drawing, he will record the entry creditor, to whom we are giving acceptance, creditor, and whatever the bill accepted by us, it becomes liability for us. So bills payable. Observe here, creditor account credit here and here debit, means creditor account gets closed. Our liability now towards bills payable only. Creditor account closed, but our liability is towards now bills payable. The bill may be payable either to creditor or to anybody. Hope you are following. Yes, sir. Now, who is holding the bill? The person, the drawer is holding the bill, and this document or this bill of exchange is a financial instrument. How can it be used by the drawer? This is nothing but options available to drawer or holder of the bill. Suppose I have money, so I have so many options now because I have money. If I don't have money, I don't have any options. I have money, so that I have so many options. What I do with the money? In the same time, he has bill, so he has so many options because this bill is equal to money. Now what he can do? He has four options. One, either he can retain the bill till the maturity date, or he can discount the bill if he is in need of money, because this bill is a financial instrument, it is equal to money. So that what he can do? He can go to the bank. He can go to the bank and he can discount the bill, or he may endorse the bill. Suppose I have to pay amount to C, so this bill can be endorsed to C, so that I can meet my liability. Next, he may send the bill to the bank for collection. Suppose if we are drawing so many bills and different bills are due for on different dates. So on this date, on those dates, it is not possible to us to go to every debtor and collect the amount, or drawee and collect the amount. In that case, what we do? We appoint the bank as our agent for collection of all these bills. First, we send all the bills to bank, and on the due dates, bank will collect the amount and bank remits that amount to our account. For the services rendered by the bank will charge some amount as their commission. First situation, bill retained till the due date. Bill retained till the due date. For this, you need not to record a separate entry. Why? Because bill is retained till the due date. On the due date, we record the entry. We are talking about during the period of due date. During the period of due date, what happens? Means anything may happen out of these four situations. If anything happened out of these four situations, based on that, we should record the entry. Retain the bill. No need to record any entry in both the parties' books. Second one, discounting the bill. You people tell me, who is discounting the bill? The drawer or the holder? Holder is discounting the bill. In whose books we record the entry? Holder books and bank books. Holder books and bank books. In the books of drawee, there is no entry. Okay, now look at. Yeah, observe. And bank is paying the amount. Yes. Discounting the bill is nothing but what? Selling the bill to the bank. And bank is paying amount before the due date itself. Bank is paying the amount before the due date. Yes, sir. So that bank will reduce some amount. Suppose the bill amount is 1 lakh. Due date is 30th April 25. 30th April 25. Suppose today is 29th March 25. Today is 29th March 25. On this date, I am discounting the bill. Today, how much bank is paying? 1 lakh. On 30th April 25, bank is collecting 1 lakh. What is the benefit to the bank? There is no benefit now. That's why what bank will do, on 29th March, bank will pay less than 1 lakh to me. On 30th April, bank will collect 1 lakh rupee from drawee. And the difference between the amount paid by the bank and amount collected by the bank, nothing but discounting charges. This discounting charges is income for bank and expenses for the person who is discounting the bill. How do we calculate the discount? Sometimes in the examination, the discount amount may be given, or sometimes it is calculated by us. Bill amount. So how can we calculate discount? Tell me. Bill amount into rate of interest or rate of discounting and unexpired period of the bill. Bank will charge this discount for the unexpired period. In our case, in the earlier case, 29 March to 30th April 2025. How many days left? Calculate. And for these days, only bank will charge the discount amount. Divided by, if the days or if the unexpired period is in months, then here also in months. If unexpired period is in days, then we take days here. Right. What are the entries we record? In the books of drawer, what is the entry? We are discounting so that we are receiving money, bank account debit. And the discount which bank charge, that is expense for us, financial expense, discount account debit. And don't get confusion between this discount and discount allowed to customers. This is different and that is different. To bills receivable, because bills receivable is going from our side. Now, what is the entry in the books of drawee? In the books of drawee, there is no entry. Why? Because drawee is not involved now. Drawee is not involved in this transaction. Next, in the books of bank, what is the entry in the books of bank? Bank purchased bill na. So bank debits bills purchased under discounted account, and bank is paying amount immediately to the customer account credit, and bank is charging some discount. It is income for them. So discount on bills, discounted account credit. This is the entry we have to record. Next, third option, endorsement of a bill. To whom generally we endorse bill? To our creditors. Entry in the books of drawer or holder, endorsee account debit, because to whom we are endorsing? A person. Endorsee name we have to write. To bills receivable, we are giving bill. In the books of drawee, no entry. Why? Because drawee is not involved in this transaction. And in the books of endorsee, what is the entry? He is receiving bill, bills receivable account debit. From whom he is receiving? Drawer account debit. Is it clear? Next, bill sent to bank for collection. What are the entries in the books of drawer and drawee and bank? Drawee will not record any entry. Why? Because drawee is not involved in the transaction. Bank also will not record any entry. Why? Bank is not discounting the bill. Bank is just receiving the bills from drawer, and it will make just a record of register. It will make an entry in the register. It will make a record in the register of bills. Bank is not discounting, so that bank will not record any entry. But in the books of drawer, what is the entry? bill sent for collection account debit. We are creating a new account, that is bill sent for collection account debit to bills receivable account. Bill is going out now. In three situations, if you observe, in the three situations means discounting the bill, endorsement of bill, bills receivable credit, and bill sent to bank, bills receivable credit. In these three situations, bill is going out. The bill is going out. Hope you are following. And in the three situations, drawee is nowhere related. In the three situations, drawee is nowhere related. Hope you are following. Next, on the due date, there are two options. One, honor of the bill or dishonor of the bill. What's the meaning of honor of the bill? The bill amount is paid on the due date by drawee to the holder. Dishonor, on the due date, the drawee is not in a position to pay the amount to holder. Right? In case of honor, what are the entries? Same. Drawer books, drawee books. Drawee books only one entry. Why? Because he is paying the bill na. Bills payable account debit to bank account. Bills payable account debit to bank account. But in the when you are writing entries in the books of drawer, check that whether the drawer is holding the bill or whether the bill is held by somebody. I repeat, check that whether the drawer is holding the bill or it is held by somebody. If the drawer is holding the bill, then what is the entry he will record? Bank account debit to bills receivable account. If the bill is held by somebody, suppose in second case, who is holding the bill? Bank. Who will receive the money? Bank. In the books of drawer, no entry. In third case, who is holding the bill? Endorsee. Who will record the entry? Endorsee. In our books, no entry. In fourth case, bill sent to bank for collection. Who is holding the bill? Bank. Who is collecting the amount? Bank. But bank gives credit to our account, so that we record the entry bank account debit to bill sent for collection. Okay, these are the entries we have to record on honor of the bill. Next, dishonor of the bill. In case of dishonor of the bill, what we have to do is immediately we approach the holder of bill. I repeat, in case of dishonor of bill, the holder of the bill will approach the notary public. They are nothing but advocates. They will approach the advocates and they will say advocates will make a draft on the bill of exchange regarding the dishonor of the bill. This is called noting, and the advocates will charge some amount for making a note of dishonor of the bill. This is called noting charges. Who will pay the noting charges? The holder of bill first will pay the noting charges. Then after he will recover the amount from previous party. Ultimately, who will bear this noting charges amount? Drawee. Why? Because observe here. Yes, look at here noting charges. Drawer will pay noting charges and recovered from drawee when the bill is retained. Second case, discounting. Who is holder of bill? Bank. Bank will recover amount from drawer. Drawer will recover amount from drawee. Next, in case of endorsement, who is the holder? Endorsee. Endorsee will recover noting charges from drawer. Drawer will recover noting charges from drawee. Ultimately, who is bearing these noting charges? Drawee. Bill sent it to bank for collection. Who is the holder? Bank. They will recover amount from drawer. Drawer will recover from drawee. On dishonoring of bill, the holder is eligible to recover bill amount plus noting charges from previous party. Hope you are following. Yes. So in this case, what are the entries we record? Observe here. In the books of drawer, again in the books of drawee. In the books of drawee, we record only one entry. What is that? Earlier, whatever bills payable we have credited, now it becomes debit because it is no liability for us. And we have to pay noting charges now. Yes, noting charges account debit. It becomes expense for us. And the amount is payable to the drawer. The amount is payable to the drawer. So drawer account credit. This is the entry we record. Whatever the situation it may be, drawee will record this entry only. But drawer will record different entries. Look at first situation. If he is the holder of bill, then what is the entry? He should receive amount from drawee. So drawee account debit to bills receivable. He is holding the bill now. Now it becomes useless. So credit. And he is paying noting charges. Cash account credit. Second situation, discounting of bill. When he discounted the bill, if drawee fails to pay the amount, but we have to pay the amount now, bank will recover amount from us. So drawee account debit to bank account. Here bank will recover amount of bill plus noting charges. Amount of bill plus noting charges. Next, in the books, when we endorse the bill to endorsee, in that case, ultimately from whom we have to receive amount? Drawee. To whom we have to pay the amount? Endorsee. Endorsee account credit. Next, when the bill is sent to bank for collection, then what is the entry? Drawee account debit. If you observe in all the four cases, which account is debiting? Drawee account is debited. Drawee account is debited with the amount of bill plus noting charges. And next we are crediting, if the bill is discounted, suppose if we are holding the bill, we are crediting bills receivable. If the bill is discounted with bank, we are crediting bank account. If the bill is endorsed, endorsee account credit. And if the bill is sent to bank for collection, bill sent for collection account credit. And bank is paying noting charges and it will deduct this amount from our account. So these are the various situations of dishonor of bill. So on the due date, check that whether the bill is honored or dishonored. Next concept comes, important concept, retirement of bills of exchange. Retirement of bills of exchange. What is the meaning of retirement of bills of exchange? Before the due date of the bill, suppose if the bill is retired, if the bill is honored, I repeat, if the bill is honored before the due date, if the bill is honored before the due date, then this situation is called retirement of bill. When drawee finds he has surplus amount, then he will retire the bill. He will approach the drawer or he will approach the holder. Mr. Holder, I have surplus amount. If you want, I will honor the bill today itself. But for that, you have to allow me some rebate. Why? Because I am honoring the bill before the due date. Suppose if the holder says, hey, Mr. Go and come again on the due date. Okay, no problem. On the due date, what happens? Who knows? On the due date, the drawee may fail to pay the amount. Instead of that, whenever he is ready to pay the amount, you allow some rebate. Yeah, no problem. It is considered as financial charges, right? Look at, in that case, rebate is calculated. Rebate is calculated for the premature period. Premature period means from the date of honoring the bill to the date of actual due date. Premature period is nothing but that from the date of honoring the bill to the date of maturity. So for this time period, we allow some rebate. What is the entry in the books of payee? The payee may be drawer or any other person. Okay, we are receiving money, so cash or bank account debit. We are allowing rebate na rebate account debit to bills receivable. To bills receivable. In the books of drawee books only one entry. Bills receivable account debit. Sorry, it is not bills receivable. It is bills payable. Make a correction. It is not bills receivable, it is bills payable. Bills payable account debit to cash or bank account to rebate account. That's it. Next, renewal of a bill of exchange. Next concept is renewal of a bill of exchange. Renewal of bill of exchange means what? On the due date, if drawee fails to pay the amount, drawee knows that on the due date I am not in a position to honor the bill. I repeat, on the due date I am not in a position to honor the bill. If drawee feels that, immediately he approaches the holder of the bill, generally drawer of the bill. He will approach and ask him to extend the time period. Hello, Mr. Drawer, you are my friend, so that please extend the time period to the extent 2 months. Okay, my friend, no problem. I am ready to extend the time period, but you have to pay me the interest for the extended time period. Initially, I have allowed some credit period. That is for what? Trade purpose. But now you are asking me to extend more 2 months. So here I am also losing some interest. Okay, I will agree to this condition, but only thing you have to pay me the interest. If both the parties agrees to that, then the bill gets renewed. That means the old bill gets cancelled and the new bill is drawn. This is the situation of renewal of bill. This is very, very important concept in bills of exchange. In this case, what happens? Look at, recording entries are very important. So follow simple steps here. Follow some steps here. First step. Steps to be followed when the bill is renewed. First step, cancel the original bill. Sir, how can I record the cancellation of original bill? Just now we have discussed dishonor of bill entry. So record the entry for dishonor of bill, except noting charges. Here the drawee is coming voluntarily and asking us to cancel the bill. In this case, there is no concept of noting charges. Next, calculate interest on the outstanding amount. Calculate interest on the outstanding amount. Look at here. Yeah. Observe here. Suppose the bill amount is 1 lakh. Suppose the bill amount is 1 lakh. He is paying now 50,000. If he pays full amount, it is nothing but honor na. Either he will not pay any amount on the bill, or he pays some part of the bill. Suppose 1 lakh is the bill amount and he is paying 50,000 rupees now. He is paying 50,000 rupees now. Remaining amount payable 50,000. We calculate interest on this 50,000 rupees. Clear? So entry for interest. First, cancellation of the bill as usual. Drawee account debit to bills receivable. Here bills payable account debit to drawer. Interest due upon renewal. From whom we receive interest? Drawee. So drawee account debit. Interest becomes income for us, expense for drawee. So for us it is income, interest account credit. And in the books of drawee, interest account debit to drawer account. Next, part payment against the bill. If any part payment received, then we are receiving cash or bank account debit to drawee account. Drawee is paying now, so drawer account debit to cash or bank account. Next, we are drawing a new bill. In that case, bills receivable account debit to drawee account. And in the books of drawee, drawer account debit to bills payable. This entry is as usual. New bill drawn. But here the problem comes. The new bill amount may be, the new bill amount consists. Okay, look at. The new bill amount may consist old bill plus interest. In some situations, it is nothing but old bill plus interest. Suppose if he pays part of the amount, in this situation he paid part of the amount now. In this case, old bill consists of what? 50,000 rupees plus interest on 50,000 rupees. Interest on 50,000 rupees. Look at 1500. New bill consists of 51,500 now. So these calculations we have to take care. Next, come to the situation of insolvency of drawee. Insolvency of drawee means on the due date, if drawee fails to pay the amount, it becomes dishonor of the bill. And we think that drawee will pay amount later. But on the due date, if he becomes insolvent, means he is unable to pay his debts, or he is not in a position to pay debts. In that case, what we do? Simple. In that case, first situation, we cancel the bill. Because whatever the bill we are holding, that is useless now. Cancel that bill. Cancellation bill, nothing but dishonor of bill. So drawee account debit to bills receivable account or bank account. In the books of drawee, bills payable account debit to drawer account. Next, finally, how much amount we are receiving? Check it. Finally, how much amount you are receiving? Suppose we have to receive 1 lakh rupee from drawee. Out of that, if you are receiving, for example, 50,000, remaining 50,000 becomes bad debts for us. So here we record the entry for the same. Bank account debit 50,000, bad debts account debit 50,000 to drawee account 1 lakh. Over. In the books of drawee, what is the entry? Drawer account debit 1 lakh. How much amount he is paying? 50,000. Remaining amount he is not able to pay now. So it is a deficiency. This amount is transferred to the deficiency account. Yes, that's it. So till now, whatever we have discussed, all these bills are trade bills. Now we try to solve some problems on trade bills. Then after we come to the concept of accommodation bills. Clear? Look at. Now here I have taken some illustration problems from our study material for our discussion in the marathon section. Now observe carefully. Miss Sujata receives two bills from Miss Aruna dated 1st January 2022 for 2 months. The first bill is for 10,200 and the second bill is for 15,000. The first bill is discounted immediately with the bank for 10,000 and second bill was endorsed in favor of Mr. Sri on 3rd January 2022. Pass the necessary journal entries in the books of Mrs. Sujata. See here they are not saying that whether the bill is honored or dishonored. Ignore that. Now, in whose books we have to record the entry? In the books of Miss Sujata. So, who is Sujata? She is the drawer of bill. On 1st January 2022, record the entry for two bills received. Bills receivable account debit 10,200 plus 15,000, 25,200. To from whom? Who is the acceptor? Miss Aruna. So, bills receivable account debit to Miss Aruna account. Next one, the first bill is discounted. Now, what is the entry for discounting of bill? Bank account debit, discount account debit to bills receivable account. Here they said we discounted for 10,000, means first bill is for 10,200, difference 200 is nothing but discount. So, bank account debit 10,000, discount 200 to bills receivable 10,200. Second bill, what happened? We endorsed in favor of Mr. Sri. What's the entry? Mr. Sri account debit to bills receivable account. That's it. Simple. Over. Next. Look at illustration 2. First come to illustration 3. On 1st January 2022, Ankita sells goods for 5 lakhs to Bhavika and draws a bill for 3 months for the amount. Bhavika accepts it and returns it to Ankita. What is the entry in the books of Ankita? First, sales entry we have to record now. Bhavika account debit to sales account 5 lakhs, and we are drawing a bill, and we are bill is accepted by Bhavika and it is received. Entry, bills receivable account debit to Bhavika account 5 lakhs. In the books of Bhavika, what is the entry we record? First one, purchase transaction, purchases account debit to Ankita account, and we are accepting the bill. Yes, Ankita account debit to bills payable account. Next, what happened? On 1st March 2022, Bhavika retires her acceptance under a rebate of 12% per annum. See, on 1st March, here you should calculate the due date of the bill. What is the due date of the bill? Tell me. It is drawn on 1/1/2022. It is for how many months? 3 months. So, 1/4/2022. 3 days maturity date. So, 3/4/2022 is the due date of the bill. But it is honored before due date 1st March. So, how many months before it is honored? 1 month before it is honored. So, for 1 month we have to calculate rebate. Look at, calculate rebate for 1 month. 5 lakhs into 12 by 100 into 1 by 12. How much we are getting? 500. Sorry, 5,000. Yes. Look at what's the entry we record. We receive bill amount is 5 lakhs minus 5,000. We receive 4,95,000. Bank account debit 4,95,000. Rebate account debit 5,000 to bills receivable. In the books of Bhavika, reverse entry means bills payable account debit 5 lakhs to rebate account and to bank account. Next, come to second problem here. It is renewal problem. Observe. Vijay sold goods to Preetham on 1st September 2022 for 1,06,000 rupees. Preetham immediately accepted a 3 months bill. On due date, Preetham requested that the bill is renewed for a fresh period of 2 months. So, 2 months he is asking for extension. We charged interest for 2 months. Vijay agrees, provided interest at 9% per annum was paid immediately in cash. So, interest portion he has to pay immediately. Means the new bill amount is nothing but original bill amount. New bill amount is nothing but original bill amount, because interest we are receiving instantly. To this, Preetham was agreeable. The second bill was met on due date. Give journal entries in the books of Vijay and Preetham. First, in the books of Vijay and Preetham, what is the entry we record? First, sales entry. Preetham account debit to sales account. Preetham account debit to sales account. This is the first entry. Second entry, we are drawing a bill. Bills receivable account debit to Preetham account. Bills receivable account debit to Preetham account. On the due date, calculate the due date of the bill. 1st January plus 2 months. Means 4th March is the due date of the bill. On this due date, the bill gets renewed. Means what are the steps we have to follow? First, cancel the original bill. Cancel the original bill. What is the entry for cancellation of original bill? Preetham account debit to bills receivable. This is the cancellation entry. Immediately calculate interest. Interest calculation. See, 9% per annum na? Interest calculation 9% per annum. 1,06,000 into 9% into 2 months na, 2 by 12. It comes to 1,590 rupees. So, record the entry for 1,590. Preetham account debit to interest account 1,590. This amount instantly we are receiving. Yes sir. And we are drawing also new bill. Look at bills receivable 1,06,000. We are receiving cash 1,590 to Preetham account 1,07,590. Okay. On the due date, we received the second bill amount. Yes, sir. Second bill amount is nothing but 1,06,000. In the books of Preetham, first transaction purchases, purchases account debit 1,06,000 to Vijay. We are accepting bill, Vijay account debit to bills payable. Next, on the due date, first bill gets dishonored. Okay, so reversal entry, bills payable account debit to Vijay account. And we are paying interest. We have to pay interest first, interest due entry, interest account debit to Vijay account 1590. And we are paying cash 1590 and we are accepting a new bill entry. Vijay account debit 1,07,590 including interest to cash 1590 interest amount, new bill 1,06,000. On the due date, this bill gets honored now. So Vijay bills payable account debit to cash account. Hope you are following. Now come to important problem of renewal of bill, that is illustration 8. Come to illustration 8 once. Rita owed, very important problem. Rita owed 1 lakh to Siriman. On 1st October 2021, Rita accepted a bill drawn by Siriman for the amount of 3 months. What is the entry in the books of Siriman? Bills receivable account debit to Rita account. So in the books of Siriman, entry bills receivable account debit to Rita 1 lakh. Next, see here bills of exchange, the important is it is given. Actually, we have to record all the entries. But these are in the form of a paragraph. From this paragraph, you have to gather the transactions, and that too they are chronological order. Then only it is possible to record one by one. Right. Next step. Siriman got the bill discounted with his bank for 9,000 on 3rd October 2021. Actually, the bill amount is 1 lakh. Discounting charges 9,000. Sorry, it is not 9,000. It is 90,000. I think. Yeah, 9,000 only. Okay. Discounted for 9,000. 9,000 is the discounting charges. Remaining amount, how much we receive? 91,000 rupees we receive. Entry. Bank account debit 91,000. Just a minute. It's a problem. Okay. Make a small correction. It is 99,000. Discounted for 99,000. Okay. On 3rd October. You need not to calculate discount now. Why? Because bill amount 1,99,000 is the discounting charges. 1,000 is the discount. Entry. Bank account debit 99,000. Bank account debit 99,000. Discount account debit 1,000 and bills receivable 1,000. What happened next? Rita approached Siriman for renewal of the bill. Oh my God. So, but the who is the holder of bill? Bank. Now Rita approached for renewal of bill. Okay, fine. But we have to pay amount to the bank now. So on the due date, we have to pay amount to the bank. Entry. Rita account debit. We receive amount from Rita and 1 lakh rupee amount we pay to bank now. See, Rita account debit to bank. Dishonor entry. Right? Bank will deduct amount from our account. Okay. Next, what happened? Siriman agreed on the condition that 50,000 to be paid immediately, together interest on the remaining amount at 12% per annum for 3 months. And for the balance, Rita should accept a new bill at 3 months. Very important. Look at what is the total bill amount? 1 lakh minus immediately I am paying 50,000 rupees. Remaining amount payable 50,000. On 50,000, calculate interest at 12% per annum. Calculate 50,000 into 12% into 3 by 12. So it comes to 1,500 rupees. Now what is the condition? 50,000 plus interest instantly you have to pay. Okay. What is the remaining amount payable? 50,000. For the remaining amount, I will draw a new bill. Now what are the entries? Tell me. First, whenever the bill gets renewed, what are the entries we have to write? First, cancel the original bill. Yes, sir. We have recorded cancellation of original bill. First entry. Second, calculate interest and record the entry. Interest calculated 1,500. Yes, sir. Interest is expense for Rita and income for us. Entry. Rita account debit to interest account 1,500. And we are receiving 51,500 from Rita. Yes, sir. Bank account debit to Rita account 51,500. And we are drawing a new bill. Yes, sir. Bills receivable account debit 50,000 to Rita account. Or instead of writing these 3 entries, you can combine these 3 entries and you can write one entry. What is that? Simple. Bank account debit 51,500 Bills receivable account debit 50,000, to interest account 1500, to RETA account 1 lakh. Simple. Next, what happened? Okay, RETA should accept. Okay, fine. These arrangements were carried out. Very good. We have also recorded the entries. But afterwards, RETA became insolvent. RETA became insolvent. Immediately, first we have to write cancellation of the bill entry. What is the cancellation of bill entry now? Same. RETA account debit. Earlier the bill is discounted with bank. That's why bank account is credited. Now the bill is retained with us. Entry RETA account debit to bills receivable account. Look at RETA account debit 50,000 to bills receivable 50,000. Next, what happened? And 40% of the amount could be recovered from his estate. Total amount receivable 50,000. Out of that 40,000 received 20,000, remaining 30,000 bad debts. Entry bank account debit 20,000, bad debts account debit 30,000, to RETA account 50,000. Over. This type of problem you may get for 8 to 10 marks. Okay. So here the same problem can be changed in the examination. How, sir? Simple. Here the journal entries is in the books of Siriman. They may ask journal entries in the books of RETA if they want to twist the student. But students, observe here. Here the requirement is in the books of Siriman. That's why we have recorded from Siriman point of view. But examiner may change that, record the entries in the books of RETA. It's a googly for us. Now you have to think from RETA point of view and record the entries. Clear? Now look at the next problem, 10th problem. 10th problem is on the concept of accommodation bill. Now we discuss accommodation bills concept. We discuss accommodation bill concept. In case of accommodation bill, what happens? Already we have discussed that accommodation bills are drawn and accepted only for temporary financial need purpose. Now at this point of time, you understood that the value of bill of exchange. This bill of exchange is equal to money. It can be discounted with bank and immediately you can get the amount, and this can be endorsed to some other person also. And this mechanism of bills of exchange is utilized by some people to meet their temporary financial needs. What happens in case of accommodation bills? Tell me. In case of normal trade bills, what happens? What is the first transaction? The first transaction in case of trade bill is sale of goods. After that, bill is drawn. After that, bill is 4 options. After that, bill may be honored or dishonored on the due date. After that, the bill may be retired, or the bill may be renewed, or on the date of dishonor, the drawee may become insolvent. This is the process of trade bills. Now, accommodation bill process is what? First, there is no sale transaction. Yes, sir. After there is no sale transaction. Next transaction, drawing of bill. Yes, this will happen. Drawing of accommodation bill. This is one transaction. Record the entry in the books of drawer and record the entry in the books of drawing. Next, after drawing the bill, the drawer of the bill will discount the bill. In case of trade transaction, the holder has 4 options. One, retain. Second one, discount. Third one, endorse. Fourth one, send bill to bank. But here, the drawee is not possible to opt 4 options. Why? Because this is accommodation bill. If you retain the bill till due date, what is the necessity? Okay, so that retaining of bill is not possible. Either you have to discount, or if you pay, if you want to pay, or if you have to pay amount to somebody, then you can simply transfer this bill. Only 2 options. But majority of the cases, the first option, that is discounting of the bill, is followed. Discounting of the bill is followed. Look at second one. The drawer of the accommodation bill gets discounted by the bank. Third case, third situation. For this, we have to record the entry. In this second case, entry is only in the books of drawer. Now, third case, what happens? As these accommodation bills are for mutual accommodation purpose. Now, out of the proceeds of the bill, the amount may be shared by both the parties according to particular ratio. Now, who is holding the proceeds? Drawer. He will pay. He will send amount to drawee. Proceeds are shared or utilized by the drawer, drawee, or both parties as per agreement. When the proceeds are shared, at the same time, discount also shared. When the proceeds of amount is shared, then the discounting charges also shared by both the parties. This is very, very important. Okay, the discount amount is borne by the parties in proportion to the sharing proceeds, 50-50 or 1 by third, 2 by third, like that. That depends on the problem. We have to record the entry. See here, whatever the points I have given, all these are transactions. Accommodation bill drawing transaction, discounted transaction, proceeds shared transaction, discount also shared transaction. Okay, now come to due date. Come to due date of the bill. On the due date of the bill, who has to honor the bill? Drawee has to honor the bill. But here the bill amount is shared. Bill amount is utilized by both the parties. So one party, drawer, has to remit his share to drawee, and drawee also add the amount, his share, and drawee will honor the bill. Before the maturity date, the drawer remits his share of proceeds to the drawee so that the drawee can meet the bill of exchange. If this is happened, if this is happened till now, then it is hold good. Bank happy, drawer happy, drawee happy. But what happens if on the due date or on the maturity date or before the maturity date, drawer fails to send his share of amount? In that case, what happens? Drawee is not in a position to honor the bill. Why? Because drawer is not remitting his share now. Drawer is not remitting his share. He is ready to add, but drawer is not remitting his share. In that case, if bill becomes dishonor, compulsorily drawee has to pay the amount. Why? Because drawee is accepted. Drawee is accepted. If he fails, compulsorily drawer has to pay the amount. But drawer is not in a position. If drawer is not able to pay the amount, then automatically bank knows that this is an accommodation bill. This is not a trade bill. Yes. To avoid those situations, what we do is the drawee of the first bill will draw a new bill. The drawee of the first bill will draw a new bill. Okay. However, sometimes the drawer may not remit the proceeds to the drawee on the due date. In such a case, what happens? Drawee may draw a bill on the drawer. Suppose A is the drawer, B is the drawee, first bill. Second time, what happens? B will draw a bill on A. In these situations, who is drawer and who is drawee? B is drawer, A is drawee. For the first bill, A is drawer, B is drawee. For the second bill, B is drawer, A is drawee. Hope you are following. Yes. Now, A has to accept the bill. Again, transaction. B is drawing a bill and A is accepting a bill. It's a transaction. After accepting, it is remitted to sent to B. What B will do? B will discount the bill. B will discount the bill. Out of the proceeds of discounting of second bill, first they will honor the first bill. Out of the proceeds of second bill, they will honor the first bill. If any amount remained, that is shared again. That is shared again. After that, what happens? On the due date of second bill, how they will settle the second bill? That is the problem comes. Here what happens? At the end, ultimately the person who is drawing the first bill, he becomes insolvent. At the end, what happens is, the person who is drawing the first bill, he becomes insolvent. This will happen in case of accommodation bill. See the steps once again. Drawing of bill. Next, the bill gets discounted. The proceeds are shared between parties. Discount also shared. On the due date, if drawer fails to remit the amount, then drawer will draw a new bill. Out of the proceeds of second bill, they will honor the first bill. Now, we have to honor the second bill. Who has to honor the second bill? Drawer of first bill. Who has to honor the second bill? Drawer of first bill, because he is accepted now. Second bill accepted by first bill drawer. He becomes insolvent. He becomes insolvent. He becomes insolvent. In that case, who has to honor? Drawer. Drawee of second bill. He has to honor. Thereafter, he will recover amount from the insolvent person. This will happen in accommodation bills. The accounting treatment for accommodation bills exactly similar to trade bills, with the exception that third transaction and fourth transaction. Okay, third transaction is nothing but sharing the proceeds. Fourth transaction is nothing but discount amount shared. Observe the accounting treatment. Entries are passed in the books of both parties in the way already pointed out for ordinary bills. The only additional entry to be passed is remitting money by one party to other party. What is the entry here we record? In the books of drawer. He is sending money na drawee account debit to bank account to discount account. Next one, in the books of drawee, he is receiving money, so bank account debit. Discount he has to bear discount account debit to drawer account. These are the additional entries we have to record. This is the accounting of accommodation bill, but it is not that much of easy. If we solve 2-3 problems now, then only you can understand the real concept of accommodation bill. Now, look at the accommodation bill problems. Illustration 10, observe carefully because these type of problems are very important from examination point of view. We discussed 2 problems on this accommodation bills. Observe carefully. X draws on Y a bill of exchange for 30,000 on 1st April 2022 for 3 months. Y accepts the bill and sends it to X, who gets it discounted for 28,800. Till now we don't know whether it is accommodation bill or trade bill. X immediately remits 9,600 to Y. By looking this one, we come to know that yes, it is an accommodation bill. In case of trade bills, after discounting the bill, the proceeds are not shared. But here the proceeds are shared. Now, the first entry in the books of X, and in the books of Y. First entry for drawing the bill. We see first in the books of X, bills receivable account debit to Y account, bills receivable account debit to Y account 30,000. And it is discounted in the books of X. What is the entry? Bank account debit 28,800. Remaining difference 1200 is discount, discount account debit 1200 to bills receivable account 30,000. Next, X immediately remits 9,600. 9,600 means, see, for 28,000, how much is the discount? 1200. And how much amount is shared to Y? 9,600. How much is the discount? Simple cross multiplication. 9,600 into 1200 divided by 28,800. That comes to 400 rupees. So, in addition to the amount shared 9,600, discount 400 also should be borne by Y. What is the entry we record? Simple. Y account debit to cash account or bank account 9,600. Earlier we debited discount, now it becomes credit 400. Now total amount for Y is 10,000. What happens on the due date? Means out of 30,000 rupees, 10,000 is utilized including discount. 10,000 is utilized by Y. Means remaining 20,000 is utilized by whom? X. Nothing but 2/3 is utilized by X and 1/3 is utilized by Y. Okay. That's why the discount amount also shared like that. 1200 into 1 by 3, that comes around 400. Hope you are following. Yes. Now, in the books of Y, what is the entry he will record? Tell me. For the first transaction, X account debit to bills payable. Second transaction, bill discounted by X. In the books of Y, no entry because it is discounted by X. Now, Y is receiving amount? Yes, sir. Bank account debit. How much amount received? 9,600. Discount amount? 400. And 10,000 rupees X account credit. Observe here. X account debited here 30,000 and X account credited here 10,000. What's the difference? 20,000. Means we have to receive 20,000 more amount from X. After receiving 20,000, we add our 10,000 rupees and we honor the bill on the due date. But what happened? Look at. On the due date, X being unable to remit the amount due. X has to remit actually 20,000, but he is unable to send. Accept a bill for 42,000 for 3 months, which is discounted by Y for 40,100. Now Y is drawing a bill. So in the books of Y, what is the entry we record? Bills receivable account debit to bank account 42,000. X is accepting the bill. Yes, sir. Entry Y account debit to bills payable account. Y account debit to bills payable account. Now this bill is discounted by Y. In the books of Y, what is the entry? Bank account debit, he discounted for 40,110. Actual bill amount 42. So discounting amount is 1890. To bills receivable account. Bills receivable account. How much amount he received by discounting the bill? 40,110. Out of this, first what he will do? He will honor the first bill. Entry for that. Bills payable account debit to bank account. Now how much amount he has remaining amount? 10,110. 10,110 because 40,110 is the amount received by discounting the bill. Out of that 10,000 is paid, 30,000 is paid. Remaining amount 10,110 he has. Now how they will share this amount, extra amount? Look at. Y sends 6,740 to X. Out of 10,110, how much amount Y is sending? 6,740 to X. Okay, for this what is the entry we have to record? Here not only amount, we have to see the discount also. Most of the students, they will face difficulty in calculating the share of discount of both the parties. For that, here is a simple calculation. Observe. So I will show you the simple calculation here. You can follow that. Yes, this is the calculation. Observe. Second bill, first bill anybody can calculate, but come to second bill. What is the second bill amount? 42,000, sir. Okay. Out of 42,000, we received 40,110. Remaining is discount. And this discount is shared between X and Y. How this discount is shared? That depends on how 40,110 is utilized. Look at first. How much amount utilized by X? Directly we are sending 6,740. It is given in the problem. Yes, sir. And out of the proceeds of second bill, first bill is honored. Yes, sir. Out of the first bill, how much amount should be remitted by X? 20,000. 20,000 actually X has to remit. Means indirectly X is utilized 20,000 also. So total amount utilized by X 26,740. Out of 40,110, how much amount is utilized by X? 26,740. Okay, so for 40,110 discount is 1890. Then for 26,740, how much is the discount? Cross multiplication, it becomes 1260. Out of 1890, 1260 is borne by X, remaining amount is borne by Y. Now tell me what is the entry we record? In the books of Y, we record the entry X account debit to bank account 6,740 we are sending, and discount 1260. Both together X account is debited. In the books of X, quite it is reverse. What is that? Bank account debit 6,740, discount account debit 1260 to Y account 8,000. Now the twist comes. Before the maturity of the bill, X becomes bankrupt. Actually, second bill should be honored by X, but before that maturity date, he becomes insolvent. Now who has to honor the bill? Y has to honor the bill. In the books of Y, what is the entry he will record? Dishonor entry. Simple. X account debit to bank account 42,000. X account debit to bank account 42,000. Now he will recover amount from X. X will record the entry for dishonor of the bill. Dishonor of the bill entry, bills payable account debit to Y account. Here the problem comes. Ultimately, how much amount is received from X? Ultimately, how much amount is received from X? That is nothing but this calculation shows. This calculation shows how much amount is receivable from X. Nothing but 26,740 receivable plus discount. Total amount receivable is 27,000, 28,000 is the total amount receivable. 26,740 plus 1260. This is the amount we have to receive from X, 28,000. Observe. But we are unable to receive this amount. Na? We are unable to receive this amount. Only 50 paisa we are able to receive. Means 14,000 rupees we are only able to receive. For that we record the entry. Receipt. Bank account debit 14,000. Bad debts 14,000 to X account 28. Over. In the books of X, Y account debit 28,000 to bank account to deficiency account. This is very, very important. This is a lengthy one because we have to record entries in the books of X and Y. Sometimes they may ask only in the books of X and only in the books of Y. Hope you are following. Yes. Now look at the next problem, illustration 11. This is also on the concept of mutual accommodation, similar to illustration 10. For mutual accommodation of X and Y, on 1st April 2022, X drew a 4-month bill on Y for 4,000. But here they have asked only entries in the books of X. But the same problem, how the examiner may change in the final exam. They may ask here, record the entries in the books of Y. So you have to be ready. When you are writing entries in the books of X, you have to think from X point of view. When you are recording entries in the books of Y, you have to think from Y point of view. Now, first we record the entry for 4,000 rupees. What is that? Bills receivable account debit to Y account 4,000. Fine. Next. Y returned the bill after acceptance of the same date. Fine. X discounts the bill from his banker 6% per annum and remits 50% of the proceeds to Y. See, 4,000 rupees into 6% is the rate of interest. 4,000 into 6%, and it is the bill is for 4 months. So here you have to calculate the discount 4 by 12. It comes 80 rupees. That means finally how much amount we receive? 3,920. Bank account debit 3,920, discount account debit 80, and two bills receivable 4,000. They said 50% amount is remitted to Y. Means out of the proceeds 50% remitted. Means discount also 50% he has to bear. Yes sir. So Y account debit 2,000, 4,000 bill amount into 50%, 2,000. Proceeds 3,920 into 50%, 1,960. Discount 50%, 80 rupees into 50%, 40 rupees. Now look at, so 50% of the amount 50% and discount also 50%. In the books of Y, this entry quite reverse. Next, what happened? On the due date, X is unable to send the amount due. Thereafter, Y draws a bill for 7,000. See, on the due date, Y has to honor the bill because Y accepted now. To honor the bill by Y, Y will add 2,000 and X has to remit 2,000. Then only the first bill gets honored, but it will not happen here. Y is drawing a bill for 7,000. Y is drawing, that means we are accepting. In our books, what is the entry? Y account debit to bills payable account 7,000. After this, what Y will do? Y will honor the bill. Sorry, Y will discount the bill. Y will discount the bill which is duly accepted by X. Y discounts the bill for 6,600 and sent 1,300 to X. 6,600 he received. Out of that, first he will honor 4,000 rupees bill. Remaining amount, how much he has? 2,600. 2,600. Out of that, he is remitting 1,300. Here also the problem comes, how the second bill discount is shared. For that also, yeah, observe here, second bill is 7,000 rupees. Okay, 6,600 we received, 400 rupees is the discount. Out of 6,600, how much amount used by X and how much amount used by Y? We are directly sending 1,300 to X and first bill amount he has to pay 2,000 rupees. How much amount utilized by X? 3,300. How much amount utilized by X? 3,300. For 6,600 bill amount is, discount amount is 400. For 3,300, how much is the discount amount? Discount amount, cross multiplication 200. So 400 out of 400, 200 is borne by X and 200 is borne by Y. Now we are receiving amount. Yes sir. Bank account debit 1,300. Bank account debit 1,300. Discount also we have to bear 200 rupees. Total 1,500. Yes. On the due date, what happens? Tell me. Before the due date, the bill is due for payment. X become insolvent. We became insolvent. What is the entry in the books of X? In our books, bill is cancelled or dishonor of the bill. Entry, bills payable account debit to Y account. Bills payable account debit to Y account. Now the question comes, how much amount is payable to Y? Sir, last entry recorded for 7,000, no sir. So 7,000 is payable. No, wrong. If you want to know how much amount is payable to Y, you can prepare either Y account or simply look at this calculation. Here, what is the total amount utilized? 3,200, 3,300 plus discount amount 200. Total amount payable to Y 3,500. Like this you can calculate. But how much amount we are paying? Tell me. Later 25 paisa in a rupee received from his estate means 3500 we have to pay into 25 paisa. Only 875 rupees we are paying to Y entry. Y account debit 3500 to bank account 875 to deficiency, remaining amount 2625. Now the same problem you people try to solve from Y point of view. Then only you get clear cut knowledge on accommodation bills. So this is our accommodation bill, students. So from examination point of view, I have covered various aspects of trade bills and various aspects of accommodation bills. Okay, we start our next discussion with the bank reconciliation statement. That is also very important chapter. Hello students, how are you all? I hope you are doing well. Previously, we have discussed accounting for GST and bills of exchange and promissory notes. In this video, we discuss bank reconciliation statement. This chapter is very important chapter. This chapter is very important from examination point of view. Not only from examination point of view, but also from practical point of view also. When you are preparing, you are journalizing the transactions, at the end of every month, what we do is we reconcile the cash book and passbook and we prepare bank reconciliation statement. This is unavoidable. This is unavoidable. So what is this bank reconciliation statement? Now we try to understand. Most of the students, they get confusion in this concept of bank reconciliation statement. Why? Because lack of basic understanding. That's it. Now we try to discuss this chapter with simple logic and how to solve the problems. Here I will also solve problems. Some 3 to 4 different types of problems we have. All those problems we try to solve. Right. Now look at, first, observe the accounting cycle. Our accounting cycle starts with identifying the transaction and recording them in the journal and posting them into ledger. After posting, next casting and balancing. After balancing the ledger, now we prepare the trial balance. From trial balance, we prepare the financial statements. Yes. Now my question is, do you find here in the accounting cycle the concept of bank reconciliation statement? No, sir. Our accounting work can be divided into bookkeeping and accounting. Now tell me, do you have any bank reconciliation statement in this bookkeeping and accounting process? No. Then why we are learning, sir? Why we are learning? Bank reconciliation statement is just a technique. It is a technique. It is neither bookkeeping nor accounting. It is not at all a part of our accounting process. Then why we are learning? I told you now, it is a technique to reconcile the bank balance as per cash book and passbook. That's it. Sir, what are you saying, sir? We are unable to understand. Yes. Now look at, I will give you one example here. Observe one example here. Whenever we deal with bank, what are our dealings with bank? Tell me. Let us say Mr. A is dealing with bank. First of all, he should open an account with the banker. Yes. Now we have opened an account. Opening account means we are depositing money into bank. And whenever we need money, we can withdraw that money, either by ATM withdrawal or check withdrawal or over the counter. Whatever it may be, it comes under withdrawal process. Yes or no? So deposit, one transaction deposit. However you deposit, that is secondary. Whether you deposit amount directly or whether you send any person to the bank to deposit money or any third party deposited money into your account, or you have you received some checks and you deposited the check into bank. All these are comes under deposits. Withdrawals may be anything. You may directly withdraw money or you may issue checks or you may instruct the banker to pay the amount on behalf of you. All these are comes under withdrawal. So there are only majorly two transactions with the bank. That means bank and its customer. One depositing money in various forms and withdrawing money in various forms. Hope you are following. Yes. Whenever these transactions happened between Mr. A and Mr. Bank, then these two parties will record the transaction. Mr. A will record the transaction in cash book. We have already discussed cash in our regular classes. And bank also record the transaction in the bank books. I repeat, Mr. A records the transaction in cash book. Bank records the transaction in bank books. Okay. both the parties will record the transaction. Look at Mr. A will record the entry either in 2-column cash book or in 3-column cash book. If he maintains cash and bank column in 2-column cash book, then he will make the entry, or else he will record the entry in 3-column cash book. In the entire chapter of BRS, bank reconciliation statement, the cash book means 3-column cash book. Cash book means what? 3-column cash book. Do remember. So Mr. A records the transaction in cash book and bank also records the transaction in bank books. So we maintain bank account na? We maintain bank account. Bank maintain customer account. We maintain bank account. Bank maintain customer account. Let us take one transaction here. Cash deposited into bank 1 lakh. In our cash book, we record the entry on the debit side. Yes or no? Yes. The same transaction bank also records in bank books. Bank will maintain customer account. Now, who is the customer here? Mr. A. Bank will maintain Mr. A account. Mr. A account credit side it will record. We are recording the transaction on debit side and bank records the transaction on credit side. Opposite now, both parties will record the transaction but not on the same sides. See, from our point of view, what is the entry we record? Bank account debit to cash account. From bank point of view, it is what? Receipt of cash. So cash account debit to customer account. Customer account is credit. Yes, credit. In our books, bank account debit. Yes, debit. Hope you are following. Yes, sir. Next, cash withdrawn from bank 50,000. From our point of view, what is the entry we record? Cash account debit to bank account. Bank account is credited now. Yes, sir. Bank account credit 50,000. From bank point of view, cash is going out now. Who is withdrawing money? Customer. So customer account debit. Customer account debit to bank account 50,000. Hope you are following. Now balance the cash book and passbook. We balance cash book, bank balance, customer account. When you balance the cash book, debit side 1 lakh, credit side 50,000, difference is 50,000. This is the balance amount. Yes, sir. Which balance it is? It is debit balance. Which balance it is? It is debit balance. Now, bank balances customer account now, Mr. A. Tell me. Credit side 1 lakh, debit side 50,000, remaining amount is 50,000. And it is called credit balance. It is called credit balance. So, when a transaction is recorded by both the parties, one transaction is recorded by both the parties, then the balance amount, the ultimate balance in both books is equal. Amount is equal. But from our point of view, it is debit balance. From bank point of view, it is credit balance. From bank point of view, it is credit balance. Yes or no, students? What we can say that bank balance as per cash book 50,000 debit. Balance as per cash book 50,000 credit. Yes or no, students? Yes. Here it is equal. Here it is equal. Why? Because there are two transactions happened between banker and its customer. Two transactions are recorded in the cash book as well as in the passbook. That means bank books. That's why we got the same balances, but the nature of balance is opposite. Nature of balance means debit balance and credit balance. But practically cash book balance, bank balance as per cash book and passbook, both are different. Both are not same. Okay. Sir, what is this passbook, sir? Yes. Whenever you open an account with the banker, immediately bank will issue a small book. That is nothing but passbook. Passbook is nothing but a copy of ledger account of customer. See, here bank is maintaining customer account. Here bank is maintaining customer account. The same details are provided in the passbook. But the passbook is not in this format. Here, for example, I have drawn. But the passbook is statement format. I will show you here. Observe. Passbook is in the statement format like this. Bank will maintain customer account like this. And here bank will balance customer account after each transaction. Normally we in cash book is balanced daily to check the cash balance. But bank will balance customer account after each transaction. So what is the meaning of after each transaction? Suppose I have deposited money in the bank. So I am writing cash 1 lakh, cash 1 lakh. Now immediately bank will balance. Here withdrawal column, this is deposit column. Now look at here, what is the balance? 1 lakh. Next, suppose I have withdrawn money from bank. Now this time withdrawal column 50,000. Previous balance is how much? 1 lakh. Look at the balance column. Now how much amount I have withdrawn? 50,000. Remaining balance is how much? 50,000. Over. This is how bank will record the entries in the passbook. And sometimes bank will send to its customer bank statement. Passbook and bank statement both are same. But passbook you have to take it to the bank and you get it updated. Whereas bank will send periodically statement to the customers. Sir, periodically means what? Every month. Every month first week or every month first or second, bank will remit statement to the customer account, to the customer mail ID, to the customer's mail IDs. Earlier bank used to send a statement in a printed format, but nowadays bank is sending in a mail format. Okay, is it clear? Now this is happening when bank balance as per cash book and passbook are same, then there is no concept of BRS, no need of any bank reconciliation statement. But when cash book balance and passbook balance, bank balance as per cash book and passbook both are not same. We deposited 50,000 rupees money in the bank. If we see cash book, it should show 50,000, passbook also it should show 50,000 or bank statement, but it is not showing any amount. In our cash book it is showing 50,000, but in the passbook it is not showing any amount. Then what is the reason? We should identify, na, it is money, na. We should not ignore it. So that we have to identify what are the causes. What are the causes for the difference? By identifying the causes, now we present them in a statement format. Cash book balance, passbook balance. For the difference of these two balances, what are the causes? All these things we present in a statement format. That statement is nothing but bank reconciliation statement. Hope you are following, students. Yes. Now, to understand bank reconciliation statement, first try to understand what are the transactions between bank and its customer. See, generally there are some transactions happens between business and debtors, business and creditors, business and proprietor, business and partners, business and shareholders. At the same time, here also there are some transactions between business and bank. Business and bank. By majorly speaking, there are two transactions only. One, deposit, two, withdrawal. Deposit of money to withdrawal of money. But these deposits and withdrawals in various forms. Now we discuss them. See, first one, cash deposited for opening an account. In our cash book, we debit. In our cash book, we debit bank account. Na? We debit bank account. Bank will credit our account. Bank will credit our account. Cash withdrawn for office use, we credit bank account, whereas bank debits our account. Next, checks deposited in bank. Check deposited in bank is a form of deposit. Whenever we are depositing cash or checks, whatever it may be, we simply debit bank account. Bank will credit our account only when the check is collected. Only when the check is collected. Only when the check is collected. Yes or no? If check is not collected, then bank will not record any entry, na? Yes, sir. Next one, dishonor of deposited checks. If you observe, above we have deposited checks, na? Above we have deposited checks. If the deposited checks are not collected by bank, then what we have to do? Immediately we have to make a reverse entry. Immediately we have to credit bank account. Immediately we have to credit bank account. We know the dishonor entry. Debtor account debit to bank account. But in the passbook, no entry. Why? Bank will record entry only when it is collected. But here check is not collected. So that bank not made any entry in the books. So that for the dishonor, bank will not record any entry. Next one, very, very important concept, students. Next, checks issued for payment. Checks issued for payment. What is the entry for payment? Supplier or creditor account debit or any expense account debit to bank account. So we credit bank account. We credit bank account because it is payment, no? It is payment. If the same checks are presented to bank, see, this is nothing but withdrawal. This is nothing but withdrawal. Yes or no, students? This is nothing but withdrawal. Now bank will debit our account. When we are crediting bank account, bank will debit our account when only only when the checks are presented. Only when the checks are presented. Observe carefully. Only when the checks are presented, bank records the entry in bank books. If the checks, see, I have issued checks to you, you have to go to bank and deposit the checks into bank. Otherwise, how can bank will debit my account? No. So you have to go to bank, deposit the checks into your account, then only bank will able to collect it. After payment of the check amount, bank will debit an entry in bank books. Till that time, you have recorded entry. Till that time, you have recorded the entry, but bank not recorded the entry. If you see the cash book and passbook, there is a difference, na? At the same time, here we have deposited check into bank, but bank will record only after collection. Before collecting the check, if you observe the cash book and passbook, automatically there is a difference, na? So here there is a time gap. Here there is a time gap. Next one. Dishonor of checks issued. We have issued checks, na? They become dishonor. Now what we do? Immediately after knowing the fact of dishonor, we reverse the entry. What is the entry earlier we have recorded? Supplier or creditor account debit to bank. Now we simply reverse it. Earlier bank account credit, now debit. In the books of bank, no entry. Sir, why sir no entry? Bank will record for checks issued for payment only after making payment. But here check is dishonored, na? So that bank did not make any entry. So that for dishonor, no need to record any entry. Next, collection of bills or checks directly on behalf of the account holder. Sometimes we give standing instruction to the bank. Hello, Mr. Bank, you collect some bills or checks on behalf of us. First, who records the entry? Bank will record the entry. Who records the entry? Bank will credit our entry. Bank will credit our entry. Why? Because directly bank collected the bills, na? If you observe in the bills of exchange chapter, we have sent bills to bank for collection. So their bank collected bills. We record. See, first the entry is recorded by bank. After recording by bank, now we also record in our books. When do we record? We record only after receipt of instruction. Receipt of instruction. When we receive the instruction from the bank, hello, see how the bank conveys to you through bank statement or passbook, updating the passbook. Receipt of instruction means in that form only. After receipt of bank statement or updating the passbook, we record the same transaction in our books. If you observe here bank is directly involved in the transaction. Of course, as per our instruction. Who is recording the entry first? Bank. After knowing that, we are recording the entry. Are you able to follow? Next one. Direct payment to the third party on behalf of the account holder. We have given standing instruction to the banker, you pay amount on behalf of us. It is also in the form of withdrawal. But bank is directly making payment on behalf of us. Who record the transaction first? Tell me. Bank records the transaction. It is a withdrawal, na? So bank will debit our account. Whenever bank debits our account, our bank balance gets reduced. Whenever bank credits our account, bank balance will increase. Opposite in the cash book. Whenever we debit bank account, bank balance will increase. Whenever we credit bank account, bank balance will decrease. And this transaction we record only after receipt of some instruction from the bank. In that case, we credit our account. Sorry, bank account. We credit bank account. Next one, dishonor of discounted bills. See, in the bills of exchange and the promissory notes chapter, we discussed dishonor of bill concept. Now, we have discounted a bill. Now that bill becomes dishonored. What is the entry for dishonor of bill? Drawee account debit to bank account. Actually, we record drawee account debit to bank account. So we are crediting bank account. Whereas bank will debit our account now. Bank will debit our account. Why? Because bank is treating it as withdrawal. Bank is charging amount from our account. This transaction also we record only after receipt of instruction from the bank. Means after receiving bank statement or after updating the passbook. Next, bank charges. Observe carefully. Bank charges levied by the bank. Bank is providing so many services to us, like statement services and ATM card services, SMS services, check collection services, check payment services, various services provided by the bank. For the services rendered by the bank will charge some amount. Whenever bank charge amount, they will not call you and ask, hello, we are charging some amount from your account. Is it okay for you? No, directly bank will debit your account. So bank will treat it as withdrawal. This entry we record in our cash book on the credit side when only after receipt of some instruction from the bank in the form of bank statement or updating the passbook. Next one, interest and dividends collected by bank. So it is also the amount collected by the bank directly. So who will record the transaction first? Bank. The amount is collected by bank and it gives credit to our account. After knowing this fact, we record the same entry in our books on the debit side. Okay. Only after receiving instruction from the bank. Next one, interest debited by the bank. Sometimes bank provides overdraft facility. For providing overdraft facility, bank charges interest. Again, bank will never call you and ask for deduction of any amount. That's why bank will treat it as withdrawal. We also record the entry, but only after receiving instruction from the bank in the form of either bank statement or updating the passbook. Here, if you observe, there are ultimately all the transactions are recorded by the bank and also in the cash book. But there is a time gap. But here, what you observe here, there is a time gap first of all, and that means we issued check, and the person to whom we issued check, he has to go to bank and deposit the same. We deposited check, the bank has to collect it the same. Next, there are some transactions took place and directly dealt by the bank. After knowing the fact of either payment or collection of any amount, we are recording in our cash book. Apart from these things, sometimes in our cash book, our cashier may commit some mistake. Suppose instead of writing 50,000 rupees, our cashier may write 5,000. Instead of writing 50,000 rupees, our cashier may write 5,000 rupees. Ultimately, there is a difference in the bank, but bank will record 50,000 correctly. Sometimes bank may do some mistake. So these are nothing but errors. These are nothing but what? Errors. Errors in the cash book and passbook. Now, from the above discussion, we can classify the causes of differences between bank balance as per cash book and passbook into three categories: timing difference, transaction difference, and errors. Is it clear? Yes, sir. Next, our next concept is how to prepare bank reconciliation statement. How to prepare bank reconciliation statement. Observe here, in the examination problem, they give you the causes of difference. Directly. These are the so many causes for the difference of bank balance as per cash book, or causes of differences are not given. Means they give you simply the raw data. Means cash book and passbook. Observe here. They will give you cash book, that means here illustration 1, passbook they have given, and cash book also they have given. Now what you have to do? You have to compare cash book and passbook. And identify the reasons. But in the examination, they don't give you this type of problems. They give you reasons. Reasons like like this. They give you straight away the reasons. With these reasons, you have to prepare bank reconciliation statement. Now, you can observe here, illustration 2 you can observe. From the following particulars, prepare bank reconciliation statement for Jindal Offset Limited. They have given balance as per cash book 2,40,000 and at the same time the balance as per passbook 2,86,950. See, here there is a difference between two balances now. Yes. For this difference, the difference may be due to one reason or the difference may be due to multiple reasons. I repeat, the difference may be due to one reason or the difference may be due to multiple reasons. Right. One of the reason observe, checks issued but not presented in the bank rupees 1,36,000. Like this, they will give you the reasons. These are the causes, students. Because of these causes, there is a difference exists. Next, checks is deposited in bank but not yet cleared. Bank charges amounted to 300. Interest credited by bank amounts to 1,250. Like this, they give you the reasons. With these reasons, we have to prepare BRS. Now, if you observe here, bank charges amounted to 300. Now, you people tell me, who will record the bank charges first? Sir, bank will record the bank charges first. This means there is an entry in the passbook, but there is no entry in the cash book. Next, interest credited by bank amounts to 1,250. What is the meaning of this? Interest credited by bank means the entry for 1,250 is there in the passbook, but not in the cash book. Hope you are following. Means what is the thumb rule here? The major difference between bank balance as per cash book and passbook is only two reasons. One, entry is there in cash book but not in passbook. Second, entry is there in passbook but not in cash book. Yes or no? There is an entry in the cash book but no entry, corresponding entry is not there in the passbook. And there is an entry in the passbook but corresponding entry is not there in the cash book. Or errors simply. Errors may be cash book errors or passbook errors. Observe carefully. Now, in the examination, if they give you the reasons like this directly, or else what you have to do, practically what you have to do, you have to take cash book and passbook separately for the same period. Here they have given for January, here also for January month. Take cash book and passbook for a particular time period and start comparing. Start comparing means I have recorded the transaction in the cash book, whether the same transaction is recorded there in the passbook or not. Next, second one. Compare like this. Second one. Check whether any transaction is there in the passbook, but it is the same is not recorded in the cash book. Check it, compare. At the same time, check any cash book errors or any passbook errors. Like this we compare. See, look at how I compare this. First, look at the cash book. See, cash book debit side. This is cash book debit. This is cash book credit. Cash book debit means deposits. Cash book credit means withdrawal. Passbook directly they have given withdrawal. Withdrawal means debit. Deposits means credit. Cash book debit side. Cash book debit side is compared with the deposits column. Comparison is like this. Cash book debit is compared with the deposits column and cash book credit is compared with the withdrawals column. Then only you get reasons. Now look at here in the cash book first transaction deposited 4 lakhs rupee. Here also there is an entry for 4 lakhs, means same items, no difference. Here we have deposited 35,000 rupees check of Johnson and Co. Check whether the same is collected or not. Yes sir, it is collected. Observe here, we recorded the entry on January 2nd but bank recorded the same entry on 10th. What might be the reason? Means bank has to collect the check. Na? To collect the check, bank will take some time. To collect the check, bank will take some time. Hope you are following. Next one. Here 76,000 worth of check is deposited into bank on January 8th. Check whether it is the same is collected or not. Yes sir, it is collected. But on 15th date. Okay, but in the same period it is collected now. January month. We deposited in the month of January. Bank also collected in the month of January. Same month it is collected. Next one. We deposited 30,000 rupees cash on January 10th. Bank also recorded the transaction. Next one. We deposited 43,000 rupees check of Roy and Brothers. Bank also recorded the same on January 26th. Next one. We deposited 1 lakh 5,000 rupees check received from M. Mohan and Co. But for the same, there is no entry in the cash book. Look at passbook. Look at. There is no entry in the passbook. Means this is the black sheep. This is the black sheep, observe. This is the black sheep. Next one. We deposited 34,000 worth of check, but bank not recorded for the same. Means entry is there in the cash book, but entry is not there in the passbook. Here in the cash book there is an entry, but passbook there is no entry. Okay. Now observe. In the deposits column, there is one entry there only in the passbook. The entry is there only in the passbook, 20,000 rupees. If you observe in the cash book, you are not finding the 20,000 rupees amount debit side. Means the entry is there only in the passbook, but not there in the cash book. Hope you are following. So mark it. So this is also a black sheep. Interest collected on government securities, 20,000. Clear? Now compare the debit side. Cash book credit side, passbook debit side. 60,000 rupees worth of check we have issued. The same is presented in the bank also. 60,000 and 60,000. Next one, we have issued 1 lakh rupee worth of check. In the bank also, the bank recorded the entry on 12th. 1 lakh. Fine. Next, we have issued 1,25,000 rupees worth of check. Bank also recorded the same. Fine. 73,000 worth of check we issued. Bank has not recorded 73,000 rupees worth of check entry. Observe carefully. What is the reason it may be? Actually, we have issued check. We have issued check, but Nagpal and Co. not presented the same check into the bank. Observe carefully. That's why bank not recorded the entry. Next, we have deposited cash. Sorry, we have withdrawn cash 50,000. Bank also recorded withdrawal entry 50,000. Withdrawal entry 50,000. Clear. Next one. We have issued a check to B. Babu and Co. 78,000, but there is no entry in the passbook. Observe. Yes, sir. Right. So this is also a black sheep. Observe. Next, this is balance. This is balance, students. See how much balance we have in the bank. 2,37,000. But whereas in the passbook we have 2,43,000 balance. Okay, sir. Now look at withdrawal column. We have two transactions which are not there in the cash book, but only it is there in the passbook. Observe. What are those two transactions? What are those two transactions? We have paid insurance premium. Means bank paid insurance premium on behalf of us as per standing instruction. And bank also charged bank charges 1,000. These two are not recorded in the cash book. Now, because of these things, how many reasons tell me? 1. Checks deposited but not collected. 2. Checks issued but not presented, 73,000 plus 78,000. 4. Third one. Interest collected by bank but not recorded in the cash book. Fourth one, premium paid as per standing instruction by the bank but not recorded in the cash book. Bank charges charged by bank but not recorded in the cash book. These are the reasons. Yes, sir. Now what we have to do is we have to make a note of all these reasons first. Okay. Out of them, if you observe here, observe the passbook. Earlier we have not recorded these transactions in the cash book. Now you have a chance to record the same transactions in the cash book first. I repeat, earlier you don't know the fact of interest collected by bank. Bank paid premium and bank charges. You don't know. Now you come to know that after comparing cash book and passbook, you come to know that you can do one thing. Record the transaction in the cash book also. Record these transactions in the cash book also first. Yes, sir. Means here the entry is there in the passbook. Now we recorded in the cash book. Now we are recording in the cash book means we are updating the cash book. Now. After identifying the reasons, what we are doing? We are updating the cash book. Towards what? Earlier there is an entry in the cash book, but there is no entry in the cash book. Earlier there is an entry in the passbook, not there in the cash book. Now I am updating the cash book. Updating the cash book. Yes or no? Yes, sir. Now you may ask, sir, earlier we have deposited checks na, sir. You go and ask the bank to give our checks back. Will you ask like that? No, we wait till the bank collect the checks. At the same time, sir, earlier we have issued checks na, sir. Now we ask Nagpal and Babu, return the checks. No, we will not ask. We will wait till its presentment to the bank. Means these things are not updated in the cash book. So here you have two options. One, we have identified total 1, 2, 3, 4, 5 causes. If you prepare bank reconciliation statement with all these causes, you can prepare bank reconciliation statement with these causes. Or else, second option, first I will update the cash book. During the updation of cash book, these entries I am now recording in the cash book. Means now the reasons are only two things. One, check deposited but not collected. Checks issued but not presented. Sir, why this transaction now I have updated in the cash book now? Yes, sir. Means you have two options. One, without updating the cash book, you prepare BRS. Second option, first you update the cash book. Then after you prepare the BRS. Two options are there. During the year, you can choose any option. During the year, suppose I am in the year 2023, 2024, 25 financial year. 2024-25 financial year. Generally, bank reconciliation is prepared every month. For every month, BRS is prepared. During the year, you have an option whether you can prepare BRS without updating the cash book or by updating the cash book. But at the end of the month means 31st March 2025. Recently we have completed our financial year now. Yes, sir. So as on this date, you don't have two options, only one option. What is that? Update the cash book first. Then after you prepare BRS. That's it. Only this option. You don't have any other option. Clear? Means we can prepare BRS in two ways. One, reconciliation without adjusting cash book, and reconciliation after adjusting the cash book. In the examination, we may get any type of problem. In the examination, we may get any type of problem. Even if they don't give you any reasons, what is the one step will increase? What is that? You have to identify the reasons. That's it. One step will increase. After that, you have the reasons. Now, same steps will be followed. You can either without updating the cash book, you prepare BRS, or after updating the cash book, you prepare BRS. It is up to you. Right. Now come to BRS preparation formats. What we do is, we may follow either balance presentation or plus and minus presentation. But most of the problems we follow balance presentation. Now, we have important task. How to prepare BRS? Here we have seen types of problems and the format. The next question comes, how to prepare BRS. Now we are ready with what? I am ready with either cash book or passbook balance. I have cash book and passbook balance, and I know the reasons, causes or reasons I know. I have two options. One, update cash book and prepare BRS. Second one, without updating cash book, prepare BRS. Yes or no? I can prepare in two presentation. One is balance presentation. Another one is plus and minus presentation. Now the next concept comes, how to prepare. We did not discuss till now how to prepare the BRS. We discussed only these things. Now we discuss about how to prepare BRS. I will explain one transaction, one cost, how this is presented in the BRS. Next things you have to follow the same. Believe me students, you can get easily 5 to 10 marks. Are you ready? Yes sir. Move forward. Now we discuss one example to understand how the BRS problems to be solved. Let us take cash book and passbook. Here I am taking cash book opening balance as 1 lakh debit balance. Cash book debit balance means this is favorable balance. First time we assume, when the cash book is showing debit balance, automatically the passbook shows credit balance. This is our assumption. When cash book is showing debit balance, passbook shows credit balance. Opposite, na? Passbook shows credit balance. Opposite. Same amount. We have discussed the same in this example. Look at bank balance as per cash book, 50,000 debit. Bank balance as per passbook, 50,000 credit. Okay. Now look at. Okay sir. Now here I have taken one transaction. That transaction is check deposited into bank. So what is the entry we record? The entry is recorded in cash book as well as in the passbook. Who will record this transaction first? In the cash book. Why? Because we are depositing check. Na? What is the entry we record? Simply bank account debit to debtor account or customer account, whoever it may be, the person who has given check. Or if we receive the same check for income purpose, that income account credit. Anyway, bank account is debited now. So on the debit side, simply I have written to check deposit 50,000. The same entry is recorded by the bank on the credit side. The same entry is recorded by the bank on the credit side only when it is collected the check. This concept we know now. Only when it is collected the check, then only it is recorded by the banker. Okay, sir. But here bank did not collect the check. Bank did not collect the check till the preparation of BRS date. Assume the BRS we are preparing on 31st March 2025. We deposited check on 26th March. On 26th March. This date we take 1st March. This is also 1st March. Fine. We take like this. First March. Okay, fine. Right, sir. Now, observe. As per cash book, how much balance you have? Tell me. Balance cash book and passbook. As per cash book, the balance is 1.5 lakh. As per cash book, the balance is 1.5 lakh. By balance C by D, 1,50,000. Whereas, as per passbook, the balance is how much? Tell me. The balance is 1 lakh. To balance carried down 1 lakh. Fine, everybody. But observe here. Cash book is showing 1.5 lakh favorable balance, whereas passbook is showing 1 lakh favorable balance. There is a difference of 50,000 rupees balance. There is a difference of 50,000 rupees balance. Now observe cash book and passbook and tell me what is the reason. The reason is simple, sir. We deposited checks. The same check is recorded in the cash book, but bank did not collect the same. That's why bank not recorded the entry. Now how do we prepare BRS with this? Means first heading is important. Bank reconciliation statement of so and so business. Bank reconciliation statement of so and so business as on so and so date. So and so date means the BRS preparation date. BRS preparation date. Here you have cash book balance as well as passbook balance. You take one book balance. So here I am starting with 1.5 lakh. This is called starting point. This is called starting point. Now you people tell me the starting point may be either cash book or passbook. Practically you have two book balances, but in the examination they may give you only one book balance. In that case you don't have any choice. Okay, and you ultimately get which book balance? Other book balance. If you start with cash book, you get passbook balance. If you start with passbook, you get cash book balance. And this is called ending point or target. This is our target. This is our target. Hope you are following. Yes, sir. Now observe here. What is the reason? Tell me. Check deposited but not collected. Check deposited but not collected. Okay. You people write down like this. A small working note to be prepared. That is cash book and passbook. You simply write like this. Cash book and passbook. See the reason. The reason is check deposited into bank but not collected. You people tell me who recorded this transaction first? Cash book. Which side is it is recorded? Debit side. By recording it on the debit side, cash book balance increase or decrease? Sir, cash book balance will increase, sir. Cash book balance has increased. When cash book balance is increased, automatically the passbook balance is decreases. Because of this transaction, because of this 50,000 rupees transaction, cash book balance increase, but passbook balance not increased. Na means if you observe the cash book and passbook, compare to cash book, passbook balance is less by 50,000. I repeat, compare to cash book, the passbook balance is less by how much? 50,000 rupees. By how much? 50,000 rupees. Like this, each cause, like this, each cause is each cause effect seen like this. This is the first one. So in the examination, suppose if you get 10 causes, 10 causes you have to observe like this. 10 causes you have to observe like this. Very, very important. Yes, sir. I have completed observation like this. So what is the first step? Check in which book it is recorded. Second, in which side it is recorded. Third, because of this, what is the effect on balance, cash book and passbook? Sir, cash book increases, sir. So upward symbol. Cash passbook decrease, sir. Downward symbol, arrows. Yes, sir. Finally, after completion of each transaction, which book balance you started with? Sir, we started with cash book balance, sir. Yes, sir, no? Yes, sir. Now, when you start with cash book balance, which book balance you get? Sir, I get passbook balance, sir. Just tick on that. Which book balance we need? Passbook balance, sir. Or else simply make a box on it. Sir, we need passbook balance, sir. Very good students. Sir, I need passbook balance. Yes. Now, upward arrow means plus. Upward arrow means plus. Downward arrow means minus. Here passbook is showing downward arrow. So what I will do is minus. This means we started with cash book. You do one thing. From cash book balance, if you deduct this 50,000 rupees, you get ultimately the passbook balance. Tell me. Less. Observe carefully. If you can understand one thing now, then you can understand the remaining things easily. Checks deposited. Write down the reason also. Checks deposited but not collected. Checks deposited but not collected. Over. Now tell me how much amount you are getting. From 1.5 lakh, I am deducting 50,000 rupees and ultimately I am getting the passbook balance. Now you can understand why we are deducting and why we are adding. I already said the difference of cash book and passbook balance, bank balance as per cash book and passbook, maybe because of one reason or multiple reasons. And it is not possible to see multiple reasons effect on cash book and passbook, so that we are taking one point. By taking one point, here we are preparing a small working note. This working note is very important, students. This working note is very, very important. This working note is very, very important. For every problem, you people try to prepare this working note. It is not part of your answer, but for our convenience, we are preparing this. You can do one thing. The same working note can be prepared at the end of your booklet. You can just write down rough work and you prepare this. Based on this, you can assign the symbols and which book balance you need? Passbook. Follow the passbook symbols. Plus, add, minus, deduct. Ultimately, if you do all the calculation, finally you get the passbook balance. Here we have second book balance now. So how much is the second book balance? 1 lakh. Here also we got the answer 1 lakh, so that our answer is correct. But in the examination problems, you may have only one book balance. You may have only one book balance. So it is not possible to check whether the answer is correct or not. For that purpose, you have to check the problem once again. Just check the problem within 1 minute. That's it. Our problem of BRS completed. If you prepare the BRS like this, then whatever the problem it is, however the problem it is, that becomes very, 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 very simple. Now, based on this concept and based on the theory which we have explained, which we understood, now we try to solve the problems. I already said we can do two types of problems. One, before updating cash book, we prepare BRS. Second one, after updating cash book, we prepare BRS. Clear? So during the year, if you are preparing BRS, means you have two options, option 1, option 2. But at the end of the year, sir, how can we check, sir? Simple. Check in the problem that whether the given date is 31st March or sometimes 31st December also they give you. Sometimes 31st December also they give you. In that case, you have two options. Assume that as on the given date, I repeat, as on the given date, if you assume the books of accounts are closed, then what you can do, you can update the cash book and then prepare BRS. Update the cash book, prepare BRS. After updating the cash book, the number of causes gets reduced. Na? After updating the cash book, the number of causes gets reduced. Before updating cash book, the number of causes are more. Once after updated, the number of causes gets reduced. So if you get these dates 31st March or 31st December, you can write clear assumption. You have to write clear assumption. Here it is assumed that the books of accounts are closed on this date. Accordingly, adjusted cash book or updated cash book is prepared. Adjusted cash book or updated cash book or amended cash book is prepared. First prepare updated cash book, then after you prepare BRS. First one, update the cash book. Second one, prepare BRS. Or if you assume that the books of accounts are not closed, then straight away prepare BRS. Then straight away prepare BRS. Up to you. Now we try to solve problems on direct preparation of BRS and after updating the cash book and preparation of BRS. These two types of problems we see. Now next question comes, sir, which format we have to follow, sir? There are two formats, na, sir. Yes. One is balance presentation. Second one is plus and minus presentation. If specifically, suppose nothing is mentioned, which presentation to follow? Follow balance presentation. Most probably 99.99% we follow balance presentation. If they specifically ask prepare plus and minus presentation, if they specifically ask prepare plus and minus presentation, then follow the same. Is it clear, students? Right. So hope you are following. Now we try to solve the problems. Look at. Now we try to solve some problems on the concept of BRS. We already understood how the problems of BRS are solved. Now we apply the same knowledge to various illustration problems. If you observe, in the illustration problem 1, we have identified 5 reasons. Na? Checks deposited but not collected, checks issued but not presented for payment. Next, interest amount collected by bank on government securities but not recorded in the cash book. At the same time, premium paid as per standing instruction not recorded in the cash book, and bank charges charged by bank but not recorded in the cash book. These are the various reasons which we have identified. Now what we do? We prepare this simple working note. First write down cash book and passbook. Here you have two book balances. Now, as per passbook, what is your balance? 2,43,000. As per cash book, what is your balance? 2,37,000. We start with either one book balance. So here we are starting with the balance as per passbook 2,43,000, or you may start with the balance as per cash book. Now look at one by one reasons. So first one, checks deposited but not collected. Who recorded this transaction first? Cash book. So by recording this transaction, our cash balance increased now. So cash book increase, whereas passbook decrease. How much, sir? 1,05,000 plus 34,000. Next one, checks issued but not presented. Who recorded this transaction first? In the cash book, sir. By recording this transaction in cash book balance gets decreased. So cash book balance decreased, whereas passbook balance increased. Sorry, this one. Cash book balance decreased, passbook balance increased. How much? 73,000 and 78,000. Next one. Here, interest collected by bank but not recorded in the passbook, sorry, cash book. Who recorded this transaction first? In the passbook, bank recorded the transaction. By recording this transaction by the bank balance increased na? Bank balance increased by 20,000, whereas cash balance decreased by 20,000. Next, premium paid by the bank as per standing instruction. Who recorded this transaction first? Passbook. So in the passbook, in which column it is recorded? Withdrawal column. Anything recorded in the withdrawal column reduces our bank balance. So here bank balance as per passbook gets reduced. But this transaction is not recorded in the cash book now. So cash book balance shows increase. How much? 25,000. Same in the case of bank charges also. Bank charges, who recorded first? Passbook. So passbook balance gets reduced. When passbook balance gets reduced, cash book balance not reduced. That's it. Over. Our working note is completed. Right. Now we started with the which book balance? Passbook balance. So which balance we need? Cash book. Cash book balance we need. This is our target. Passbook is starting point. Now cash book assign the symbols. Upward arrow means plus, downward arrow means minus. So all plus items write down in one place. All minus items write down in one place. After writing, see, you have to write the reason also. Right. These are the plus items. After writing plus items, add total. All less items write down in one place and total it. 1,71,000 minus and 2,37,000 is our cash book balance. Very simple process. Yes, sir. Now next look at illustration 2. This is also very simple problem. From the following particulars, prepare bank reconciliation statement. Yeah, one more thing. If you take balance as per cash book as starting point, then you get passbook as a target. In that case, whatever the items we have deducted now, they becomes add. Why? Because we are taking cash book first. So the items which we have reduced earlier, that becomes add, and whatever the items we have added earlier, that becomes less. Okay. So it's all depend on our working note. Now look at illustration 2. From the following particulars, prepare a bank reconciliation statement for Jindal Offset Limited. Balance as per cash book 2,40,000. Checks issued but not presented in the bank 1,36,000. And at the end, if you observe the balance as per passbook, 2,86,950. Here also they have given two book balances, cash book balance and passbook balance. You may start. Illustration 1 we started with passbook balance. Now this problem we start with the cash book balance. Observe, cash book balance 2,40,000. And do prepare working note for this problem also like this. Look at what is the first reason. The checks issued but not presented in the bank rupees 1,36,000. Who record this transaction? In the cash book we record this transaction. Which side? Credit side. Why? Because it is issued na, check issued, credit side. When you record anything on the credit side, our cash bank balance gets reduced na. So as per cash book, our balance gets reduced, but the same is not recorded in the passbook, so that our balance gets increased by how much? 1,36,000. Next one, checks deposited in the bank but not yet cleared 90,000. This transaction first recorded in the cash book. Which side? Debit side. By recording it on the debit side, our cash book balance gets increased by how much? 90,000. Whereas passbook balance gets decreased. Next, bank charges amounted to 300. Who records this transaction first? In the passbook. Which side? Withdrawal column. So that our passbook balance gets reduced. Our passbook balance gets reduced by how much? 300. When you look at cash book, our cash book balance shows more amount. Next, interest credited by bank amounted to 1,250. Who recorded this transaction first? In the passbook. Which column? Here interest credited. Interest credited means bank has allowed interest to us. So it is recorded in the deposits column. When anything is recorded in the deposits column, our bank balance gets increased. So as per passbook, our balance increase, but as per cash book, our balance gets decreased. Now we started with which book balance? Cash book balance. We started with cash book balance. We started with cash book balance. Now which book balance you need? You need passbook balance. Make a box on that. Follow the passbook symbols. Upward arrow means plus, downward arrow minus, downward arrow minus, plus. All plus items write down in one place and total it. All minus items write down in one place and total it. Finally, whatever the amount we get, that is our passbook balance. Here if you observe, here we have started with the favorable balance as per cash book. If you get any negative amount here, finally that becomes unfavorable balance as per other book. I repeat, observe carefully. Here we started with the favorable balance as per cash book. If we get anything negative here as our final answer, negative means unfavorable. Yes, sir. So in that case, it becomes unfavorable balance as per passbook. This is very, very important. If you start anything negative here, negative as starting point, but at the end if you get a positive amount, In that case, it becomes favorable balance. In that case, it becomes favorable balance. Do remember, everyone. Clear? This is our illustration 2. Next, look at illustration 4. From the following particulars, ascertain the balance that would appear in the bank passbook as of A on 31st December 2022. Here they are asking how much balance will have in the passbook. Means whatever the target we find out, that is nothing but other book balance. Here they are asking bank passbook, means they give you cash book balance. Okay, 31st December. Observe, the bank overdraft as per cash book on 31st December is 6,314. Very important, student. Illustration 1 and 2 are on the concept of favorable balance. Now in this problem, they are giving bank overdraft, but our procedure is same. When you have favorable balance, you have in mind, okay, my favorable balance increase, my favorable balance decrease. But here you have overdraft. Now in that case, you have to think that overdraft increase, overdraft decrease. Because of this transaction, overdraft increase. Because of this transaction, overdraft decrease. In that manner, you have to think. Now, already how much overdraft we have? 6,340. Observe here. Overdraft as per cash book 6,340. This is actually unfavorable. This is actually unfavorable. But here the amount is taken as plus amount. Normally, unfavorable means the amount we have to kept in brackets. But here the amount is not kept in brackets. Here overdraft, to increase the overdraft, what we have to do? We have to add the items. To decrease the overdraft, what we have to do? We have to decrease the items. Finally, here if you get any negative amount, then it becomes favorable balance. I repeat, finally if you get any negative amount here, you get unfavorable balance. Why, sir? Here you have taken, actually it is unfavorable, but you have taken as plus amount. Unfavorable means you have to take like this now, but here we are not taking negative amount. Here we are taking positive amount. At the end, if you get any negative amount, it becomes favorable. Very important problem in this point. Right. Look at now one by one. Interest on overdraft for 6 months ending 31st December 2022, 160 is entered in the passbook. Now tell me, the working note prepared is like this. Already we have overdraft in the bank now. In the bank, this transaction is recorded by the bank first. Which side? Withdrawal column. Already we have overdraft. Don't forget this. Already we have overdraft. By recording this transaction in the passbook withdrawal column, our overdraft balance will increase. Our overdraft balance will increase. In this, like this, you have to think. So overdraft balance will increase by how much? 160. Whereas cash book overdraft balance gets decreased. Hope you are following. Next one. Bank charges 400 are debited in the passbook only. Bank charges 400 are debited in the passbook only. Means bank recorded this transaction. It is bank charges now. Already we have overdraft. Again the 400 rupees is written in the withdrawal column. So our overdraft balance will increase. Our overdraft balance will increase by 400, whereas cash book overdraft will not increase. It is decreased. Next, checks issued but not cashed prior to 31st December amounted to 11,68,000. Checks issued. We are issuing check. Who records this transaction first? In the cash book. Which side? Credit side. Already we have overdraft. Overdraft means cash credit balance. As per cash book, overdraft means what? Credit balance. Again we are issuing checks. So our overdraft will get increased. Our overdraft gets increased. So as per cash book, overdraft increase. But bank has not paid this amount now. Bank has not paid this amount. If bank also pays this check amount, then as per cash passbook also our overdraft gets increased. But bank not paid. So that as per passbook, overdraft gets decreased. Simple logic. Next one. Checks paid into bank. Checks paid into banks means checks deposited into bank but not cleared before 31st December were 22,17,000. Checks deposited. Checks deposited means in the cash book, which side we record? Debit side. Already we have overdraft facility. Yes, sir. Sorry, overdraft balance. If anything is recorded on the debit side, if it is favorable, favorable balance increase. If it is unfavorable, unfavorable balance decrease. Suppose if I have 50 lakh rupee overdraft, 50 lakh rupee overdraft in the bank. Now I am depositing 22 lakh 17,000 rupees check. What happens here? My overdraft balance gets decreased. Yes or no? Yes, sir. So as per cash book, your overdraft balance gets decreased as per cash book. But as per passbook, checks not collected now. If checks collected by the bank, then as per passbook also our overdraft gets decreased. But checks not collected, so that as per passbook our overdraft gets increased. Next, interest on investments collected by the bank and credited in the passbook 12 lakhs. Interest on investments collected by the bank. Who records this transaction? Passbook. Which column? Withdrawal or deposit column? Deposit column. Already what you have in the passbook? Overdraft. Overdraft balance you have, and this transaction is recorded in the deposit column. So as per passbook our overdraft gets decreased. But look at, as per passbook our overdraft gets decreased, but it is not recorded in the cash book, so that in the cash book overdraft gets increased. Important. Now which book balance you need? Already we started with cash book unfavorable balance. You need passbook balance, so make a box on the passbook. Now follow passbook symbols. Upward arrow plus, downward arrow minus. So all add items. See here, add items means what? Overdraft we are increasing. See, for 6,000 to 6,340 we are adding items, means for 6,340 we are adding items, means we are increasing overdraft. We are deducting items, means we are decreasing overdraft. Look at, after adding items, what is your overdraft? 22,23,900. Whereas overdraft decreased by 23 lakhs 68,000. Here we got negative balance, means favorable. Means favorable. Favorable balance as per cash book. This is our balance presentation overdraft problem. Remaining all reasons are same. Overdraft, overdraft. Because of this overdraft balance increase, because of this overdraft balance decrease. Now the same problem we solve in plus and minus presentation. Under plus and minus presentation, the format is like this. Format is simple. Particulars, same 3 column statement format. Particulars, plus amount, minus amount. Plus amount, minus amount. Here, if it is favorable balance, we write the amount in plus amount column. If it is overdraft balance, then we write the amount in minus amount column. Now, if you want to increase the overdraft, then everything is written on the minus amount column, because minus minus plus na. If you want to reduce overdraft, then the amount is written in the plus amount column. Plus amount column. Is it clear, students? Yes, sir. Now here you can observe 160 rupees increase means passbook overdraft gets increased. So 160 add. Next 400 rupees overdraft increase. So 400 also add in the minus amount column. Look at minus amount column. 400. Next see, the working note is same. After doing this working note, now your wish, if you want to present this information in balance presentation like this, or plus and minus presentation like this. Next 11,68,000 overdraft decrease. See, to decrease overdraft, already it has minus amount more now. Now we have to decrease, so the amount is written in the plus amount column. 11,68,000. Next 22,17,000 rupees overdraft we have to increase. Increase means write down in the minus amount column. 22,17,000. Next one, 12 lakhs rupees overdraft we have to decrease. 12 lakhs rupees overdraft we have to decrease. Already we have minus amount. To decrease means write down the amount in plus amount column. After writing the amounts, next total it. Total it. Total plus amount 23,68,000. Plus amount means favorable. Minus amount means unfavorable. Plus amount 23,68,000. Whereas minus amount total 22,23,900. Plus amount is more. By how much it is more? By 1,44,100 more. By 1,44,100 more. Then it becomes our favorable balance. Balance as per passbook See, you know ledger balancing, ledger account balancing. In that case, the debit balance is shown first on the credit side by balance C by D. Next, when we bring it to the next period, we write it as to balance B by D. This is also same. Just to total the columns, to make the total columns equal, what we are doing is the debit amount, that is the plus amount column, by how much it is more, 1,44,100, that is written in the minus amount column. Don't take it in a wrong manner. Sir, we are writing the amount in minus amount column na sir, so it becomes a negative amount sir, so it is unfavorable balance as per passbook sir. No. First check which column total is more. Plus amount column total is more. By how much it is more? 1,44,100 more. Plus amount more means favorable balance. Minus amount more means unfavorable balance. But to equal the columns, we are writing the balance amount in the lesser amount column. That's it. This is our plus and minus presentation. I already said 99.99% we follow balance presentation like this. If it is specifically asked in the problem, then you follow plus and minus presentation. Next, look at illustration 5. Illustration 5 is after updating the cash book. After updating the cash book, then we start preparing BRS. Before this, let me discuss one small concept here. Yeah, observe here. So here we have two methods of preparing BRS problem. One is before updating or without updating cash book. Without updating cash book, we start our preparation of BRS. Till now, whatever the problems we have solved, they comes under this process, first process. Now second process is what? First we update. We update. After updating means first we update, first we update cash book. Second step we prepare BRS. Means here you have to do two things. First you prepare updated cash book. Then after you prepare BRS. Two things. Without updating cash book or before updating cash book means only one thing, that is BRS. Okay. Now, sir, which causes are updated or which transactions or which reasons are updated in the cash book and which are not updated in the cash book? So you have to keep these things in your mind. Tell me the major differences between bank balance as per cash book and passbook. Tell me. One is timing differences. Timing differences are always taken to the BRS. It is not possible to update them in the cash book. Why, sir? Timing differences means only two things. One, check deposited but not collected. Checks issued but not presented. Already these checks are out of our control. We deposited into bank. Now the checks are in bank. We have issued checks. The checks are in the hands of supplier or creditor, whoever it may be. Unless you know the fact of dishonor of check, it is not possible to take the reverse of the checks. That's why all timing differences are taken to the BRS. So read the problem. If any cause or transaction is timing difference, then directly you can take it to the BRS. Next one, transaction difference. Transaction difference means what? Some transactions are recorded in the passbook, but the same are not recorded in the cash book, like interest credited by the bank charges debited by the bank, or insurance premium paid by the bank. All these are what? Various transactions appears in the passbook only, but not recorded in the cash book. Earlier you don't know this. Now you come to know that. Record all the transactions into the cash book. Update in the cash book. Record all these transactions in the cash book. Now the same transactions or same causes, you need not to take it to the BRS. Why? Earlier entry is there in the passbook. Now the same is recorded in the cash book. You need not to write the same again. Next, cash book errors. All cash book errors now you can rectify. All cash book errors now you can rectify easily. Yes, sir. Once all cash book errors are rectified, again you need not to take them to the BRS. Again, you need not to take them to the BRS concept. Hope you are following. Next, passbook errors. Who committed passbook errors? Cashier of bank. Now, is it possible to rectify these passbook errors by you? Not possible. Who has to rectify? Banker. So that all passbook errors are taken to the BRS. Like, bank wrongly credited our account, or bank wrongly debited our account, our bank has wrongly debited. Suppose instead of writing 1500 rupees, bank has written 1005 rupees. Yes, banker also may commit some mistakes. Finally, if you observe the timing differences and the passbook errors only taken to the BRS, remaining all can be adjusted or updated in the cash book. If you can understand this concept now our concept becomes very simple. Look at, so here they have given 7 causes. Here they have given 7 causes. Look at 7 causes they have given. 7. All these 7 causes, suppose if the first method is followed, all 7 causes are taken to the BRS. But now we are following second method. First we update cash book. Then after we prepare BRS. In that case, the number of causes gets reduced. So which items are taken to the updated cash book and which items are taken to the BRS? Now you have to decide. Look at first. On 30th September 2022, the bank account of X according to the bank column of the cash book, was overdrawn. Overdrawn means overdraft to the extent of 4062. So if you look at the cash book, it is showing credit balance, means by balance C by D. Sorry, by balance B by D 4062. First what we do is we prepare updated cash book. Look at here. We prepare updated cash book or amended cash book. It is showing credit balance. By balance brought down 4062. By balance brought down 4062. You can check it. Next. Now read one by one. If it is possible to adjust, then we adjust in the or update in the cash book. Otherwise, we take it to the BRS. On the same date, the bank statement showed a credit balance. See, bank statement is showing credit balance, means favorable balance. As per cash book, it is showing unfavorable, but as per passbook, it is showing favorable balance in favor of X. An examination of the cash book and passbook bank statement reveals the following. Now look at one by one. A check for 13,14,000 deposited on 29th September was credited by the bank on 3rd October. Actually, we deposited on 29th September, but bank credited the same on 3rd October. Observe on which date we are preparing BRS, on 30th September. So if you see, compare cash book and passbook for 30th September, this transaction is there in the cash book but not there in the passbook. Means there is a difference, and this is a timing difference now. This is a timing difference. Timing differences are taken to the BRS directly. Now tell me, already in the cash book what we have? Overdraft. We have in the cash book overdraft. So by recording this transaction, our overdraft balance gets reduced. But don't think like this. Why? Why? Because this problem is on the concept of amended cash book or updated cash book. Here they have given 4062 rupees is overdraft. Very good. But after updating that some transaction, the balance of overdraft may be increased, or the balance of overdraft may be decreased, or sometimes it becomes favorable balance also. That's why don't start comparing now. So first of all, it is taken to the BRS directly. First one is taken to the BRS directly. Clear? Yes sir. First one, take it to the BRS. Second one, observe. A payment by check for 16,000 has been entered twice in the cash book. A payment by a check for 16,000 has been entered twice in the cash book. Payment means we have paid amount. It is recorded on the credit side, but it is recorded two times on the credit side. It is cash book error. It is cash book error. How can we rectify? Simple. Credit side 2 times recorded. You write now 1 time on the debit side. You write it 1 time on the debit side so that the error gets rectified. See, one time on the credit side 16,000. Here you can write the reason. Hope you are following. Next one. So now this is not taken to the BRS. I will do one thing. This is taken to the BRS and this is not taken to the BRS now. Okay. Why? Because already it is rectified now. Next one. On 29th September 2022, the bank credited an amount of 1,17,400 received from a customer of X, but the advice was not received by X until 1st October 2022. Who is X? We are the X because we are the business owner. Our customer, this is nothing but our customer directly deposited amount into bank. Our customer directly deposited amount into bank. So our bank balance increases now. The same transaction is not recorded in the cash book. Now you come to know that record it in the cash book, so that this is also not taken to the BRS. This is updated in the cash book now. It is like receipt for us. It is recorded on the debit side. See, to customer account 1,17,400. Okay, next one. Bank charges amounting to 580 had not been entered in the cash book. Means this transaction is there in the passbook only earlier. Now we are going to record it in the cash book. So again, this is also not taken to the BRS. Clear? Bank charges na, which side of cash book we write? Credit side, 580 rupees by bank charges, 580. Look at, by bank charges, 580. Hope you are following. Next one. On 6th September 2022, the bank credited 20,000 to X in error. If you observe passbook, bank has credited 20,000 rupees by error. It is passbook error. Is it possible to rectify by you? Not possible. So straight away take it to the BRS. Straight away take it to the BRS. Clear? Straight away take it to the BRS. That's it. Sir, what we do in the BRS, that we discuss. First, let us update the cash book first. Next, sixth one, observe. Sixth one, a bill of exchange for 1,40,000 was discounted. Earlier we discounted by X with his bank. This bill was dishonored on 28th September, but no entry had been recorded in the books of X. Means already we have discounted. Now on 28th September, the bill dishonored. Means the bank will reduce our account balance. Normally, what is the entry for a discount? This dishonor of bill? Drawee account debit to bank account. In the passbook, already entry is recorded. Earlier, you don't know this. Now you come to know that. First, update this in the passbook. Sorry, cash book, so that you need not to take it to the PRS. 1,40,000 payment. So record it on the credit side by customer account. On the credit side, 1,40,000 over updated. Again, you need not to take this 1,40,000 to BRS. Next one. Checks issued up to 30th September but not presented for payment up to that date total 13,26,000. Already checks issued. It is a timing difference. Timing differences are all taken to the BRS. So if you observe, out of 7 causes, only 3 causes are taken to the BRS. Remaining 4 causes are updated in the cash book. Now calculate updated cash book balance. Here they have given 4,062 rupees cash book overdraft, but now we are updating cash book. The overdraft may be increased, the overdraft may be decreased, or sometimes the overdraft may become favorable also. Total credit is 1,44,642 minus total debit. We are getting 11,242 rupees difference. Means tell me, overdraft increased or overdraft decreased? Sir, overdraft increased, sir. Now you start BRS with this balance. Look at bank reconciliation statement as on 30th September. Overdraft as per cash book, amended cash book, 11,242. And observe remaining causes. Here checks deposited na, already we have in the cash book overdraft balance. Checks deposited means our overdraft gets reduced. So cash book overdraft gets, sorry, check for 13 lakh 14,000. Yeah, just a minute. 13 lakh 14,000. Yes, our overdraft, here I will write. Actually, this is another concept. Cash book, passbook. We are starting with the cash book. So our overdraft balance will decrease. Overdraft balance will decrease. Whereas passbook overdraft increase 13 lakh 14,000. Next one, 6th September bank credited 20,000 to X. Means it is recorded in the passbook. It is recorded in the passbook. So our overdraft gets decreased. Our overdraft gets decreased by how much? 20,000. Whereas overdraft increase in the cash book. Next one, a bill of exchange over. Last one, checks issued. We issued checks now. So already we have overdraft. By issuing checks, our as per our cash book, overdraft increase 13 lakh 26,000. Whereas passbook overdraft decrease. That's it. Which book balance you need, sir? We need passbook balance, sir. Okay. Follow the passbook symbol. Tell me. Upward arrow means plus. Downward arrow means minus. Here minus. Add point 13 lakh 14,000. Add 13 lakh 14,000. We get 13 lakh 25,242. Minus amounts, two amounts, 20,000 and 13 lakh 26,000 minus. So here we have started with the unfavorable or overdraft, but the amount is positive. The amount is positive, but here finally we got negative amount, means favorable balance or credit balance as per bank statement 20,758. Actually, this is also correct. This is also correct, but I have explained in a different manner. But to avoid all confusions, you follow the same approach. This approach only. Okay, that's it. This is adjusted cash book or updated cash book or amended cash book. When do we follow this updated cash book or amended cash book? I have already discussed. That's it, students. Same concept you apply to n number of problems. This working note is very, very important. This concept you apply to n number of problems. N number of problems. Finally, all add points add, all less points less. That's it. Now we start our discussion with the rectification of errors. Rectification of errors. Look at. Hello students, how are you all? I hope you are doing well. In the previous lecture, we have completed bank reconciliation statement. That is where bank reconciliation statement chapter is very, very important from examination point of view. Now we discuss another important chapter from examination point of view, that is rectification of errors. This chapter is very, very important, not only from examination point of view, but also from practical point of view also. You may ask, sir, what is the importance of this chapter and why should we learn this chapter? To discuss that, let us start our discussion with accounting cycle. Sir, why are you telling accounting cycle for every chapter? Why? Because by looking this accounting cycle, you can understand the concept, what we are learning. Whether with the concept which we are learning is part of accounting cycle or what it is. We understood bills of exchange. Bills of exchange is a transaction. Bills of exchange is a transaction. There we understood how the transaction is recorded in the journal. And bank reconciliation statement is a technique. Why we are learning that technique? When the bank balance as per cash book and passbook is not equal, then we have to reconcile the cash book and passbook, and we prepare a statement by showing the causes for the difference between bank balance as per cash book and passbook. That statement is nothing but bank reconciliation statement. There we have learned how this bank reconciliation statement is prepared. Now the chapter which we are going to discuss is rectification of errors. Now tell me, is this a part of our accounting cycle? The answer is no. Then why we are learning, sir? Observe carefully. Our accounting cycle starts with identifying the transaction. The identified transactions are recorded in the journal. After recording the transactions in the journal, immediately we post them into ledger. After posting, we do some clerical work here. What is that? We casting of ledger accounts and balancing of ledger account. These two things we do in the ledger: posting, casting, and balancing. After balancing all the ledger accounts, now all these balances are brought to trial balance to check the arithmetical accuracy. After preparing the trial balance, the next step is to prepare financial statements or final accounts. Final accounts or financial statements consist of income statement as well as position statement. Income statement can be classified as trading account and profit and loss account. This is our accounting cycle. Now tell me, total accounting process we have divided into two steps. One is bookkeeping, another one is accounting. Bookkeeping means nothing but maintaining books of accounts. Look at recording in the journal, posting into ledger, and preparation of trial balance. These three comes under bookkeeping process. Now, during the bookkeeping process, if the bookkeeper may be any person who maintains these books of accounts, nothing but subsidiary books including cash book. So the bookkeeper, during the process of bookkeeping, if the bookkeeper commits any mistake, see, who maintains books of accounts? Human beings tendency is not there to commit some mistakes. So during the process of bookkeeping, you may ask, sir, nowadays we are using computers to maintain the books of accounts, na sir? Yes, very good. But who is giving input to that computer? Human being. So wherever a human being is involved, there may be chances of committing mistakes. In the same manner, during the process of bookkeeping, if the bookkeeper commits any mistake, then how do we rectify that? That this chapter deals with that. During the process of bookkeeping, if the bookkeeper commits any mistake, then how we are going to rectify? You may ask, sir, what happened, sir? A mistake is happened, na sir. A mistake is mistake. Leave it, na sir. Forget about that. No, it is not possible. Whenever any, see, our accounting aims to ascertain true financial position, at the same time to calculate true performance of the business, profit or loss of the business. If we commit some mistakes in the bookkeeping process, then compulsorily we have to rectify it. In this chapter, we understand two aspects here. One, well, first we identify the mistakes and identifying and locating the errors. First of all, we should identify where the mistake is happened, in which stage it is happened, whether the mistake is happened during the process of journal, or whether the mistake is happened during the process of posting, casting, or balancing. I repeat, whether the mistake is happened during the process of recording the transaction in subsidiary books including cash book, and whether the mistake is happened during the process of posting the transaction from subsidiary books to ledger, at the same time casting or balancing. And is there any mistake happened during the preparation of trial balance? We should locate in which stage, or in which where, in which process the mistake is happened, that we need to identify and locate. After locating, the next step is rectification of errors. Only two aspects we cover in this chapter. First we locate the errors, after that we rectify the errors. Anyway, here we are not going to locate any errors. Why? Because already in the examination problems, they give you the identified error. Already they locate the errors and they give you, these are the errors happened or mistakes happened. Now you have to rectify them. So straight away we go to rectification of errors. Before understanding how the errors gets rectified, let us discuss first of all, how can we know that there are errors in the bookkeeping process? How can you not? Will you close your eyes and will you visualize, there are some errors, there are some mistakes in the recording or posting or preparation of trial balance. Will you visualize like that? No, it is not possible. After completion of recording and posting, we prepare a trial balance. Na? The trial balance, what is the purpose of preparing trial balance? Tell me. To check the arithmetical accuracy. What is the meaning of arithmetical accuracy? Total accounts showing debit balances must be equal to the accounts showing credit balances. If these two amounts are equal, then it's a reasonable evidence that there are no mistakes in the bookkeeping process. But if the total of debit and total of credit does not match, then there is a conclusive evidence that there are some mistakes in the bookkeeping process. Here I have given one example. Look at, total debit is 1 lakh, whereas total credit is 90,000. Both debit and credit is mismatched. Na? Means there is 100% conclusive evidence that there are some mistakes in the bookkeeping process. The mistake may be in the recording stage or posting stage, or even at the time of preparing trial balance also. This you need to identify. Next, before rectifying the errors, first we should understand what are the various types of errors, how the errors are classified, and what are the different stages of rectification. After that, what is the rectification process? There is a process for rectification. Suppose let us take for example, I have purchased furniture. By paying 1 lakh rupee. Then what is the entry I'm supposed to write? Furniture account debit. 1 lakh to cash account 1 lakh. This is the entry I'm supposed to write. But suppose by mistake I have written like this: purchases account debit. Instead of debiting furniture, I have debited purchases account. So purchases account to debit 1 lakh to cash account 1 lakh. Now tell me, is it a mistake or not? Yes, sir. What is the mistake? Sir, instead of debiting furniture account, by mistake we debited purchases account, sir. Yes. Now, will you do like this, sir? Do one thing, sir. Just strike off this entry and write down this entry. Sorry. This is the wrong entry, na? Sir, we do one thing, sir. I will strike off this entry like this, sir. And I will write straight away this entry, sir. No, it is wrong. It is wrong. In the books of accounts, we should not overwrite the journal entries. Only thing which we can do is we have to write the rectification entry. Rectification entry we should write. Sir, what are you talking? Yes, whatever the entry you have written, let it be. You write one more entry which rectifies this error. And the entries which we are going to record to rectify the error are called rectification entries. Already we understood previously opening entries, closing entries, rectification entries, simple entry, compounding entry, or combined entry. Like this we have learned so many things. Na? Yes, sir. Now understood the process. First we try to understand what are the various types of errors. After that, different stages of rectification. After that, rectification process. Now come to various types of errors. Broadly speaking, the errors are categorized into two types. One is error of principle. Another one is clerical errors. Very, very important concept, students. Clerical errors. Observe carefully. Error of principle and clerical errors. So what is the meaning of error of principle? Error of principle is nothing but, already we understood the concept we know the concept of capital and revenue items. Capital and revenue items means capital expenditure, revenue expenditure. Capital receipt, revenue receipt. Suppose if the capital expenditure is treated as revenue expenditure, or revenue expenditure is treated as capital expenditure. This is a mistake now. See, previously here, purchase of furniture. We purchased furniture now. Purchase of furniture is capital expenditure. But instead of recording furniture account, which account we have recorded? Purchases account. Purchases means revenue expenditure. So capital expenditure is treated as revenue expenditure. Capital expenditure is treated as revenue expenditure. It is a mistake na? Yes sir. Which type of mistake it is? Sir, error of principle sir. So error of principle. So while recording the transaction, we should follow some principles like capital expenditure na. So we have to debit that expenditure name, furniture account sir. Why? Because all capital expenses are shown in the balance sheet, shown on the balance sheet asset side, and revenue expenses are straight away taken to the P&L account debit side. Yes sir, no students? Yes sir. In the same manner, uh, treating revenue receipt as capital receipt or capital receipt as revenue receipt, this is also error of principle. Like we sold furniture, what is the entry for sale of furniture? Cash or bank account debit to furniture account, but by mistake you have written the entry like this: cash or bank account debit to sales. Sales is revenue receipt, sale of furniture is capital receipt. Yes sir, no students? Yes sir. So if you have committed these types of mistakes, then we call them as error of principle. At the same time, when we pay any expenses, generally we will not debit any personal account. Suppose I have paid salaries. I have paid salaries, then what is the entry I am supposed to write? Salary account debit to cash or bank account. This is the entry we record. But in the place of salary, in the place of salary, if you debit the personal account, it is also error of principle. Next, proprietor contributed capital, then what is the entry we are supposed to write? Cash or bank or any asset account debit to capital account. If you write proprietor name alone, it is error of principle. At the same time, amount withdrawn by the proprietor, in that case we have to debit a drawings account. Instead of debiting drawings account, if you debit his personal account, then it is an error of principle. And at the same time, when you receive any income, then we have to credit income account na. Suppose we received interest, then what is the entry we are supposed to write? Cash account debit, cash or bank account debit to income account. Income account you have to credit. If it is interest, interest account credit. Dividend, dividend account credit. Any commission, commission account credit. But instead of writing income name, if you write the person from whom we receive income, then it is a mistake of error of principle. So while recording the transaction, we should follow some principles. If you violate those principles, if you record the entry by violating those principles, then all these mistakes are categorized into error of principle. Error of principle. Because of this error of principle, our trial balance will agree. Our trial balance will agree means by looking at this trial balance, it is not possible to identify there are some errors of principle, there are some clerical errors. Straight away it is not possible to identify. Why? Because even though there are some errors, even though there are some errors in the bookkeeping process, but they may not disclose, they may not disclose in the trial balance. If trial balance agree, trial balance is agreed, but there are some errors, but here trial balance is not disclosing those errors now. How can we say that there are some errors in the bookkeeping process? We understood, if the trial balance agree, then it is a reasonable evidence that there are no mistake. But back at the back end, at the back end there may be some mistakes. But if the trial balance does not agree, straight away we can come to one conclusion that there are some errors. But here error of principle, because of error of principle, our trial balance agree. Why sir? Why? Because if you observe here, if you observe here, observe here, Here we have to debit furniture account. Instead of debiting furniture account, we debited purchases account na. What trial balance is? One account we have to debit. I need one account debit. Yes, that may be furniture account or purchase account or whatever the account it may be. Instead of debiting furniture account, you debited purchases account na. Yes, trial balance needs one account debit of same value, 1 lakh. Here 1 lakh and 1 lakh. So that automatically your trial balance will agree. And the remaining types of errors, remaining all errors can be classified as clerical errors. Clerical errors means during the process of bookkeeping, we may commit some clerical errors. These clerical errors, again we can classify into error of omission. Error of omission means, what is the meaning of error of omission? Some transactions we may forget to record in the journal. I repeat, some transactions we may omit or we forget to record in the journal. This is called complete omission. This is called complete omission. Look at again. Error of omission. Omission means we forget to record the transaction in the journal or to post the transaction from journal to ledger. This is called error of omission. Again, error of omission can be classified as complete omission. Omitting an entry completely from the subsidiary books. I have recorded an entry in the subsidiary books, but I forgot to post them into ledger. In that case, our trial balance will agree na? Yes sir. See, when the trial balance agree or the trial balance not agree, when the transaction is posted into ledger. See, the transaction is recorded simply in the journal. It doesn't mean that it will affect your trial balance. No. Unless the recorded entry comes into ledger, then only there is some mistake will happen. Otherwise, your trial balance will agree. There is an entry in the journal, but it is not posted into ledger. Means no debit in the ledger, no credit in the ledger. Means there is no effect on your trial balance. Do remember. Next one, omitting to post the ledger account from the subsidiary books. Omitting to post the ledger account from the subsidiary books. So here the trial balance will not agree. I repeat, error of omission, nothing but either it may be complete omission or it may be partial omission. So what is the meaning of complete omission? Here completely we omit to record the transaction in the subsidiary books, or the transaction is recorded in the subsidiary books, but it is not it is completely not posted into ledger. Next, partial omission means what? We have recorded the transaction in the subsidiary book and we forgot to post them into ledger accounts. This is partial omission, right? Next one, error of commission. Error of commission. This is nothing but during the process of recording the transaction or during the process of posting the transaction or during the process of casting or balancing at the same time. During the preparation of trial balance, we do some mistakes. In addition to error of principal and commission, the remaining comes under error of commission. Look at, for example, writing the wrong amount in the subsidiary books. I have purchased goods for 1 lakh, but by mistake I have recorded 10,000 rupees. How much I have recorded in the subsidiary books? 10,000. 10,000. Okay. Debit 10,000, credit also 10,000. So that mistake is there. Actually, you are supposed to write 1 lakh, but how much amount written? 10,000. Mistake is there. Yes, sir. But even though your trial balance will agree. Why, sir? Why? Because in the subsidiary book, how much amount you recorded? 10,000, sir. So how much amount you post into ledger? 10,000, sir. How much amount you balance? 10,000, sir. The same 10,000 you bring to trial balance also? Yes, sir. But if you debit 10,000, if you write credit 1 lakh, then there is a mistake. Next, wrong casting of subsidiary books. Generally, subsidiary books are periodically totaled. If you total subsidiary books by mistake, wrong. Suppose the total of subsidiary books actually 1 lakh, but you casted it as 90,000. 90,000. So it is a mistake now. The total of subsidiary book is 1 lakh, but by mistake, how much amount you have written? 90,000 rupees. So it is a casting error. Because of this, the trial balance will not agree. Why, sir? From trial balance, individual postings are posted into various suppliers or customer accounts now. But whereas the total amount is wrong. The total amount is wrong. So that the trial balance will not agree. Next, posting the wrong amount in the ledger. Actually, in the subsidiary book, I have recorded correct amount, but by mistake, I have posted wrong amount. Your trial balance will not agree. Next, posting an amount on the wrong side. Actually, I have to write the amount on the debit side, 50,000, but by mistake, I have written the same amount on the credit side. So, your trial balance will not agree. Next, wrong balance of an account. Wrong balance of an account. See, instead of writing debit balance, what I have did is I have shown it as credit balance. Wrong balancing also. Wrong balancing also. Debit balance actually 10,000. Actually 10,000. Debit said total 10,000. Credit said total 8,000. What is the balance now? 2,000 rupees is the balance. But by mistake you have written 20,000 rupees. So it is a wrong balancing of an account. All these are comes under error of commission. Error of commission. Because of error of commission, sometimes our trial balance may agree, sometimes our trial balance may not agree. And another important classification of error is compensating error. This is very, very important. So what is the meaning of compensating error? One error gets cancelled out. One error cancelled out with another error. These are called compensating error. Means actually two errors happened. Actually two errors happened. Because of these two errors, what happened? One error, because of one error, another error gets cancelled out. Another error gets cancelled out. These are called compensating errors. So here I have given one example for compensating error. Look at compensating error. Observe carefully. Suppose an amount of 10 received from A. What is the entry we record? Cash account debit to A account. In A account we post on the credit side 10 rupees na? Yes sir. Is not credited to his account and the total of the sales book is 10 rupees in excess. Actually from A account we have credited na. A account we should give credit 10 rupees but it is not credited. So the sales book is 10 rupees in excess, right? The omission of credit to A's account will be made up by the increased credit to sales account. Next, for example, another example, the sales day book undercast by 1000, less credit is compensated by less debit of 1000 in the salary account. For example, observe here. Here I am preparing sales account. While preparing sales account, I have committed, or while casting sales account, I have casted 1000 rupees less. Fine, sir. And on the other hand, I am preparing salary account also. Salary account. Salary account, I forgot to post 1000 rupees debit. I forgot to post 1000 rupees debit. So salary account shows 1000 rupees less debit na. 1000 rupees less debit. Observe. Salary account 1000 rupees less debit. Sales account 1000 rupees less credit. Means here two errors happened. Okay. Here sales account shows what? 1000 rupees less amount. On the other hand, salary account shows what? 1000 rupees less debit. So automatically, the sales account 1000 rupees less means if you observe debtor account 1000 rupees, it shows more na, because the entry is posted into debtor account na, means debit 1000 rupees is showing more, whereas credit 1000 rupees showing less. On the other hand, salaries, what we are doing, salaries we are showing 1000 rupees less, 1000 rupees less. So automatically when it comes to total debit 1000 rupees less, total credit 1000 rupees less, so that the error gets compensated. The error gets compensated. These are called compensating errors. Because of compensating errors, the trial balance will agree. Because of compensating errors, the trial balance will agree. So these are the various types of errors. These are the various types of errors. After understanding various types of errors, next step is, what are the various stages of rectification of errors? What are the various stages of rectification of errors? Means, when did you identify, or when you have identified the error? Means, we have classified them as three stages, students. Three stages. Observe one by one here. Just a minute. Yeah. Observe here. Look at this box once. An error can be detected at any of the following stages. Any of the following stages. First one, before preparation of trial balance. I have located errors before preparing the trial balance. Generally, you tell me, when do you come to know that there are some errors in the bookkeeping process? Only after preparation of trial balance. But here what I am doing, before preparation of trial balance itself, I come to know that there are some errors. Then how do you rectify? Second one, after preparation of trial balance, but before preparing the trial balance. Now I have prepared the trial balance. I come to know that the trial balance does not agree. In that case, it's a conclusive evidence that there are mistakes in the bookkeeping process. Yes, sir. Now here I have located, or here I have identified the errors at the stage of preparation of trial balance, but I have not prepared financial statements. This is called stage 1. This is called stage 1, and this is called stage 2. Next one, next one, after the preparation of final accounts. After the preparation of final accounts, that is in the next accounting period. Current year, I was unable to locate the error, but here I have to prepare. If I spend time on locating errors, here I have to prepare financial statements now. That's why what I am doing. So whatever, see, after preparing trial balance, the difference we transfer to the suspense account, and the same suspense account is carried to the next financial year. Same suspense account we carry to the next financial year. So next financial year, what we do, we try to locate the errors of previous years. We try to locate the errors of previous year. So that is stage 3. That is stage 3. When you are locating errors, previous year errors we are locating in the current year. Previous year errors we are locating in the current year. This is called stage 3. After the preparation of final accounts, that is in the next accounting period, we have located. So here there are 3 stages of locating errors. If you locate errors in stage 1, then what is the rectification process? If the errors are located in stage 2, then what is the rectification process? If errors are located in stage 3, then what is the rectification process? That we need to understand. What is the next step? Tell me. Rectification process. First step, types of errors. How do you know that there are some errors in the bookkeeping process? By looking at trial balance. After knowing that there are some errors in the bookkeeping process, next we have classified all those errors into error of principle, clerical errors. Again, clerical errors are classified into error of omission, error of commission, and compensating errors. Because of these errors, some errors may affect the trial balance, some errors may not affect the trial balance. Okay, sir. After that, we understood in which stage, the various stages of identifying and locating the errors. How many stages, in how many stages we can locate the errors? In three stages. One is before preparation of trial balance, second one is after preparation of trial balance but before preparation of final accounts, next one after preparation of final accounts, that means in the next financial year. Now, if you identify the error in stage 1, then how do you rectify? If you identify the error in stage 2, then how do you rectify? If you identify the error in stage 3, means next financial year, then how do you rectify? That is nothing but rectification process. Rectification process. Next, one more thing you should understand is, whenever an error happened, I repeat, whenever an error happened, because of this error, there may be effect in one account, or there may be effect in two or more accounts. I repeat, if you observe here, this is the correct entry, this is the correct entry, yes or no? This is the correct one, and this is the wrong one. This is the wrong one. You people tell me, because of it is error of principle. Now first identify whether it is error of principle or error of omission or error of commission or compensating error. So this is error of principle, sir. Fine. Because of this error, how many accounts gets affected? Here total correct entry is furniture account debit to cash account. How many accounts total? Furniture account and cash account. In the wrong entry, how many accounts we recorded? Purchases account and cash account. In the correct entry, cash account credit. In the wrong entry also cash account credit. Means there is no effect in cash account. There is no effect in cash account. So the effect is in furniture account. Furniture account is affected, means there is no debit in the furniture account, and purchases account also affected, means purchase account is debited 1 lakh more. Actually we should not debit for purchases account, but by mistake purchases account debited, so it is showing 1 lakh rupee more. And we should not debit furniture account, but by mistake we should debit furniture account, but furniture account is not debited. So how many accounts gets affected? Two accounts. So first we should identify, because of this error, how many accounts gets affected? One account or two accounts? One account or two accounts? That you need to identify. If the error affects only one account, then it is called one-sided error. If the error affects only one account, then it is called one-sided error. If the account affects two accounts, then it is called two-sided error. In our example, you people tell me whether this error affecting one account or two accounts. Two accounts are furniture account and purchases account. So it is called two-sided error. So while solving the problem, first identify whether the error is affecting one account or two accounts. From there we start the rectification process. Hope you are following. One side error or two side error, that we need to understand. Now that we understood, now we start discussing very important concept, that is rectification of error problem solving technique. Previously I have discussed bank reconciliation statement problem solving technique. Some students, they have uh, sent a message that, sir, please help us in solving the remaining chapters also, especially company accounts also. That's why what I thought is, for every chapter, let me give you some problem solving technique. Sir, is it possible to solve any type of problem by following this technique? Means, for all problems it may not be possible, but for to some extent, if you follow these steps, you can complete the problem to some extent. Ultimately, you have to utilize your common sense. Don't forget that. Now let us discuss the rectification of error problem solving technique. Now, before discussing the rectification of error problem solving technique, let us discuss a small example here so that you can understand the rectification process. First, look at, here I have taken one example. Purchased furniture rupees 1 lakh on credit from Mr. A. First, what is the journal entry we record? This is the first stage. Now, we record the entry. The entry is furniture account debit to Mr. A account. Furniture account debit to Mr. A account. This is the correct entry we record. Next, second one is we have to post it into the ledger. How many accounts we open in the ledger? Furniture account debit and furniture account and Mr. A account. In the entry, furniture account is debited now. So ledger posting also, furniture account debit side to Mr. A account, 1 lakh. Mr. A account credit side, Mr. A account credit side by furniture 1 lakh. After posting, next step is what? Balancing. After posting, next step is what? Balancing. Observe carefully. Here furniture account is showing 1 lakh rupee balance. Furniture account is showing 1 lakh rupee balance. So by balance carried down 1 lakh. And Mr. A account is also showing 1 lakh rupee balance. To balance carried down 1 lakh. Now with these balances we prepare trial balance. Observe the trial balance. Furniture account is showing debit balance. So furniture account debit balance 1 lakh and Mr. A account is showing credit balance. So Mr. A account credit 1 lakh. Now both sides are equal. Na? Both sides are equal. Actually, this is the bookkeeping process. Entry recorded, posted into ledger accounts. From from the ledger accounts, we prepare the trial balance. If the trial balance does not agree, then we have the conclusive evidence that there are some mistakes in the bookkeeping process. Hope you understood. Yes, sir. Now, in the examination, first identify in which stage the mistake is happened. In which stage here, in the sense whether the mistake is happened in the journal stage or ledger stage or preparation of trial balance stage. Ledger stage nothing but posting. Ledger stage nothing but there are some things covered under here, under ledger. First one, posting. Whether the mistake happened in posting. Posting means whether the posting has been done on the debit side or credit side. Posting. Or the amount is recorded on the debit side or credit side. Whether the amount is recorded correctly or not. These are all posting errors. Next one, casting. Next one, casting. Whether the ledger account is casted properly or not. The total is 10 lakhs, but by mistake I have casted 1 lakh rupee. Next one, balancing. Balancing. Sometimes the debit balance may be shown as credit balance or credit balance may be shown as debit balance. So these three things we need to understand first. These three things. In case of postings, you should understand these three things. Posting, casting, balancing. Errors. After that, whether the error may be happened in the trial balance, means actually furniture is showing debit balance now. Sometimes it may be recorded on the credit side, or Mr. A account is showing credit balance now. Sometimes it may be shown on the debit side by mistake. At the same time, furniture account is showing 1 lakh rupee na. Sometimes we may write simply 10,000 rupees. Mr. A account is showing 1 lakh na. Sometimes we may write 10,000 or even 10 lakhs also. Sometimes we may forget to bring Mr. A account to trial balance at all. Sometimes we may forget to bring Mr. A account to trial balance at all. These may be the things may happen in the trial balance stage. Okay, here in the recording stage, what are the various types of mistakes we may commit? We may completely forget to record this transaction in the journal. Here we have recorded, but practically we may forget to record the transaction in journal na. Yes sir, error of omission, error of omission. Or sometimes in the place of furniture we may write purchases na, error of principle. So we may commit error of principle or error of omission, commission, whatever it may be. Means the error may happen at any stage, at the stage of recording journal entry, at the stage of posting, casting, balancing, and at the time of preparation of trial balance also. So in the examination problem, you identify whether the mistake is happened in the recording process or posting process or preparation of trial balance. This is very important. This is the first and foremost step. Tell me first, what will you do? Identify whether the mistake is happened in the journal stage or posting. Posting also at the stage of posting or casting or balancing. After that, or at the time of preparation of trial balance. After identifying this, now we start our rectification of errors problem solving technique. Hope you are following. Yes sir. Fine. Now look at the step 1. Step 1 is what? Identify in which stage the mistake happened, not identified, happened. Whether the mistake is happened in journal stage or ledger stage or trial balance stage. After that, next one, follow this. So here we can name it as step 2. Step 1 is what? Step 1. Mistake happened in which stage? Which stage means that may be journal, ledger or trial balance stage. Okay, now second step, look at identify the stage of rectification. Step 1 is what? In which stage the mistake is happened. Whether the mistake is happened in recording stage or posting or preparation of trial balance. Second step is what? Stage of rectification. In which stage you identified the mistake? So identified the mistake means whether you have identified the mistake at the time of before preparation of trial balance or after preparation of trial balance but before preparation of final accounts, or after preparation of final accounts, that means next financial year. Stage 1, stage 2, stage 3. If the mistake is identified or the mistake is located in stage 1, very important, students, observe. If it is stage 1 rectification, if you are rectifying the error in stage 1, then first identify whether the error is affecting one account, whether it may be stage 1, 2 or 3. First you have to check whether the error is affecting one account or two accounts, one sided or two sided. In stage 1, this is before preparation of trial balance. Now this is before preparation of trial balance, means no suspense account is created. I repeat, when does the requirement of suspense account comes? only at the time of preparation of trial balance. In stage 1, trial balance is not prepared. Okay. So how the one sided error gets rectified? Normally, this stage 1 rectification is possible only in case of manual accounting work, manual accounting system. Under computerized accounting system, this stage 1 rectification is not possible. Why? Because in the computerized accounting system, trial balance gets prepared automatically. After recording of each transaction, it is posted into ledger accounts, and back end the trial balance also prepared. So stage 1 rectification is possible only when you maintain manual accounting system. So in stage 1, what we do, if it is one sided error, go to that account straight away. Suppose if the error is affected, if the error is in furniture account, if the error is in furniture account, assume furniture account the error is. Okay. Furniture account, which side identify? Furniture account, which side identify? In case of purchase, then the mistake is on the debit side. In case of sale, then the mistake is on the credit side. Suppose debit side I have written 100 rupees less here. Our furniture account is not at all debited. Now we debit furniture account. Let us say 1 lakh rupee. There is some mistake in the furniture account debit side. You rectify it now. So what we do? We simply write here rectification statement. What we call it? Rectification statement. Rectification statement. Because the mistake is happened in one account only. So we go to that account and go to appropriate side. Appropriate side means if I write the rectification debit side or credit side. If I write rectification on the debit side, then the error gets rectified. If I write rectification on the credit side, then the error gets rectified. Is it clear? So rectification statement. Second, next one, observe. If it is two-sided error, means the error is in two accounts. The error is in two accounts. If it is possible to record complete journal entry or complete rectification entry, you can write down. Complete rectification entry means one account debit and one account credit. I repeat, complete rectification entry means one account debit and one account credit. If it is possible to record complete rectification entry, then write down the rectification entry. If it is not possible to record rectification entry, means let us say, for example, there is one mistake in purchase account. Suppose let us take two accounts here, purchase account and sales account. Okay, just a minute. Let me take one problem and I will show you that. Yes, look at illustration 1 once. Okay, look at 7th one. Discount allowed to Satish 25 has not been entered in the discount column of cash book. It is not entered in the discount column of cash book. The amount has been posted correctly to the credit of his personal account. Means, so here the mistake is in only one account, that is discount column. Discount column is only one account. So how many accounts affected? Only one account, na? Okay. Now come to illustration 2. Come to once illustration 2. Yeah, look at fourth one here. 100 paid for rent debited to landlord account. 100 paid for rent debited to landlord account. Now how can we rectify this? Earlier rent account is not debited, now you debit. Landlord account earlier debited, now you credit. Means here it is stage 1 error. Here it is possible to record rectification statement, sorry, rectification entry. That's why for the fourth one, here we have recorded complete rectification entry. Observe carefully, complete rectification entry. So if it is possible to record complete rectification entry, then you can write down. Let me take one more example here. Okay, if it comes, I will explain, don't worry. Next, look at, yeah, if it is one-sided error, then what we do? Simply write down the rectification statement on the appropriate side, or simply you can write the rectification statement like this, like this. Simply you can write in the examination like this. Okay, next one, if it is two-sided error, if it is possible to write complete rectification entry, write down. Complete rectification entry means one account debit and another account credit. Otherwise, you can write two rectification statements. This is stage 1 rectification. Important note points. Here you need not to prepare any suspense account. Why, sir? Why? Because here we have not prepared suspense account. Na? It means here we have not prepared trial balance. When trial balance is not prepared, you need not to prepare any suspense account. If we prepare trial balance, if we get any difference in the trial balance, that difference we transfer to the suspense account. Means in stage 1 you need not to prepare any suspense account. So what is the indication that whether it is stage 1 rectification or stage 2 rectification or stage 3 rectification? Simple. The indication is simple. The indication is they will not use the word suspense account. They will not use the word suspense account. In that case, it is stage 1 rectification. Next, suppose if it is stage 2 rectification. Stage 2 rectification means after preparing trial balance but before preparing final accounts. After preparing trial balance but before preparing final accounts. After preparing trial balance means the difference we transfer to the suspense account. Let us take for example, debit side total is more than credit total, means we transfer that excess debit to suspense account. In that case, suspense account shows credit balance, because debit side more na, we transfer the amount to the suspense account credit side. Suppose credit side is more, excess amount, excess credit, means the excess credit we transfer to the suspense account, means suspense account shows debit balance. Okay, so check that in stage 2, whether it is one-sided error. If it is one-sided error, the error gets rectified by writing complete rectification entry. In stage 2, we record whether it is one-sided error, irrespective of whether it is one-side error or two-side error, we record complete rectification entry. Complete rectification entry. Sir, you may ask, sir, one side error means only one account affected, na sir. To record the rectification entry, we need two accounts, na sir. Yes. You can use the second account, suspense account. You can use the another account, suspense account. Suppose, for example, furniture purchased, but it is not posted to furniture account. Furniture purchased for cash, means this transaction is recorded in the cash book now, because it is a cash transaction. It is recorded in the cash book but forgot to post into furniture account. Only one account affected. Which account? Furniture account gets affected. Now what is the entry I have to write? Actually, furniture account debit. Earlier furniture account is not debited. Now I will debit furniture account. But to complete the entry, I need one more account now. So I will take suspense account help. I will take suspense account help. That's it. In the furniture account debit side, I will post to suspense account 1 lakh. To suspense account 1 lakh. This is how I prepare. Sorry, I will write rectification entry. One-sided error. If it is two-sided error, Two-sided error means two accounts gets affected. Two accounts gets affected. If one account is debited and another account is credited, then it is okay. Or if two accounts are debited during the rectification, two accounts are debited. Then what about credit? Use suspense account. During the process of rectification, two accounts gets credited. In that case, you can use suspense account as debit. If it is possible to record the journal entry, if it is possible to record the journal rectification entry with the two accounts, then you can straight away record the entry. If it is not possible to record rectification entry with the two accounts, then you can take the help of suspense account. When problem comes, then I will explain. Next step, note point, prepare suspense account. When you are rectifying errors in stage 2, compulsorily you have to prepare suspense account. Sir, what is the indication that this is stage 2 rectification? Means they use the word suspense account only. They use the word suspense account. They don't use the word next year. Suppose if they use the word next financial year, the errors are identified in the next financial year. Next financial year means it is stage 3 error. Next financial year means it is stage 3 error. Do remember, students. Okay. Now come to stage 3 error. We understood in stage 1 how the errors gets rectified. In stage 2 how the errors gets rectified. Now come to stage 3. Stage 3 also identify whether it is one-sided error, two-sided error. Stage 3 rectification is similar to stage 2 rectification with the exception that, very important, observe carefully. Check the account affected is a nominal account or not. Account affected is a nominal account. See, in stage 3 means we are rectifying the errors in the next financial year. In the previous year, all the nominal accounts gets closed now. In the previous year, see, we have three types of accounts now: personal accounts, real accounts, nominal accounts. All the nominal accounts gets closed in the previous financial year. Remaining accounts carry forwarded means personal accounts and nominal accounts. In the previous year, nominal account is affected. Very good. If you write that a nominal account in the current year now, current year also we open some nominal accounts now. Suppose the mistake is there in the purchase account, in the previous year purchases account. If you write purchase account in the current year also we open purchase account now, because nominal accounts are opened during the year and closed at the end of the year. All nominal accounts are gets closed at the end of the year. Again next year we open nominal accounts. Last year purchase account closed, but current year again we are opening purchase account, and this purchase account is for current year. If the mistake is in previous year purchases account, if you open that purchase account in the current year again, the current year purchases account gets affected now. That's why whenever any nominal account is affected, in the place of nominal account, we use one important account, that is profit and loss adjustment account or profit and loss suspense account. Profit and loss adjustment account or profit and loss suspense account we open when the affected account is nominal account. In suppose salary account is debited 1000 rupees short. Salary account debited 1000 rupees short means now we have to debit salary account actually. Now we have to debit salary account, but salary account is nominal account. Yes sir, in the place of salary account use the word profit and loss adjustment account. And ultimately the other account is what? Suspense account, because we have only one account now, one account affected. And account affected other than nominal account, account affected other than nominal account, the rectification is similar to stage 2 error. The rectification is similar to stage 2 rectification. Very important. In stage 3 the only concern is identify whether the account affected is a nominal account or real account or personal account. If the account affected is a nominal account, then in the place of nominal account, use the word profit and loss adjustment account. If the account affected is real and personal account, then you can rectify the error as in the case of stage 2. This is very, very important. So here also we will take the help of suspense account to complete the rectification entry. To complete the rectification entry, we take the help of suspense account if needed. Note point, look at. So here in stage 2, we prepare only suspense account, but in stage 3, we prepare suspense account as well as profit and loss adjustment account. Both the accounts we prepare, and the balance in suspense account automatically gets closed sometimes. If it is not closed, carry the balance, or else you can transfer the suspense account balance to profit and loss adjustment account, and ultimately the profit and loss adjustment account balance is closed by transferring the amount to capital account. Don't forget this. The profit and loss adjustment account balance, it may be debit balance. Debit balance means loss. Credit balance means profit. Whether it is profit or loss, that is transferred to the capital account of the owner. Okay. Next, what is the indication that we have to do stage 3 rectification? Means they will use the word next year. The errors are located in the next financial year, or current year books of accounts are closed, next year the mistakes are identified. This is the indication for stage 3 error. Do remember, students, stage 3 error. Now we understood in case of stage 1 how the errors gets rectified, and stage 2 how the errors gets rectified, and stage 3 also how the errors gets rectified. Now we try to solve some problems. Here you can read the theory point that rectification of errors before trial balance. Here I have given clearly, after completion of this lecture, go and read the concept. Rectification of one side error and rectification of two side error. Next, rectification after preparation of trial balance but before final accounts. This is also one side error, two side error. Next, rectification after the preparation of final accounts, stage 3. Here also it is, stage 1 error, stage 2 means one sided, two sided. But here we use the account profit and loss adjustment account in the place of nominal account. The difference between stage 2 and stage 3 is this is, in stage 3 if you identify any nominal account, in that place we use the word profit and loss adjustment account. Don't forget, students. Okay, now we try to solve some problems, then you can understand the concept of rectification of errors more clearly. Okay, we understood that how the problems of rectification of errors solved. For that, first what we need to do, we need to identify whether the mistake is happened during the process of journalizing, recording transactions in the subsidiary books, or posting, casting, or balancing, or at the time of preparation of trial balance. Based on that, after that we have to check whether in at what stage we are going to rectify the error. That may be stage 1, 2, or 3. Stage 1 is nothing but before preparation of trial balance. Stage 2 is nothing but after preparation of trial balance but before preparation of financial statements. Stage 3 is nothing but after preparation of financial statements. That means we are going to rectify the errors in the next financial year. Now we try to solve some problems to understand the concept of rectification of errors. First we discuss some problems on stage 1, then after we go to stage 2, then after stage 3. First look at illustration 1. How do you rectify the following errors in the books of Rama and Co? Simply they are giving, how do you rectify the following errors in the books of Rama and Co? They did not mention about suspense account now, or they did not mention about the mistake, the errors are identified in the next financial, rectified in the next financial year. They are not using these words. Most cases in the examination, they give you either stage 2 or stage 1. Stage 2 or stage 3. Clear? Now, these are just for understanding purpose. Illustration 1 is just to understand the concept. First one, the total of the purchase book has been undercast by 100. Total of purchase book means subsidiary book. It is nothing but subsidiary books are periodically totaled. Yes, sir. So while we are totaling purchase book, we undercast it by 100. When purchase book is undercast by 100, automatically purchase account also shows 100 rupees less. Tell me, is it one side error or two side error? Sir, it is one side error, sir. Why? Because of this error, only one account gets affected. Now this is stage 1, so that simply we go to purchase account debit side and we write 100 rupees. Why? Because purchase account is debited now. We write 100 rupees. So here we write rectification statement. Look at what is the statement we record. We write on the debit side of purchase account, simply we write to undercasting of purchase book for the month of, that's it, 100. But do remember students, now we are doing accounts in a computerized environment manner, so one set errors are not possible. That's why in the examination also most of the cases they are giving stage 2 errors and the stage 3 errors. Next, rectification, stage 2 rectification and stage 3 rectification. Second one, the returns inward book has been undercast by 50. Returns inward book means sales returns book. Sales returns book shows debit balance, so it is undercast by 50. Now what we do, we go to sales returns account debit side and we write 50 rupees. Look at, to undercasting of returns inward book for the month of 15. Simply we write this rectification statement. Next, third one, a sum of 250 written off as depreciation on machinery. What is the entry for depreciation on machinery? Depreciation account debit to machinery account 250 rupees. Fine. So this is posted to depreciation account debit side and machinery account credit side. Has not been debited to depreciation account. Means machinery account correctly credited, but depreciation account is not debited. Now we debit depreciation account. Look at third one, we go to depreciation account debit side, we write this statement to omission of posting 250 over. Next, fourth one, a payment of 75 for salaries to Mohan has been posted twice to salaries account. Actually we have paid salaries. What is the entry we record? Salaries account debit to cash or bank account. It is debited to the salaries account, but here they debited two times. So in the salaries account debit side, on the debit side of salaries account, we recorded this two times. Now how can we rectify this? One time you cancel it, means we open salary account, on the credit side we write 75 rupees, automatically the error gets rectified. So we go to salaries account, on credit side we write by double posting 75 rupees. Understood? Next one, the total of bills receivable book. Total of bills receivable book, periodical total 1500 has been posted to the credit of bills receivable account. Actually the total of bills receivable book is posted to the bills receivable account debit side, but by mistake they have debited on the credit side. So how can we rectify this? This is very important students. Look at, observe carefully, this is bills receivable account. Actually I have to post on the debit side. I have to post on the debit side how much? 1500. 1500 I have to write, but instead of that what I did, I have written 1500 on the credit side, means there is no debit on the debit side. Now you people tell me how can we rectify this? See, credit side by mistake we have recorded. Now debit 1500. Credit side by mistake recorded na debit 1500. Now if I write, if I debit 1500, what is happening? The effect gets nullified. The effect gets nullified. Earlier wrong credit given, now rectified. But where is the right credit or correct debit? Sorry, correct debit means we have to write more 1500 rupees on the debit side to make the bills receivable account. To make the bills receivable account, because bills receivable 1500. Now what we have to do? By mistake we have written on the credit side 1500. To correct this 1500, one time debit 1500. But originally bills receivable account should receive debit 1500 now. For that more 1500 rupees. So totally bills receivable account is debited with 3000 rupees. This is very important concept. Most of the students, they get confusion here. Sir, if we write 1500 rupees, that is more than enough, na sir? No, we should write 3000 rupees. If we write only 1500 rupees, then the error gets rectified. But what about the original amount of 1500? For that purpose, we are writing more 1500 rupees. So totally bills receivable account will receive 3000 rupees. So we go to bills receivable account to debit side and we write the same. To wrong posting of bills receivable, 3000 rupees. Very important. Next, an amount of 151 for a credit sale to Hari. Normally, what is the entry we record? Hari account debit to sales account 151. Although correctly entered in the sales book, so it is correctly entered in the sales book, has been posted as 115. But we posted as 115. We entered correctly. We entered correctly in the sales book. How much? 151. But at the time of posting, how much amount we posted? 115. Now, how do we rectify this? What is the difference here? 151 minus 115. 36 rupees is the mistake. Now we go to sixth one, Hari personal account. We go to Hari's personal account. See, if you observe here, you may get one doubt. What is the doubt? Sir, to which account or which account gets affected here? Is sales account or Hari account? Means, observe carefully, correctly entered in the sales book has been posted. From sales book to which account we post? Debtor account. Means there is a mistake in the debtor account. Mistake in the debtor account. So it is very important to identify in which account the mistake it is. Observe. Hari's personal account is debited 36 short. Yes or no? Actually, we have to debit 151 rupees, but only 115 rupees debited. How much short debit? 36 rupees. Now we debit Hari account with more 36. The error gets rectified. Next one. Discount allowed to Satish 25 has not been entered in the discount column of cash book. If you remember 3-column cash book, there we allow, debit side we write discount allowed to customers and credit side we write discount received from suppliers. Here we have allowed discount to Satish, but we forgot to write this 25 rupees in the discount column. The amount has been posted correctly to the credit of his personal account. Means here, if you take Satish account, credit side 25 rupees we write as by discount allowed. This is what they are saying. Anyway, personal account we have given correct credit, but if you take discount allowed account debit side, 25 rupees not recorded. Now what we do? We go to discount allowed account debit side and we write 25 rupees. That's it. Look at to omission of discount allowed to Satish on 25. We go to discount allowed account debit side and we write the same. This is our problem number 1. Understood? Next, look at problem number 2. Observe here, the following errors were found in the books of Ram Prasad and Sons. Give the necessary entries to correct them. Simply they are asking, give the necessary entries to correct them. They are not mentioning about suspense account or they are not mentioning about stage 3 rectification. Simply they are saying, give the necessary entries to correct them. So here also we assume this rectification is stage 1 rectification. Under stage 1 rectification, generally what we do is we rectify the error by writing rectification statement. If it is possible to record complete rectification entry, then we simply write the rectification entry. Now look at first one. 500 paid for furniture purchased has been charged to ordinary purchases account. Means, what is the wrong entry recorded? Purchases account debit. Purchases account debit to cash or bank account. This is the wrong entry recorded. Actually, what is the correct entry? Correct entry is furniture account debit to cash or bank account. This is the correct entry. Now, how can we write rectification entry? Simple. Which account actually you have to debit? Sir, furniture account actually debited, sir. Now you debit furniture account. Furniture account debit. By mistake earlier, which account debited? purchases. Now you cancel it, means reverse it. Don't strike off. Don't strike off. Simply credit it to purchases. Over. This is the rectification entry we record. Anyway, cash account is correctly credited. You need not to touch cash account. Now, how do we rectify this? Tell me. First, visualize what is the wrong entry recorded. After that, visualize what is the correct entry to be recorded. After that, you can write rectification entry. If you want, you can write it as rough page also. You can write in a rough page also. Based on that, you can make a rectification entry. Now, look at first one. Furniture account debit 500 to purchases account 500. That's it. Second one. Repairs made were debited to building account for 50. Actually, we have paid for repairs. What is the entry we have to write? Repairs account debit to cash or bank account. But by mistake, we debited to building account. Means it is error of principle, because revenue expenditure is treated as capital expenditure. Now what we do? Earlier repairs account is not debited. Now you debit it. Earlier by mistake building account is debited. Now you reverse it. What is the entry we record? Rectification entry. Repairs account debit to building account. Repairs account debit to building account. That's it. Look at repairs account debit to building account. Next. An amount of 100 withdrawn by the proprietor for his personal use. Normally, what is the entry we record? Simply drawings account debit to cash or bank account. Has been debited to trade expenses account. So it is also error of principle, because here personal expenses of proprietor they mixed with the business expenses. We should not do that. That's why what we do now, earlier drawings account is not debited, now we debit. Earlier by mistake trade expenses account is debited, now you reverse it. Finally entry drawings account debit to trade expenses account. So here visualization is very important. What was happened? What was happened? That you need to think. What should have been happened? That also you have to think. Next, 100 paid for rent debited to landlord account. It is also error of principle. Generally rent paid we have to debit rent account, but by mistake whose account debited? Landlord account debited. Now rectification. Rent account debit, landlord account credit. Cancel it. Okay. So rent account debit to landlord account. So here if you observe, here whatever the errors we have rectified, here we have written, we have recorded complete rectification entries. Complete rectification entries. Next one, salary 125 paid to a clerk due to him has been debited to his personal account. Actually salary paid to clerk, which account we have to debit? Salaries account. But by mistake which account debited? His personal account. Now what is the entry we record? Salary account debit to clerk account. Salary account debit to clerk account. This is the rectification entry. Next, 100 received from Shaw and Co. has been wrongly entered as from Shaw and Co. Actually this is Shaw, S-H-A-H, but this is Shaw, S-H-A-W. Now what we do? 100 received. What is the entry we record? Cash or bank account debit to Shaw and Co account. Earlier by mistake this account is credited now. Now SHAW and Co account debit, SHAH and Co account credit. Simple. Look at this is the rectification entry we record. Next, 700 paid in cash for a typewriter. Typewriter is asset for us. Was charged to office expenses account. Again it is error of principle. Now earlier typewriter account is not debited. Now you debit typewriter account. Earlier office expenses account is debited. Now you simply credit it. Over. So typewriter account debit to office expenses account. This is our illustration 2. Hope you are following. Now come to illustration 5. This is very important, student. Stage 2 rectification. From these problems onwards we discuss stage 2 rectification. Look at. Correct the following errors found in the books of Mr. Dutt. The trial balance was out. The trial balance was out means trial balance has been prepared by 493 rupees excess credit. If you prepare trial balance, credit side is more by how much? 493 rupees. Then what we do? This 493 rupees we transfer to the suspense account on the debit side. So now tell me, suspense account is showing which balance? Debit balance. If you open suspense account, we write Two balance brought down. Two balance brought down 493. The difference thus has been posted to a suspense account. Okay, now that's it. Remaining all are errors. Means here what is the indication? Trial balance is prepared and there is a difference in the trial balance. That difference is transferred to the suspense account. Means this is stage 2. Identification is very important, whether the rectification is made in stage 1, stage 2 or stage 3. That is very important. In stage 2 what happens? Whatever the error it may be, means whether it is one sided error or two sided error, we should record rectification entry. We should record complete rectification entry. If complete rectification entry is not possible, then we use suspense account. Okay, now look at, an amount of 100 was received from DDoS on 31st December but has been omitted to enter in the cash book. Actually, we have received 100 from DDoS but it is not entered. It is complete omission. Complete omission. Now you record entry. Cash account debit to DDoS account. Complete omission na. Now you make a record. Cash account debit to DDoS account. Next. The total of returns inward book. Returns inward book means sales returns book. For December has been casted short by 100. Okay, now you give more debit to sales returns account 100. So sales returns account is debited to, actually it is one sided error na. If it is one sided error, to record the rectification entry, we take the help of suspense account. So that what is the entry we record? Returns inward account debit to suspense account 100. Okay, next one. Third one, the purchase of an office table. Office table nothing but furniture costing 300 has been passed through the purchase day book. Means earlier furniture account is not debited, you debit now. Earlier by mistake purchase account is debited, now you simply credit over 300 rupees. So furniture account debit to purchases account 300. Is it clear? Very simple. Once you understand the concept now, what was happened by mistake, now how can I rectify it? That is very important. Next, 375 paid for wages to workmen for making showcases. Showcase is nothing but asset. So whatever the expenses, whatever the wages we have incurred for making an asset, we have to capitalize those expenses or wages. But here what happened, had been charged to wages account. Means treating capital expenditure as revenue expenditure. What we do now? Debit furniture account, credit wages account. That's what we do now, 375 rupees. So furniture account debit 375 to wages account 375. Next, E point. A purchase of 67 had been posted. Posted. So where is the mistake happened? Posted. Posting mistake. 67 posted to the trade payables account as 60. Actually, we go to trade payables account credit side and we should write 67. But how much amount you have written? 60. You do one thing. Supplier account credit with more 7 rupees. Is it one side error or two side error? One side error, sir. So supplier account is credit with 7 rupees. Suspense account debit with 7 rupees. See, suspense account debit 7 rupees to creditor account 7 rupees. Hope you are following. Next, a check for 200 received from PC Joshi had been dishonored. We received a check. What is the entry we have been recorded already? Bank account debit to PC Joshi account. Now this check is dishonored. What is the entry we should write? We are supposed to write reverse entry. PC Joshi account debit to bank account. But what happened here? Was passed to the debit of allowances account. Actually, whose account we have to debit? PC Joshi account is debited, but by mistake allowances account is debit. What we do now? PC Joshi account debit, allowance account credit over. PC Joshi account debit 200 to allowance account. Next, 1000 paid for the purchase of a motorcycle for Mr. Dutt for his personal use. We have purchased motorcycle. Generally, if it is purchased for business purpose, motorcycle account debit to bank account we record the entry. But it is for personal purpose, na? Then what is the entry we record? Drawings account debit to cash or bank account. Had been charged to miscellaneous expenses account. So personal expenditure is treated as business expenditure. How can we rectify this? Drawings account debit 2. Earlier by mistake miscellaneous expenses account is debited. Now simply credit 1000 rupees over. So drawings account debit to miscellaneous expenses account. Next one, goods amounting to 100 had been returned by customer, means sales returns, and were taken into inventory, but no entry in respect thereof was made in the books. Means there is no entry recorded for sales returns. Generally, what is the entry for sales returns? Sales returns account debit to trade receivable or customer account. The same entry we record over 100. Next, a sale of 200 to Singh and Co. was sale of 200 to Singh and Co. What is the entry we are supposed to write? Singh and Co. account debit to sales account was wrongly credited to their account. Actually, Singh and Co. account debit side we should write 200, but by mistake we have written credit side. To make a correction of this 200 rupees, debit side we should write 200 and one more 200 for actual debit. So totally Singh and Co account is debited with 400 rupees. Okay, one sided error now. So we take the help of suspense account. Singh and Co account debit 400 to suspense account 400. Now after recording all these transactions, what we do is we simply prepare suspense account. Already I have explained here. When you have rectified errors in stage 2, observe carefully, note point, prepare suspense account without fail. Irrespective of that, whether they have asked in the exam or not, prepare it well. Next one. Look at suspense account. Already suspense account is showing 493 rupees debit balance. Yes, sir. So after posting all these entries means suspense account. So which entry contains suspense account? B. Next E entry. Next one, last entry. These three accounts entries contain suspense account. Now post them into suspense account. After posting, now suspense account total debit 500, total credit 500. It means suspense account gets closed. It means suspense account gets closed. Hope you are following. Yes, sir. Next, look at illustration 7. Write out the journal entries to rectify the following errors using suspense account. Means they are asking us use suspense account for the following errors, rectify them with the help of suspense account. Means in which stage we are rectifying. So stage 2, after preparation of trial balance but before preparation of financial statements. First one, goods of the value of 100 returned by Mr. Sharma were entered in the sales day book and posted therefrom to the credit of his account. What happened? Actually, we have to record this transaction in the sales returns account. But sales returns account is not debited earlier. Now you debit sales returns account 100. Now sales account earlier by mistake credit. Now debit sales account also 100. To customer account give 200 rupees credit. Why? Actually customer account should get 200 rupees credit now. Therefrom to the credit of his account. Okay, to the credit of his account means correct customer account is correctly posted. So here two accounts debited now. Sales returns debit 100, sales account also debit 100. So we take the help of suspense account. So look at sales account debit 100, sales returns suspense account. If customer account is wrongly debited, then here we write customer account 200 rupees. Okay. Next, second one, an amount of 150 entered in the sales returns book has been posted to the debit of Mr. Philip who returned the goods. Actually, who returned the goods? Mr. Philip. We have to credit Mr. Philip account now. This entry we have to post on the credit side of Mr. Philip account, but by mistake we recorded on the debit side. How do we rectify? For rectification of 150, write down 150 rupees one time credit. To give actual credit, more 150. Total 300 rupees Mr. Philip account credit. Debit is given to suspense account. So suspense account debit to Mr. Philip account 300. Next, a sale of 200 made to Mr. Gansham was correctly entered in the sales day book but wrongly posted to the debit of Mr. Radhesham as 20 rupees. Actually, we have to give debit to Gansham. Earlier Gansham account is not debited, now you debit. So Gansham account 200. By mistake, what we did, we have debited Mr. Radhesham account. Now you credit Radhesham account credit 20 rupees. Two accounts mistake. Debit 200 we have given and credit 20. What's the difference? 180 rupees. Give 180 rupees credit to the suspense account. Look at Mr. Gansham account, Mr. to Radhesham account, to suspense account, 20 and 180. Very, very important, students. Next, fourth one. This type of problem you may get for 4 to 5 marks. Total of discount allowed column in the cash book for the month of September 2022 amounting to 250 was not posted. Total of discount allowed column in the cash book is posted to the debit side of discount allowed account. We have not posted, now you post it. Means discount allowed account debit 250, one side error, credit suspense account, over. Discount allowed account debit to suspense account. That's it. So here you need not to prepare suspense account. Why, sir? Why? Because here we don't know whether suspense account is having some balance or not. That's why here we have ignored suspense account. Next, look at illustration 8. Very, very important problem. Mr. Roy was unable to agree the trial balance last year and wrote off the difference to the profit and loss account of that year. Very important. Why? Because actually, if there is any difference in the trial balance, what we do, we transfer that difference to suspense account. But here what they did, the difference in the difference is transferred to the profit and loss account. The difference is transferred to the profit and loss account. Observe carefully. Means in the previous year there is no suspense account. The difference in trial balance is directly transferred to the P&L account. Maybe debit side or credit side, that we don't know. But the difference is transferred to the P&L account. Means in the previous year there is no concept of suspense account. Next year, very, very important. Next year, if you see the word next year, it indicates that it is stage 3 error. In stage 3, what we do, we identify which account gets affected. What is the nature of this account? Personal account, real account, or nominal account? If it is nominal account nature, don't use that account name. Instead of that, use profit and loss adjustment account. Very, very important. He appointed a chartered accountant who examined the old books and found the following mistakes. Okay, fine. Purchase of a scooter was debited to conveyance account 3000. Okay, purchase of scooter was debited to conveyance account 3000. Now what we do, how do we rectify? Simply we rectify scooter account is debit. Scooter account is debited with 3000 to conveyance account. But observe carefully, conveyance account is nominal account. Previous year all nominal accounts gets closed now. This year, that means we are rectifying the errors in the next financial year. So we should not use conveyance account once again. Instead of using conveyance account, what we do, we use profit and loss adjustment account. This concept is very, very important. This is only the difference between stage 2 rectification and stage 3 rectification. So that how do we record the entry? Look at motor vehicle account debit. Yeah. Here last you can observe Mr. Roy used 10% depreciation on vehicles. Means if we record a scooter, 3000 rupees in the previous year, Mr. Roy charged 10% depreciation. Means what is the original value of scooter? Actually 2700 for the next year. 3000 original value minus last year we charged depreciation. If we debit 3000 rupees scooter account, in that case we would have been charged depreciation 10%. Means what is the original value of scooter now? Next year 2700. That's why what we do, 2700 scooter value to P&L adjustment account 2700. Very, very important adjustment it is. Error it is. Next, purchase account was overcast by 10,000. Normally, how do you rectify this one? Purchase account is overcast, reduce. So, purchase account credit 10,000. This is one-sided error. Use suspense account. You may ask, the suspense account closed na sir? Yes, but next year we open suspense account. So suspense account debit, because to complete the rectification entry, we should take some account na. That account is nothing but suspense account. So suspense account debit to purchases. Purchases is nominal account. Yes, sir. So in the place of purchases, what we do? We use now profit and loss adjustment account. Look at suspense account debit 10,000 to profit and loss adjustment account. Next, a credit purchase of goods from Mr. P. What is the entry we should record? Purchases account debit to Mr. P for 2000 was entered as sale. Means P account debit to sales account. Very important. Observe. Purchases account debit 2000 to P account 2000. This is the correct entry, but wrong entry recorded as sales na. So P account debit 2000 to sales account 2000. This is the entry they have recorded. Now how do we rectify this? Simple. Earlier purchase account is not debited. Now you debit purchase account 2000. Earlier by mistake sales account credit. Now you credit sales account, debit sales account 2000 to actually P account we should give credit. How much? 2000 rupees. Earlier by mistake P account is credited. Now P account gives more credit 2000. So total P account gets credited 4000 rupees. But observe carefully here, purchases and sales both are nominal accounts. So in the place of these nominal accounts, what we do is simply we write in the place of purchases and sales, we write profit and loss adjustment account. Profit and loss adjustment account. That's it. Observe. This is the entry we record. This is very, very important. Profit and loss adjustment account debit to P account 4000. P is personal account, na? Yes, sir. Next one. Receipt of cash from Mr. A. Receipt of cash from Mr. A was posted to the account of Mr. B. Actually, we received cash from Mr. A. In that case, what is the entry we record? Yeah, cash account debit to A account. But by mistake, we recorded to B account. B account wrongly credited na. Now you debit. B account debit to Mr. A account. B account debit to Mr. A account. Next, receipt of cash from Mr. C was posted to the debit of his account 500. Actually, we received cash from Mr. C. Mr. C account we have to write on the credit side. Okay, but by mistake we have written on the debit side. How do we rectify? To rectify this, one time 500. To make it correct, more 500 rupees credit. So Mr. C account gets credited. Entry, suspense account debit to C account. Next, 500 due by Mr. Q was omitted to be taken to the trial balance. 500 due by Mr. Q means credit balance na. We forgot. So now we take Mr. Q account credit, suspense account debit. Okay, sorry. Due by Mr. Q na. Due by Mr. Q means he is our debtor. So Q account debit to suspense account. In the place of Q account, which account they have written? Trade receivable account. Next one, sale of goods to Mr. R for 2000 was omitted to be recorded. We sold goods to Mr. R, but we forgot to record. Now you record it. What is the entry we record? R account debit to profit and loss adjustment account. R account debit to profit and loss adjustment account. Why? Why? Because sales account, last year sales account closed now. In the place of sales account, now we use profit and loss adjustment account. Next, amount of 2395 of purchase was wrongly posted as 2593. Actually, amount of 2395 of purchase was wrongly posted as 2593. What is the difference here? So excess posted na, excess amount posted 2593 minus 2395. So 198 rupees extra amount we have posted. Now excess debit is given now. Now you give credit. 198. So suspense account debit to profit and loss adjustment account. Over. After completion of this, prepare profit and loss adjustment account, at the same time suspense account. See, profit and loss adjustment account and suspense account. Here suspense account will not have any opening balance. Why? Because suspense account balance, previous year the difference in trial balance is closed by transferring to P&L adjustment account. That's why suspense account will not show any balance. After posting all the entries, now observe carefully. First post all the entries into profit and loss adjustment account and suspense account. Now come to suspense account here. There is a difference in suspense account now. Observe, total debit minus credit. How much is the difference? 10,698. Now this 10,698 is transferred to Roy's capital account, because suspense account we are closing. Now suspense account closed. Now come to profit and loss adjustment account. Here also we have balanced this profit and loss adjustment account. Total credit 14,898. Debit 4,000. Total credit more. Credit more means profit. How much profit? 10,898. Transfer to Roy capital. Or else what we can do is, the suspense account balance of 10,698 can be transferred to the P&L account, P&L adjustment account also. In that case 10,698 comes here, 10,698. In that case what is the difference? Only 200 rupees is the difference transferred to Roy's capital. Observe here, Roy's capital account credit 10,898, Roy's capital account debit 10,698. What is the extra credit given? Only 200 rupees. Understood? Yes. So this is the problem on stage 3 rectification. We have seen stage 1 rectification, stage 2 rectification, stage 3 rectification. Now the same concept you can apply to n number of problems. This is our rectification of errors chapter. Hope you understood the concept of rectification of errors, and this video will help you a lot. Now we start our new chapter, that is inventories. This is another very important chapter from examination point of view. Look at. Hello students, previously we have completed our discussion with the rectification of errors chapter. Now we start a new chapter, that is inventories. This is very important from examination point of view. Not only from examination point of view, but also from practical point of view also. Why? Because during the year the business will purchase goods and the business will sell goods. At the end of the year, whatever the goods unsold, they become closing stock for the current year, and this is shown on the credit side of trading account. To follow the matching concept, at the same time it becomes current asset for us, and it is shown on the asset side of balance sheet. So that how the inventories are valued, that we discuss in this chapter. Most of the students, they feel difficult, this they feel difficulty in this chapter. Why? Because maybe lack of conceptual knowledge, or maybe lack of understanding the logic behind the valuation of inventory. Okay, but make I will give you the assurance that after completion of this inventories chapter, you can comfortably solve the problems of inventories in the examination. Okay, now look at, in this chapter what we are going to learn. First, we start our discussion with what is the meaning of inventory. After that, how the inventories, or how the cost of inventory is calculated, or calculation of cost of inventory. Nothing but at the time of purchase of goods, we pay amount towards purchase price. But in addition to the purchase price, we have to incur more expenses, some more expenses for purchase of goods, or expenses relating to purchase of goods. All these constitute our cost of inventory. So how to ascertain the cost of inventory, this also we discussed. Next, inventory record system. Whenever we purchase inventory, how these inventories are recorded in our books of accounts, that also we understood. After the types of problems, so how many types of problems we get in the examination, followed by valuation of inventory. That's it. Very simple chapter, but very conceptual chapter. That's why most of the students, they feel this chapter as difficulty. Okay, because various concepts are involved here, right? First, we start our discussion with the meaning of inventory. Accounting standard 2, as 2, valuation of inventory, has given definition for inventory. Look at, inventory can be defined as an asset, as assets. Inventories or assets held for sale in the ordinary course of business. What is the meaning of this? Suppose I have purchased furniture, it is an asset for me. Is it meant for sale? No, sir. It is meant for used in the business. It is not meant for sale. I have purchased a building. Is it an asset? Yes, sir. Is it meant for sale? No, sir. It is meant for used in the business. Now, my business is a computer dealer business. I have purchased computers. Yes, computers are assets. Is it meant for sale? Yes, sir. So, these are nothing but goods for us, inventory for us. I have purchased a computer. It is asset for me, but it is not meant for sale. It is not inventory. It is an asset for us. So inventories are assets held for sale. The business held the assets for sale purpose in the ordinary course of business. I am a furniture dealer. I have purchased furniture, asset, but it is meant for sale, inventory. Okay, so I am a computer dealer. I have purchased a computer. These are assets for me, but these are meant for sale, means inventories. Okay, next, or in the process of production for such sale. In the process of production for such sale means work in progress, in the process of production. Suppose if you take if you take a manufacturer point of view, if you take a manufacturer, what he will do is he will purchase raw material and he will convert those raw materials into finished goods and he will sell the goods. So first what he will do, he will purchase raw material or processed, raw material or processed, and out of the process we get finished goods. Out of the process we get finished goods. Raw material is inventory from manufacturer point of view. At the same time, whatever the goods in the process means work in progress, we call it as work in progress, means goods not yet completed. Goods not yet completed, these are called work in progress. After completion of the production, now we get the completed goods, these are called finished goods. Okay, now here you can observe, inventory can be held as an asset held for sale in the ordinary course of business, nothing but finished goods. Next, in the process of production, nothing but work in progress, these are also inventory. Next, for consumption in the production of goods or services for sale. Consumption in the production of goods or services for sale means nothing but raw material. These are nothing but raw material. So, inventory consists of finished goods, work in progress, at the same time raw material also. In addition to this, in addition to this, other things also considered as inventory. What are they? Including maintenance, supplies and consumables. Other than machinery spares not a part of inventory. Servicing equipment not a part of inventory, and standby equipment. If you take a, so here we can divide the business into manufacturing business and a trading business. First, we divide the business into manufacturing and trading. From a manufacturer point of view, what is the meaning of inventory? Nothing but raw material, inventory, work in progress, inventory, finished goods, inventory, stores and spares, inventory, packing materials, inventory. All these constitute inventory for a manufacturing concern. If you take a trading concern nothing but buying and selling of goods. He will not manufacture now, so that no raw material, no work in progress. So he will have only traded goods, nothing but finished goods. Apart from the finished goods, he may also have some packing materials, cottons. Okay, all these constitute material for the trading concern. So here our discussion is limited to manufacturing and trading concern, not for service oriented, or that means service businesses. Right, now look at, yeah, that's it. Next, we start our discussion with the calculation of cost of inventory. Normally, in a journal chapter, we have recorded transactions for purchase of goods. When we purchase goods, what is the entry we record? Purchases account debit to cash or bank or credit or account. After that, we have paid some carriage or cartage or whatever, some additional expenses to bring the goods from the place of purchase to our business premises. So whatever the expenses incurred in relation to purchase of goods, all those constitute cost of inventory. Again, the cost of inventory is different from a trading concern and manufacturing concern. Why? Because manufacturing concern, he will purchase raw material. He will purchase raw material and he will incur some amount on conversion of those raw material into finished goods, and he has also incurred some expenses to complete the goods into finished goods. But when it comes to a trader, he will not incur any conversion cost. Why? Because he will incur only purchase price plus some additional expenses to purchase the inventory. All these like taxes, tax, duties, any duties or any customs import duty paid or any customs duty paid, at the same time any taxes paid, all these are part of cost of inventory. Okay, but here the cost of inventory will not have any relevant. Why? Because we are discussing from examination point of view, so that just know what is cost of inventory, that's it. We are not digging the concept of cost of inventory. Right, now look at here. Yeah, how to calculate cost of inventories? Observe carefully. As per accounting standard 2, the cost of inventories should comprise, just a minute, all cost of purchase means purchase of raw material, cost of conversion, nothing but raw material is converted into finished goods, primarily for finished goods and work in progress. This is from a manufacturer point of view. And other cost incurred in bringing the inventories to their present location and condition, nothing but administration cost. Next, cost of purchase consists of the purchase price. Yes sir, this is the amount directly payable to the vendor or supplier. Next, duties and taxes, add any freight inward, cartage inward, whatever it may be, add. Next, all trade discounts, rebates and duty drawbacks and other similar items must be deducted from cost of purchase. Why? Because of trade discount, what happens in the journal chapter already we discussed, trade discount is deducted from the list price, it is not part of cost purchase price. Okay, that's why any deductions we have to minus, then we get a purchase price. Next, cost of conversion already we discussed. If you observe in the final accounts of manufacturing concern, there we have discussed material cost, labor cost and other expenses. Whatever apart from material cost, whatever the other cost we have incurred, that is nothing but cost of conversion. This is from a manufacturer point of view, not from a trader point of view. The cost of conversion of inventories includes cost directly related to the unit of production, such as direct labor cost and allocation of fixed and variable overheads. Other costs you can observe here, some administrative cost. Okay, interest and borrowing cost. Generally, interest and borrowing cost should not be included in the cost of inventory. Why? Because it is finance cost. It is finance cost, so that it should not be included in the cost of inventory. But but there is some one exception here. There is one exception here. What is that? For items that take a long time to produce and store, there are some products which requires storage, like for example wine, rice or timber. These requires storage. To store the inventory, we need to incur huge capital na? To store the inventory, you need premises. Yes, but what about its purchase price? We have purchased these inventory or we have manufactured these inventories. To store them, we need to incur so huge capital. Na? In that case, there we should also consider the interest and the borrowing cost. That is what they are saying, right? Interest and borrowing cost might be added to the inventory cost. So all these are part of cost of inventory. But in the examination, they will not ask you calculate cost of inventory. Even though they ask this question, they give you some amounts and the purpose for which it is incurred, and they ask calculate cost of inventory. In that case, check first whether it is a manufacturing concern or non-manufacturing concern. If it is a manufacturing concern, then cost of inventory comprise of cost of purchase, cost of conversion and other cost. If it is a trading concern, only it consists of cost of purchase of goods. Cost of conversion, no relevant, but other cost, yes, it is relevant. Based on that, we can use some common sense and calculate the answer. Next concept, that is inventory record system. Generally, if you observe, whenever we purchase goods, what is the entry we record? Purchases account debit to cash or bank or supplier account. This is the journal entry we record. But but when we want to maintain some proper recording of inventory, then we have two methods of inventory. See, forget about journal entries. Here we are not discussing journal entries, students. Inventory record system means here we are not uh, thinking about from journal point of view. Inventory record system we are talking about. Here we are not talking about how the journal entries are recorded for inventory purchase. No, that is different, and this inventory record system is different. Here you should understand the concept, right? So to record the inventory, we have two systems generally. One is periodic inventory system and perpetual inventory system. Sir, what first, let us try to understand what is perpetual inventory system. See, to record inventory means generally we purchase inventory and we sell inventory. If you think from a trader point of view, suppose if you think from a manufacturer point of view, what happens is we purchase inventory and the same are issued to production. Hope you are following. If you are a trader, purchase, sale. If you are a manufacturer, purchase of raw material and issue of raw material to the production department. This is happened. So if you maintain a proper record for each purchase and issue or purchase and sale, we are recording whenever we purchase goods, we are recording whenever we issue goods to the production. At the same time, we are recording whenever we sell goods. If you follow this system, then it is called perpetual inventory system. So under perpetual inventory system, control over the inventory. We can control the inventory. Why? Because we are recording each fact, purchase, issue or purchase, sale. Under periodic inventory system, what happens is, and under perpetual inventory system, suppose I have purchased 100 units. Observe carefully. I have purchased 100 units and I have issued 50 units to the production. 50 units to the production. So automatically here you can calculate remaining 50 units as closing inventory. Closing inventory. So on the spot you will get the information about closing inventory. That means unsold stock or raw material which is remained in the store. 100 units purchased, we made a record. 50 units issued, that also recorded. Remaining how many units left? 50 units. Hope you are following. But under periodic inventory system, what happens? There is no proper record of inventory. Means we purchased goods, no proper record. We sold goods, no proper record. Relating to inventory we are talking, not relate. Don't relate this concept with journal chapter. I repeat, don't relate this concept with journal chapter. Do remember, journal entries are different, inventory record systems are different. Next, periodic inventory system means what we do is periodically we fix a time. Periodically, every month or every quarter or once in a 6 months or at least at the end of the year, what we do is we count the goods physically. We count the goods physically. Physically, we count the goods. Number of item name, item name, quantity. Like this we make a list of items and its quantity, and we make a record, and we calculate the closing inventory by following periodic inventory system. The whole concept of inventory tells us how the closing inventory is valued. The whole inventories chapter tells us how closing inventories are valued. Very, very important. For that purpose, we are talking about inventory record system. So there are two systems of recording inventory. One, periodic inventory system, perpetual inventory system. Under perpetual inventory system, what happens? We maintain inventory records. Inventory records. Books of accounts different. Inventory records are different. We maintain inventory records. In those records, we record purchase of inventory, issue of those inventory to production. At the same time, or if you are a trading concern, purchase of goods, sale of goods. But under periodic inventory system, no such record is followed. Only after a certain time period, we count the inventory physically. We take those inventory as those inventory as our closing stock. But under perpetual inventory, the difference between the difference between goods purchased and issued taken as closing inventory. Look at periodic inventory system. Before that, we discuss first perpetual inventory system. Observe carefully. Under this system, the inventory ledger is maintained to record the inventory ledger. What we do? We maintain inventory ledger to record the inventory of goods after each receipt and issue. Receipt means purchase, issue means issued to the production. Next, the cost of goods issued is directly determined and inventory in hand calculated as residual amount. Nothing but just now I have explained 100 units purchased minus 50 units issued to the production. For 100 units we have a record. For 50 units also we have a record. Balance amount is nothing but what? Residual amount. Nothing but what? 50 units left. This is nothing but our closing inventory. So under perpetual inventory system, how the closing inventory is calculated? Tell me. Opening inventory plus purchases during the year minus cost of goods sold. Cost of goods sold is nothing but we have issued 50 units. We have issued 50 units into what is the each unit price? Let us say 100. Then cost of goods sold, nothing but 5,000. Opening inventory, let us say 100 units plus purchases during the year 1000 units. So here I am discussing in terms of units. Units can be multiplied with the cost price. Okay. So 100 units opening stock plus 1000 units during the year purchased minus 900 units sold during the year. So how many units left? Tell me. 200 units left. These 200 units are called closing inventory. Multiply with the cost price. That's it. Cost price per unit. This is under perpetual inventory system. But under periodic inventory system, what happens? Here there is no proper record. Na? Here there is no proper record. So here what happens? Whatever the opening inventory information, we know that how many units we have at the beginning of the year plus during the year how many units purchased. So we will have purchase invoices. Na? So during the year we count how much goods purchased minus at the end of the year physically we calculate inventory. Now physically we count the inventory, yes, minus closing inventory, so that cost of goods sold is calculated as a residual amount. Observe carefully. Under periodic inventory system we calculate cost of goods sold because closing inventory is valued at the end of the year by taking physical count. But under perpetual inventory system, closing inventory is nothing but the residual amount. Residual amount, purchases minus issued. Very, very important. Next, Now we discuss how the inventory ledgers maintained, or how the inventory ledger maintained means. Observe carefully. I will take one problem first, then you can understand how the inventory ledger is maintained. Observe illustration 11. This type of, sir, you are missing LIFO method, FIFO method, simple average. I have seen, sir, LIFO method, FIFO method, simple average and weighted average. Wait, I will come to that point. First you observe how the inventory is recorded at the time of purchase and at the time of issue. And this 11th point is from a manufacturer point of view. 11th problem, manufacturer point of view. When you are solving problem, think that whether this problem is from manufacturer point of view or a trader point of view. That is very, very important. Okay, now 11th problem is from manufacturer point of view. Observe carefully. Continue illustration 11 here. Observe carefully. If you can observe illustration 11, then you can come to know that why this FIFO method, LIFO method, weighted average, simple average method came. Look at the following are details of a spare part of Sriram Mills. Fine, it is a spare part, details of a spare part. Observe the dates here. The dates are in chronological order. 1/1/2021, opening inventory nil. We don't have any opening inventory. And first, on the same date, we have purchased 100 units at 30 per unit. Now, you people tell me, normally if you want to write journal entry, then how do you record the journal entry? Simple, purchases account debit to cash or bank or supplier account. 100 units into 30, 3000 rupees over. But how the same information is recorded in the inventory ledger? That is important. Now, look at first. Learn how to draw the inventory ledger. It consists of total 4 columns. 1, 2, 3, 4. 4 columns total. First column is meant for a date. Second column is meant for writing receipts whenever you receive any goods. Third column is meant for issues. And fourth column is meant for writing balance. Receipts minus issues. Remaining nothing but balance. Next, each second column, third column, fourth column again divided into sub columns, 3 sub columns. Look at units, rate, amount, units, rate, amount, units, rate, amount, sub columns. First learn how to draw this format. Now look at, whenever you receive any goods, first write it in the receipts column, then after write down the ultimate balance. Next, whenever we issue, write down in the issue column. After issuing the inventory, write down the balance of the units left. Okay, now look at 1/1/2021. We don't have any opening balance now. Opening balance nil. Next, on the same date, how many units we have purchased? 100 units we have purchased. Write down in the units column. At what price we purchased? 30 rupees. What is the amount here? 3000. After each receipt or issue, we have to write the balance. Now receipt completed, immediately write down the balance. Balance, how many units left? 100. How much amount? 30 per unit. What is the amount here? 3000. Next, over. Next one, look at. On 15/1/2022, what happened? Issued for consumption 50 units. How many units issued? 50. But price they are not giving. Look at how many units we have issued? 50. Right. Now observe here. Yes, this is issue na. Write down this in the issues column. 15/1/2022. How many units issued? 50. At what price? 30. Each total amount 1500. After completion of issue, now calculate the remaining units left. Sir, previously I have 100 units, sir. 50 units issued, sir. Remaining units left 50. At what price? 30 rupees. Previously at what price we have? 30 rupees. And the remaining stock left 1500. If I ask on 15/1/2022, 15/1/2022, if I ask what is the closing inventory? 15/1/2022, if I ask what is the closing inventory, sir, closing inventory is 50 units, sir. Each unit 30 rupees, sir. So 1500 is the total closing inventory, sir. Is it possible to say closing inventory at any point of time? Yes, sir. That is the main advantage of this perpetual inventory record system. Next, observe. Next date 1 2 sorry 1 to 2022. Again we have purchased 200 units at 40 per unit. Record chronological order, don't forget. 1 to 2022, 200 units purchased, 40 rupees, total amount 8,000. Now how to write the balance? Here we have two different quantities. One is 50 quantity, another one is 200 quantity. At the same time, two different prices. I have purchased 50 units at 30 rupees and 200 units at 40 rupees. Now look at the balance column. First I am writing 50 units at 30 rupees, total amount 1500. Next I am writing 200 units, 40 rupees, 8,000. If I ask what is your closing inventory, tell me what is your answer? Sir, the closing inventory total is 250 units, sir. Closing inventory in terms of quantity 250 units, sir. And tell me in terms of amount. Sir, in terms of amount, the total amount is 9,500, sir. How? 1500 plus 8,000, total 9,500 now. Yes, this is another important aspect. Next step. Now the concept comes, real concept comes. Look at. On 15 to 2022, what happened? Issued for consumption 100 units. How many units issued? 100. Now the problem comes. Look at 15 to 2022. How many units I am issuing? 100 I have to issue. But here I have two different quantities, 50 quantity, 200 quantity, plus two different prices, 30 and 40. Now the question comes, which units we issue first? Which units we issue first and at what price we take it? That is the concept. Generally, you people, what you do? Sir, whatever the old stock we have, the same old stock we issue first, sir. Okay, fine. You issue old stock first. Sir, 50 units old stock I have. First, I will issue those 50 units old stock for the consumption. So, 50 units into 30. How much? 1500. I need more 50 units to issue, na? Yes, sir. And the remaining 50 units I will take from 200 lot. 50. At what price? 200 units purchased at what price? 40. Total 2000. Understood here? So here first I have issued units to consumption for consumption out of old stock. Old stock means first in, first out. Old stock means first in, first out. Means whatever the units I have purchased first, I will issue for the consumption first. This is the assumption. And this method is known as FIFO method. Okay, so under FIFO method, what happens? It is just an assumption. Actually, this 250 is one lot. That's it. 50 units plus 200 units. Units we will mix up. But when it comes to price, which price I should take, I should consider. That is the problem comes. That is the problem comes. Okay, so 50 units, 30. At the same time, 50 units, 40. Total quantity issued 100. Total amount issued 3,500. To calculate this amount, we need price. That is the FIFO method. Now, how many units left? 50 units already issued for consumption. No 50 units. Ignore. Next, I have 200 units. Out of 200 units, I have issued for consumption 50. Remaining units left 150. Price 40 rupees. Total goods left 6,000. If I ask on 15th February 2022, what is your closing stock? Tell me, what is your answer? Sir, closing stock is 150 units at 40 rupees. 6,000, sir. So at any point of time, you can calculate closing inventory, and the same closing inventory you can take it to the books of accounts. Next, last date, observe 20th to 2022. What happened? 20th to 2022, again issued for consumption 100 units. Observe, issues now 20 to 2022, 100 units issued. Actually, previously, how many units we have? 150. Only one lot. Only one lot. At what price? 40. 4,000 units left. Out of 150, 100 units issued, remaining units left 50. Price 40 rupees, total 2,000. If anybody asks what is the closing inventory on 31st March, after 20th February, there are no transactions. Now assume we are closing the books of accounts on 31st March. If anybody asks what is your closing inventory, our answer is very, very simple. What is our answer? Sir, 50 units at 40 rupees, 2,000 rupees is our closing inventory, sir. If you follow this technique, then this is called first in, first out method. First in, first out. Here, what is our assumption? Whatever the units we have first, as the same units we are issuing for consumption first. And finally, whatever the units left, they are out of recent purchases. Recent purchases means, what is the recent purchase here? 200 units is the recent purchase. Out of these 200 units, how many units left now? 50 units. Observe carefully. This is our inventory record system, perpetual inventory record system. Very, very important. This type of problem you may get for 4 marks. If you follow reverse strategy means the first one, this one is same, this one is also same, third one is also same, but when it comes to 15 to 2022, when it comes to 15 to 2022, instead of issuing stock from old stock, if I start issuing stock from latest purchase, I am not taking old purchases, I am considering latest purchases 200. If I issue any goods from latest purchases, then this is called LIFO method. LIFO, LIFO method. Last in, first out. Last in, first out means whatever the fresh units we have, whatever the fresh units we purchased previously, we issue to the consumption the same fresh units. You may ask, sir, what about old stock, sir? Old stock is remained. Actually, it is an assumption. It is an assumption, but practically we issue the stock now. We issue the stock. Practically we issue the stock. There is no difference between this unit and that unit. Practically we issue, but when it comes to calculation purpose, this difference FIFO and LIFO method. Hope you are following. Yes, but this LIFO method is not considered. Ignore LIFO method. LIFO method is not considered. Another important method we have, that is weighted average based method. This FIFO method somewhat, you may follow FIFO method or you may follow weighted average method. Sir, which method is better, sir? Weighted average method, weighted average basis is very, very important. So how this method is followed, that we discuss now. Look at. Now observe carefully. Here we have ascertained inventory on 31st March 2022. How many units left? 50 units, sir. Each unit price is how much? 40 rupees, sir. Total value of inventory is how much? 2000. And tell me, here we have maintained inventory register or inventory record, inventory ledger, and we are also ascertaining the inventory here itself. That too, here we valued inventory at what price? The price which we have paid originally. 40 rupees is the price paid originally. This is called historical cost. This 40 rupees is called historical cost. Means here we are valuing inventory at its historical cost or at its original price. That's why these methods are called historical cost methods. Here we are valuing inventory at what price? The price which we have paid originally, means historical cost. That's why these methods are called historical cost methods. Observe carefully. Inventory valuation techniques, historical cost methods. Hope you are following. FIFO method we are following, LIFO method and weighted average. Now observe, we try to solve the same problem by applying weighted average basis. So what is the meaning of weighted average basis? Here we value the inventory at a price which we calculate, by applying a formula. Observe here, under FIFO method, what we have considered? Tell me. Here we have taken at a different prices. The issues are taken at a different prices. Hope you are following. And to avoid this, what we do now is we apply the weighted average price technique. Weighted average price. What is the formula for weighted average price per unit? Total cost of goods available for sale during the period divided by total number of units available for sale during the period. To put it simple, here we have goods at two different prices. Now we make it one price. How, sir? Total value of inventory, how much? 9,500. So 9,500 divided by total quantity available 250. 9,500 divided by 250. Whatever the price we get, that is our weighted average price. And we issue the goods at this price, weighted average price. Clear? Now look at. Observe illustration 2. Same information, but here we have followed FIFO method. Here we follow weighted average basis. I am discussing only these two techniques. I am not discussing FIFO and simple average. Okay. Now look at weighted average basis. Same table. On 1st January, there is no opening balance. On 1st January, we have purchased 100 units. When the requirement of weighted average price comes, only when we have different quantities at different prices. In that case, we make it as one price, right? So 133,000. On 15th one, we have issued 50 units at 30 rupees. Total amount 1500. Here also we are not finding any difficulty. On 1st February 2022, we have purchased 200 units. Each unit price is 40. Now here we have two different prices now, balance. Earlier balance is at 30 rupees price. New purchases are at 40 rupees price. In this case, what we do? Simple. Earlier quantity 50, purchased quantity 200, total quantity 250. Okay. Earlier amount 1500. Now newly purchased goods cost 8,000, total 9,500. In that case, calculate weighted average price. 9,500 divided by 250, that comes 38 rupees. This is the weighted average price. This is the weighted average price. In case of simple average, what we do? Simply we take the prices, number of prices, 30 plus 40 divided by number of prices 2. In that case, what we get? 35 rupees is the simple average price. 35 rupees is the simple average price. But here we are calculating weighted average. Simple average price is not followed, but weighted average price is followed. Now observe carefully. Next one, 15th February 2022. How many units we are issuing? 100. Under FIFO method, we have two different prices. That's why what we have assumed, first the old stock is cleared. After that, new stock is cleared. But here what we do? We are mixing the quantities. That's why out of 250, directly we are issuing 100. And we calculated weighted average price 38. And we are writing the same price 38. Total 3,800. Next one, 20th to 2022. And what is the balance? 250 minus 100. Balance is 150. Same price 38 amount. Don't forget, sometimes here we get the price in decimals. In that case, the total, the decimal price is multiplied with the quantity. In that case, you may get the amount in differently. But make sure that this total amount should match. Next one, 20th February, we have issued 100 units. Out of 150, we have issued 100. Price is same 38, 3800. Remaining quantity left 50. Price 38. Amount is 1900. And if anybody asks what is the inventory on 31st March, we can say that we have 50 units left at 38 rupees per unit, total 1900. What is the difference between FIFO and LIFO? Under FIFO method, the cost is 2000 rupees, inventory cost is 2000 rupees, but under weighted average price method, the cost is 1900. Under both the methods, we valued inventory at its original cost, only, because 38 rupees is the original cost, but we have averaged. So when you change the method, what is your observation? When you change the method 2000 and 1900 here, FIFO method and weighted average method, the amount of inventory is changing. Observe. When you change the method, automatically the amount of inventory also changes. This is your next observation. Next, sir, when do we follow this method, sir? Like historical cost method. When? Because here, if the inventory is ordinarily interchangeable, I repeat, inventory is ordinarily interchangeable. Means, suppose we are selling water bottles. Observe. Now, what is our inventory? Water bottles are our inventory. Water bottles contains, substance is same, water, but branding is different. Kinley water, okay, Aquafina, next Tata Copper. Like this, we have some 4-5 brands of water bottles. Here, suppose if Kinley company water bottles are not available, then this other company water bottle, suppose Tata Swatch, this can be substituted with that. This is called inventory ordinarily interchangeable. Suppose a customer came and asked, sir, give me Kinley water bottle. You said, sir, Kinley water bottle is not available, but Tata Swatch water bottle is available. Now, he will take that water bottle. These are nothing. Kinley water bottle and Tata Swatch, Aquafina, water Bisleri, all these are water bottles inventory. But branding is different. And these inventories are interchangeable. In the place of Kinley water bottle, I can sell Tata Swatch water bottle, interchangeable. And suppose I am running a cement shop. There are cement substance is same, but there are different brandings. Suppose Nagarjuna cement, next ACC cement or Birla cement. Like this, we have different Anjana cement. Like this, we have different cement bags. But now these cement bags also ordinarily interchangeable. Suppose somebody asks, give me Birla cement. You can say, sir, Birla cement is not available, but ACC cement is available. If the customer is in need, then what he can do? Instead of taking Birla cement, he can take ACC cement. Na? So inventory ordinarily interchangeable. If the inventory is ordinarily interchangeable, then we follow these methods. If inventory is not ordinarily interchangeable, then directly we follow specific identification method. Specific identification method means we directly identify the inventory and we ascertain how much cost we have incurred on purchase of those inventories. I can give you one more example also. Suppose let us take rice bags. Different brands of rice we have. These are ordinarily interchangeable. If one brand rice is not available, then we can take other brand rice. Na? Inventory ordinarily interchangeable. In this case, we follow first in first out, and normally we follow historical cost methods. In case of inventory not ordinarily interchangeable, we follow specific identification. If inventory is ordinarily interchangeable, then we follow this FIFO, LIFO and weighted average prices. Okay, now from examination point of view, this is very, very important. We value the inventory. If you observe in a problem number 11 and 12, we valued inventory at what price? Cost price. But now what we are going to do is, we are valuing inventory but not at its original cost. What we do is, This method is called adjusted selling price. Very, very important technique it is. Sir, what is the procedure followed here? Means very simple. Look at here. I have given the types of problems. Types of problems. One is preparation of inventory ledger and valuation of closing inventory. Just now we have seen. Next one, valuation of closing inventory by adjusting its selling price. You may think here, if it is possible to value the inventory at its original cost, here it is historical cost. Historical cost. If it is not possible to value the inventory at its historical cost, then what we do is, first we take the inventory at its selling price. This method is also called as retail inventory method. Retail inventory method. Observe carefully. And this method is followed in case of retail industry, where the number of items are more. If you take for example DMart. In DMart there are some thousands of items in different quantities. It is not possible to remember all the units cost price. And if you observe when you go to DMart or Reliance Smart or whatever big supermarkets, just observe there, they will give you bill. Yes or no? After purchase of goods, they will give you the bill. The bill contains item name, how much quantity purchased, and at what rate it is purchased. That means selling price. If you look at the system shows how many units left in the store. After selling, suppose after selling one rice bag, the system shows how many rice bags unsold. And this is the unsold stock, closing inventory. And the system will not show the cost price of goods. System will show the selling price of goods. Like that, what we do is we take a list of items and the quantity left and its a selling price. In this case, what is happening? We are having closing inventory, but at what price? Selling price. I repeat, we are having closing inventory, but at what price? Selling price. Because the purchase price is not available. Purchase price is not available, or it is not possible to ascertain the goods at its cost price. In that case, the retail inventory method technique is followed. Here we have closing inventory, but at what price? Selling price. You people tell me, selling price of goods consists of two elements, two components. One is cost element, another one is profit element. Now what we do is, the selling price of goods, from the selling price of the goods, if you can eliminate profit, automatically the closing inventory shows at what price? Cost price. This is the technique which we are going to follow now. And this technique is also called as what? Adjusted selling price, or retail inventory method, Is it clear, students? Yes. Now look at. Now we discuss inventories problem solving technique. Already we have discussed BRS problem solving technique. Rectification of errors problem solving technique. Now we are going to discuss inventories problem solving technique. Normally we have different types of problems now. First one is preparation of inventory ledger and valuation of closing inventory. Here comes preparation of inventory ledger. Already we discussed. Here it is not a technique, students. Simply we prepare inventory ledger either by following FIFO method or LIFO method or simple average or weighted average. But the real concept of valuation of inventory technique comes here. Second one and third one. Second one is valuation of closing inventory by adjusting its selling price, and next one is inventory taking. First we discuss valuation of closing inventory by adjusting its selling price, where where it is not possible to value the closing inventory at its cost price, then we use this technique to remember. If it is possible to value the inventory at its cost price, we follow historical cost methods. If it is not possible to value the inventory at its original cost price, then we follow adjusted selling price method. In case of adjusted selling price method, there are two situations. One, closing inventory or closing stock given at selling price. We discussed already, closing inventory physically we can count, or the system shows, the computer shows closing inventory as on so and so date. If you follow perpetual inventory system, perpetual inventory record system, if you follow this, then the system shows how much quantity left, what is the selling price of the goods, what is the selling price of the goods. This is closing stock given at, sometimes closing stock is given in the problem itself, but at what price? Selling price. We have to value the closing stock at what price? Cost price. But here the closing stock is at selling price. Then what is the approach we follow? Next, look at the problem that sometimes they will not give you closing stock information. They will not discuss about closing stock. Look at, closing stock information is not given. In that case, what is the approach we have to follow? There are two approaches, students. First approach, calculation of closing inventory when closing stock information is given. Now tell me, closing stock, we have closing stock at what price? Selling price. From the selling price consists two components. One is cost, another one is profit. From the selling price of inventory, if you eliminate profit, then automatically whatever the closing stock is in your hand, that is at what price? Cost price. This technique we follow here. Now take sale value of closing inventory minus gross profit included, or gross profit margin on the above inventory. Here the question comes, sir, how can we get gross profit margin? Sometimes the gross profit margin is given in the problem itself. Otherwise, you should calculate gross profit margin. The formula for calculation of gross profit margin is equal to gross profit divided by sales. Gross profit divided by sales. Here again the problem comes, sir, how do we get the information about gross profit? If you don't have any information about gross profit, then calculate. So gross profit is equal to, how can we calculate gross profit? Gross profit is nothing but the difference between selling price minus cost. Gross profit is nothing but what? Selling value, sales value minus cost of goods sold, or cost value. Here what we do is, we take total sales including closing inventory at selling price. This is very, very important. Here we take total sales. Total sales information is given in the problem. Means sales information is given in the problem, and closing stock is also given in the problem at selling price. Now, in that case, what we do is, we assume that the closing stock also sold. We assume, it is just an assumption, that the closing stock also sold. In that case, the total sales comes after adding closing stock at selling price minus COGS. COGS nothing but opening stock plus purchases. Opening stock plus purchases. Here closing stock is zero now. Why? Because closing stock we assumed that sold. Even though you have closing stock, but what is our assumption? Closing stock, all closing stock sold. In that case, cost of goods sold is equal to opening stock plus purchases. If any expenses are given, add direct expenses. This approach you have to follow. Simple approach. Observe. First one, this is the direct calculation. Sale value minus profit. Then whatever the stock you have in hand, that is at cost price. If gross profit margin is not given, then calculate. For calculation of gross profit margin, what is the formula? Gross profit divided by sales. So for calculation of gross profit, then what is the formula? Total sales minus cost of goods sold. Means first you should calculate this one. Second, you should calculate gross profit margin. And third one, you have to calculate this calculation. This is the problem solving technique. Simple. And this concept or this knowledge you can apply to illustration 6. Follow this one. Follow this concept and apply the same concept to illustration 6. Observe carefully. Mrs. XYZ or in retail business, following information is obtained from their records. Okay, goods received from suppliers subject to trade discount, packaging, sales during the year, sales price of closing inventory. Means closing inventory is given, but at what price? Selling price. Find out the non-historical cost. This is the hint. Whether to follow historical or non-historical. This is the hint. Non-historical cost of inventories using adjusted selling price method. Here closing stock is given, then which approach we follow? First we calculate gross profit. How can we calculate gross profit? Total sales including closing stock at selling price minus COGS. Yes or no? So here we calculated the same. Look at sales during the year, add closing stock, total selling value. What you have to deduct? COGS. COGS is nothing but opening stock plus purchases. In this problem, opening stock is not given. In this problem, opening stock is not given, but purchases are given. Purchases are given indirectly. How, sir? Here they said this is the value of purchase subject to trade discount and taxes. So from this value, what we have to do? First, we have to deduct 3% trade discount. To that value, we add 11% GST. Then we get purchase value. To that, what we do? Packaging and transportation charges we add. Then we get total COGS minus total. Here we have calculated total COGS and this amount is deducted here. Then what you are getting? Gross profit. From this gross profit, what you are calculating? Gross profit margin. Gross profit margin formula: gross profit divided by total sales. Sales includes closing inventory at selling price, and this percentage is applied on closing inventory at selling price. Look at selling price of inventory 2,35,000. On this you apply 28.909% minus. This is the gross profit and this is the closing inventory at cost price. Hope you are following. So apply this technique to illustration 6. Then you can understand. If you get this type of problem now, you can score 4 out of 4 or 5 out of 5. Very, very simple. Next one, second approach. If closing stock information is not given in the problem, then how? If you observe illustration 8, observe illustration 8 once. From the following, read total problem and tell me, do you find any closing inventory or not? From the following particulars, ascertain the value of inventories as on 31st March 2022. Okay, inventory, this is opening stock, purchases, manufacturing expenses, selling expenses, administrative expenses, financial charges, sales. At the time of valuing inventory on 31st March, a sum of 70,500 was written off. Okay, 50,000 and sales, bearing the transaction relating to the gross profit margin 20% on sales. Here gross profit margin is given, but closing inventory information is not given. In illustration 6, sales closing inventory at selling price is given, but gross profit margin is not given. In that case, we have calculated gross profit. Then how can we solve illustration 8 now? Clear? For that, this is the approach you have to follow. How? We know the formula that closing inventory is equal to suppose I have purchased 100 units minus sold 50 units. Remaining 50 units nothing but my closing inventory. Here 100 units are called cost of goods available for sale. 100 units are called goods available for sale. 50 units are called goods sold. And remaining 50 is nothing but our closing inventory. Simple technique. See, cost of goods available for sale minus cost of goods sold. Then you get closing inventory. Yes, sir. So then how can we know that cost of goods available for sale and cost of goods sold? You have to calculate. Cost of goods available for sale is nothing but whatever the opening stock I have plus purchases plus direct expenses. This total consists of cost of goods available for sale. Cost of goods sold, how can I calculate? You know that cost of goods sold formula, opening stock plus purchases plus direct expenses minus closing stock. But here closing stock information is not given. That's why it is not possible to use that formula. That's why we use COGS technique. Other formula. For COGS, other formula is nothing but sales minus profit on sales. COGS is equal to sales. Total 100 rupees is my sales. From sales you deduct profit. Then what is remaining? Cost. So COGS is equal to sales minus profit on sales. In this problem they have given profit on sales na. Sales information is given minus profit on sales. You get COGS. Cost of goods available for sale minus COGS, remaining nothing but your closing stock at a cost price. That's it. Simple technique. But here, very important note point is, if you get any information about abnormal goods are nothing but what? Suppose at the time of valuation of inventory, at the time of valuation of inventory, at the time of valuation of inventory, sometimes we value some goods which are defective or which are not sold at its original cost or at its selling price. Some goods sometimes they become defective. In that case, what we do, we value those inventory at less than the cost price. Sometimes we value those inventory at less than the cost price, and those inventories are called abnormal goods. When you get any information about abnormal goods in the problem, then generally this abnormal goods is included in the opening inventory. Means previous year closing inventory is nothing but current year opening inventory. Generally abnormal goods information is given in the opening inventory. In that case, what we do is, from opening inventory you ignore minus, from opening inventory you deduct abnormal goods plus, and these abnormal goods are sold in the current year. That information also they will provide. In that case, the sales information includes normal sale of goods plus abnormal sale of goods. In that case, what we do, ignore abnormal sales. Ultimately, what we are doing, we are ignoring abnormal goods cost from opening inventory, abnormal goods sales value from sales. Remaining problem is same. This is very important point. You can apply this knowledge to illustration 8. Look at here, at the time of valuing inventory on 31st March 2021. Here they said 1/4/2021 opening. 31st March 2021 financial year, it is closing. A sum of 17,500 was written off on a particular item which was originally purchased for 50,000. How much amount written off? 17,500, but original cost is 50,000. Means the inventory is valued at 32,500, and this is called abnormal goods. 30, so 1,42,100 includes 32,500 abnormal goods. Ignore, immediately ignore. 1,42,500 minus 32,500, ignore. Abnormal goods cost is ignored from cost opening stock, so that, and was sold during the year for 45,000. These abnormal goods are sold at 45,000. Means this sales of 12,45,000 includes 45,000 rupees abnormal goods. Yes sir, immediately ignore. 12,45,000 minus sale of abnormal item, ignore. From opening stock, cost of abnormal item, ignore. From sales, sale value of abnormal item, ignore. This is simple technique. Remaining everything is same. Total sales 12,45,000 minus 45,000 is abnormal sales. Remaining sales are 12 lakh. This is selling value. Look at sales 12 lakh minus profit on sales. In the problem they said 20% is the profit on sales. 12 lakhs into 20%, 2,40,000. So deduct 2,40,000, you get COGS. This is cost of goods available for sale, 10,22,500 cost of goods available for sale, and 9,60,000 is COGS. Remaining amount is nothing but closing inventory. This is very simple technique, students. Hope you understood this technique. Yes, you can follow this technique now n number of problems based on adjusted selling price. Clear? After understanding the technique of solving inventories problem by utilizing adjusted selling price method, now we try to solve some problems. On this technique. Look at illustration 6. Messrs. XYZ are in a retail business. Following information is obtained from their records on 31st March 2022. Goods received from suppliers subject to trade discount and taxes. This much. Trade discount 3% and GST 11%. Packaging and transportation charges. Sales during the year, selling price Sales price of closing inventory. I already said, when you are solving problem on adjusted selling price, check that whether closing stock is given at selling price or not. If closing stock is given at selling price, we have to follow this approach now. Yes, sir. Now look at selling price is given. Find out the non-historical. So this method is also called non-historical cost method using adjusted selling price. So what is the approach we have to follow? Tell me. First we calculate how much gross profit earned by business. After that we calculate gross profit margin. After that, that gross profit margin we apply on the selling price of closing inventory. In that process, first determine what is cost of purchase. Here cost of purchase is given indirectly. Now we are calculating its original cost of purchase. First, goods at a goods received from suppliers 15,75,500. From that, first deduct trade discount 3%. On the remaining balance, generally we charge GST. Then what is my total cost of purchase? 19,69,341. To this add packaging and transportation charges. Additional charges 87,500. Total cost is 17,83,841. After that, calculate gross profit. How do we calculate gross profit? From sales we deduct this cost. So how much is sales? Sales during the year 22, 45, 500. I already said take the closing inventory also. Assume the closing inventory is also sold. Then 2,35,000. Then total sales becomes 24,80,500. From this we deduct 17,83,841 cost. Then gross profit is 696,651. Then calculate gross profit margin. Simple. 6,96,659 divided by total sales are 24,80,500. Here you get 28.09% gross profit margin. Don't forget, don't take simply here original sales, but here take closing stock also at selling price. That is important aspect here. Then we get 28.09%. Now this percentage we apply on the selling price. What is the selling price of inventory? 2,35,000. Gross profit margin 28.09%. We get 66,012. Total 168,988. Very simple and important. Now look at illustration 7. From the following information, calculate the non-historical cost of closing inventories using adjusted selling price method. Here also check whether closing inventory is given at selling price or not. Observe, sales during the year 2 lakhs given, sales 2 lakhs given. Next, cost of purchase 2 lakhs given. After that, opening inventory is given nil, closing inventory at selling price. Closing inventory is given at selling price. Look at 50,000. In that case, what is the approach we follow? First approach. First you calculate gross profit. Yes sir, gross profit is nothing but total sales minus COGS. Total sales here 2 lakhs is the original sales. Assume the closing stock also sold 50,000. In that case, the total sales becomes 2,50,000. From this you deduct cost of goods sold. Cost of goods sold nothing but opening stock plus purchases plus direct expenses. Closing stock is 0. Why? Because closing stock is added to sales value. Yes sir. Opening stock anyway nil. Then what about your purchases? Your purchases are 2 lakhs rupee minus 2 lakhs. Then what is your gross profit? 50,000. Calculate gross profit margin. 50,000 divided by total sales 2,50,000. You get 20% is the gross profit margin. Already we have closing stock at a selling value 50,000. So 50,000 minus 20% 10,000. We get 40,000 closing inventory at a cost value. This is another important problem. Next one. Look at illustration 8. Illustration 8 is on the concept of second one. Second one is what? Closing stock information is not given in the problem. In that case, what is the approach we follow? We follow second approach, already we discussed. Apply this knowledge, that's it. And this point also very important. If you get any abnormal item, then ignore it from opening stock plus from selling value. Observe, inventory on 1/4/2021 142,500, purchases 762,500, manufacturing expenses, selling expenses. Do remember, when you are calculating cost of goods sold or cost of goods available for sale, selling expenses are not considered. Why? Selling expenses, administration expenses and financial charges, these are part of P&L account item. And do remember, if you visualize trading account, here we take only those expenses which are considered in trading account. Hope you are following. Right sir. So selling expenses, administration and financial charges don't consider. Okay. Now sales are 12 lakh 45,000. If you observe in the entire problem, the closing stock information is not given. At the time of valuing inventory on 31st March 2021, here 1/4/2021, here 31/3/2021, that is previous year information. A sum of 17,500 was written off on a particular item which was originally purchased for 50,000. Already I have discussed in the problem solving technique that if any non-movable goods or fast moving goods, if the fast moving goods are sold at its original selling price, but some goods which are not fast moving, they will be sold sometimes at less than the cost price. In that case, those goods are valued at less than the cost price. Actually we purchased those goods for 50,000, but 17,500 were written off. Means at what value these goods were valued? 32,500. This is abnormal item and it is included in the opening stock. You deduct 32,500 from opening stock and was sold during the year for 45,000. Normal goods sold, abnormal goods also sold. Total sales 12 lakh 45,000. This includes 45,000 rupees sales. Yes sir, minus. Bearing the transaction relating to this item, that means except this sale of 45,000, remaining all goods were sold at a 20% on sales. If you observe previous problems, percentage gross profit margin is not given, but now gross profit margin is given, but closing stock information is not given. In that case, we follow a simple approach. Look at a statement is prepared. First, take opening stock. Means what we have to calculate first? Cost of goods available for sale. Cost of goods available for sale formula: opening stock plus purchases plus direct expenses. This we are making in a statement format. Observe carefully. Opening stock is 1 lakh. Opening stock is 1,42,500. From this you deduct book value of abnormal inventory. 50,000 cost, 17,500 write off. Remaining 32,500. Total opening inventory, that means normal goods, 1,10,000. Add purchases, 7,62,500. Add manufacturing expenses. Then we get total goods available for sale. Total goods available for sale, 10,22,500. From this we deduct cost of goods sold. Cost of goods sold, already I said a different formula, that is sales minus profit on sales. How much is sales? 12,45,000. But from this you deduct abnormal sales. Remaining sales are, that means normal sales are 12 lakh minus 2,40,000 is our gross profit on sales. 20% on 12 lakh, 2,40,000. Remaining is 9,60,000. This is the total cost of goods available for sale, 10,22,500 minus 9,60,000 is the cost, deduct, you get 62,500. This is our inventory. Simple. Two methods I have explained. Two approaches, not two methods, two approaches I have explained. Observe carefully. Next, do we have any other problems on this concept? Let me check. Okay, remaining problems are on inventory taking, that we discuss now. Inventory taking, another important aspect in our inventories chapter is inventory taking. Most of the students, they will get confused. They will get confused in this concept. Look at now. Now we try to understand inventory taking concept in the inventories chapter. This is the most important concept in the inventories chapter, and from examination point of view also this is very, very important. To understand the concept of inventories taking, let us look at a small example scenario here. Let us take for example in the year 2020-21 financial year, 2021 financial year. During this financial year, during the year, what we do is we purchase goods and we sold goods. Yes or no? During the year we purchase goods, we make a record in the journal as well as in the inventory ledger. At the same time we sell goods, we record the transaction in the journal as well as we also record in the inventory ledger. During the year this will happen. Purchase of goods, sale of goods. At the end of the year, if you observe, whatever the unsold goods are there, at the end of the year, unsold goods, at the end of the year, We identify how many units are unsold or how much of goods are unsold. Okay, as we are maintaining, assume we are maintaining perpetual inventory record system. I repeat, perpetual inventory record system. What happens under perpetual inventory record system? We make an entry, we record the receipts as well as issues of material. And the difference between receipt and issue is nothing but the balance of the material in our hand. Right? These are as per books. The inventory stock and its price is as per books. Forget about price, come to quantity. The quantity which is shown by the inventory ledger, it is nothing but as per books. But the same quantity, whether we have physically or not, the same quantity of goods we should have physically also. Suppose, to make it simple, as per my cash book, I have 1 lakh rupee cash in hand. As per my cash book, I have 1 lakh rupee cash in hand. If I check physically also, I should have the same 1 lakh rupee physical cash also. Tell me students, physical cash also. My cash book shows 1 lakh rupee cash. If I count physically, I should have 1 lakh rupee cash in my hand. And my cash book bank column shows 50,000 rupees cash at bank. Observe carefully. Cash at bank. Now, how can I cross check that whether I have 50,000 rupees cash at bank or not? So, I will see passbook. Check passbook. If passbook also shows same balance, then my balance is same. Correct. Cash book bank column shows 50,000 rupees cash at bank. For this, what is the evidence that I will check passbook balance na? If I check passbook, if it contains 50,000, then it is good. Otherwise, if my bank balance as per cash book is not same as to passbook, then what I'll do? I will prepare BRS. Like this, we cross check na. As per cash book, 1 lakh rupee cash in hand. Physically, I will count. As per cash book, bank column shows 50,000 cash at bank. I will check passbook. If both amounts are not equal, then I will prepare BRS. In the same manner, when I follow in a perpetual inventory record system, after recording each receipt and issue, the remaining quantity left as unsold. This is the quantity as per books. Now, I will check whether the same quantity of goods is there physically in the store as well as in the godown warehouse. Yes, for that what I have to do? I have to carry on physical inventory verification or verification of inventory physically. Verification of inventory physically. Yes sir, no students? Yes sir. This is the concept of inventory taking. Inventory taking. Verification of physical inventory. This will happen only at the end of the year. During the year we don't need. During the year physical verification will go on. But especially at the end of the year we have to check physical verification of inventory. Whether we have the same quantity of goods shown in the books or not. Now tell me, at the end of the year means 31st March of the year. 31st March of the year. In our example, 31st March 2021 is at the end of the year. At the end of the year, you people tell me exactly on this 31st March 2021, is it possible to close the business and value the inventory physically? To count the inventory physically, I repeat, to count the inventory physically, first what we have to do? We have to shut down our business or we have to close our business on that day. You people tell me, if we close the business on that day, we will lose some revenue. And that too, suppose let us take for example DMart. DMart will have different branches in different localities. On the same day, is it possible to value the inventory? Highly impossible. As on 31st March 2021, it is highly impossible to value to value means to physically verify the inventory. That's why what they do is they physically verify. I'm repeating, they physically verify the inventory either before 31st March 2021 or after 31st March 2021 based on the circumstances. Is it clear? So physical inventory verification done either before 31st March 2021, 1 week or 10 days before 31st March, not 1 month, 2 months, 3 months or 4 months, or after 31st March 2021. Sir, already physical verification of inventory is done, sir. Yes, but we need inventory on what date? 31st March. We need inventory on this date, 31st March. But here physical inventory verification happened either before 31st March or after 31st March. Sir, what we have to do now? Yes, suppose if physical inventory is taken before 31st March, let us say for example, it is taken on 20th March 2021. 20th March 2021. Suppose let us take the physical inventory of goods is 10 lakhs. On 20th March 2021, we have valued inventory at 10 lakhs. But what we need inventory on 31st March 2021. Na? Yes, sir. Now what we do? Whatever the transactions happened between this period, I repeat, whatever the transactions happened between this period, 20th March to 31st March, we adjust. We adjust. See, I will take 10 lakhs rupee. I will add the transaction value which increase stock, which increase my stock, which increase inventory. During this period, some transactions happened. Because of this transaction, my inventory increase. Yes, add. Minus. During this period, some transactions happened which decrease my inventory. Which decrease my inventory. Less. Suppose I have purchased goods during this period some 1 lakh. Because of this, my inventory value increases. Na? So 1 lakh rupee purchases you add. And during this period, I have sold goods worth 50,000 rupees. Sold goods worth 50,000, which include profit of 5,000 rupees. Normally sale value includes profit also. Yes, sir. Because of sales, my inventory goes out now. Yes, sir. Because of this, my inventory value decreases na. Yes, sir. Minus. What is the total sale value? 45,000, sir. Sorry, 50,000, sir. My sale value is 50,000, sir. Okay, my sale value is 50,000, but out of that 5,000 is profit now. Profits we should not include. What is the cost? 45,000, sir. How much cost of goods are sold? 45,000, sir. Now tell me, what is your inventory on 31st March? Nothing but 10 lakh 55,000. This is what we have to do. And this process is called forward reconciliation. This process is called forward reconciliation. Means we have taken inventory on 31st March 2021 and we are going forward on 31st March 2021, so that we have taken inventory on 20th March. Now we need inventory on 31st March. So whatever the transactions happen between 20th March to 31st March, we have to reconcile. How do we reconcile? Tell me. If inventory value increased, add. If inventory value decreased, less. To put it simple, any inflow of goods, add. Any outflow of goods, minus. Any outflow of goods, minus. That's it. Apart from this, we need to adjust some more items that we discuss when it comes to problem. And now come to second point. Suppose if inventory is taken after 31st March, let us say after 31st March, we take the date, suppose 15th April 2021. We have taken inventory on 15th April 2021. But what we need inventory on 31st March 2021. And on this date, the inventory is valued at 10 lakh rupee. On this date, inventory is valued at 10 lakh rupee. But what I need inventory on 31st March. I need inventory on 31st March. Now what I do is, whatever the transactions happened between this period, means 31st March means 1st April 2021 to 15th April 2021, whatever the transactions happened during this period, I will take and I will reconcile those transactions. This is called backward reconciliation. Means inventory is taken on 15th April. From 15th April we are coming back now. From 15th April we are coming back 31st March. This is called backward reconciliation. Here from 20th March we are going forward to 31st March. This is called forward reconciliation. Hope you are following. Yes, sir. So here what we do, all inflows are deducted. Inflow of goods. Actually, whatever the inflow of goods we have from 1st April to 15th April, this comes under next financial year goods now. Yes. So whatever the goods you receive between 1st April to 15th April, you deduct them. Plus outflow. From 1st April to 15th April, whatever the goods we sold or whatever the goods outflow, actually we should have those goods on 31st March. 31st March. All outflow of goods you add. All inflows what I am doing, I am deducting now. So all outflows I have to add. By adding or deducting, by reconciling like this, what we do is we get the inventory on 31st March. This is called backward reconciliation. So what we have to see, first look at the problem and identify whether it is forward, whether we have to do forward reconciliation or backward reconciliation. In case of forward reconciliation, any inflow of goods add, any outflow of goods minus. In case of backward reconciliation, any inflow of goods minus, reverse, any outflow of goods add, plus. Here all outflows must be at cost price. Suppose if you get any information in sales, suppose sales, goods sold means goods outflow. Goods sold is at what price? Sale price. From sale price what you have to do? You have to deduct the profit. You have to deduct profit. Then only you get the cost price of the goods. In case of inflows, anyway the inflows are at cost price. But in case of outflows, the outflows are at sale price. Why? Because we sell goods now. Sale price. That is very, very important. So this is the concept of inventories taking, students. So here I have given some format for forward reconciliation, at the same time backward reconciliation. You can just go through the concept. Okay, straight away what I am doing is I am going to solve some problem here. Look at illustration 9. A trader prepared his accounts on 31st March each year. Okay, due to some unavoidable reasons, no stock taking could be possible till 15th April. Means on which date we valued inventory? 15th April. Actually we close books of accounts on what date? 31st March. So 15th April goods physically verified means after 31st March. Now we have to come back from 15th April to 31st March. This is backward reconciliation. First you identify this. Next, on which date the total cost of goods in his godown come to 50,000. On 15th April, how much goods we have? 50,000 worth of goods we have. The following facts were established between 31st March to 15th April. The following things were happened. Tell me, sales. Sales means outflow. All outflows are added. All inflows are deducted. Outflow how much? 41,000. This is at selling price, but we need cost price. From 41,000 we deduct profit. Next, purchases 5,034, including cash purchase, whether it is cash purchase or cash sales or credit purchase, whatever it may be, purchase na? Yes sir, purchase. This is what inflow. Inflows are deduct, outflows are add. Sales return. Here sales return means inflow of goods. I repeat, sales returns means inflow of goods. Yes, sales returns, it is at what price? Selling price. What you have to do, from 1,000 rupees you have to minus profit, then you add back, sorry, you deduct inflow now. Or you can do one thing, sir, sales are 41,000 na sir, yes. Returns are 1,000 na sir, yes. You deduct 1,000 rupee from 41,000. Then net sales how much? Sir, net sales are 40,000 sir. You take net sales. Why should we add 41,000 rupees and why should we deduct 1,000 rupees? You take net amount na, 41,000 minus 1,000, 40,000 you take net amount. Yes. So this is very, very important. From sales, what we do? We deduct sales returns. Next. On 15th March, goods of the value of 10,000 were sent on sale or return basis to a customer. The period of approval being 4 weeks. See, this is the concept of sale of goods on approval basis. What we do is, today we send goods. We record it as sales. Means customer account debit to sales. But we allow some time to the customer whether to accept it or reject it. It is just like our e-commerce sales. In e-commerce sales, what happens? Amazon, let us take for example Amazon. Amazon will deliver goods to the customer. Customer will pay the amount. And Amazon people will allow some time to us to return the product. Within that time, if you don't like the product, you can return. You get your money back. If you don't return within the time, then Amazon will treat it as actual sales. Here also the same concept apply. But initially the customer will not pay any amount to us. So what happened here? On 15th March, we sent goods 10,000 rupees to our customer on sale or return basis. Within the due date, suppose 31st March, we are closing the books of accounts. 31st March, we are closing the books of accounts. Within this date, if customer is unable to return the goods, but still he has some time, to return, but 31st March, he has not returned. He has some time even in the next financial year. In this case, what we have to do? Very important. On this date, first we have to cancel the sales. Earlier we recorded entry for sales. On this date, now you cancel the sales. Entry, sales account debit to customer account. Means sales we have to minus. Next step. The period of approval being 4 weeks, he returned 40% of the goods on 10th April. Already he returned 40% of goods. Now tell me how much of goods he is having. 60%, approving the rest. The customer was billed on 16th April. Means these sales we consider in the April month. But here you need to understand one thing. Total we have sent 10,000 worth of goods minus he already returned 40% goods means 4,000. Already this 4,000, already 10,000 is included in sales. 40% he returned, remaining goods not returned 6,000. Remaining goods not returned 6,000. Now you people tell me how much of goods he is having. 6,000. Who is the owner of these goods? He has not approved. When he become owner, only when he approves the goods. Only when he approves the goods, he becomes the owner. Till he approves the goods, he is not the owner. 4,000 rupees goods he returned. Remaining 6,000 he has not returned. Who is the owner? We are the owner. Even though the goods physically held by the customer, but we are the owner. On 31st March, we have to show these goods also in our books of accounts. This is the concept of goods sold on, goods sent on sale or approval basis. But 6,000 is selling price. From 6,000 rupees you deduct profit. From 6,000 you deduct profit. Remaining amount is added to our stock. This is very, very important, students. This D point is very, very important. Right. The trader had how much profit we have charged with. See that. The trader had also received goods costing 8,000 in March for sale on consignment basis. See, consignment basis, somebody will send goods to us. We sell those goods for a commission basis. We are not the owner. In case of consignment goods, what happens? We received goods on consignment basis. We are consigning. And the person sent goods is consignor. As consignee, we sell goods on behalf of consignor. In return, we receive some commission. But we are having 8,000 rupees worth of goods. We are not the owner. Physically, we have these 8,000 rupees worth of goods. But who is the owner? Somebody is the owner. We are not the owners. So 8,000 rupees we have to deduct from our stock. This is very important. Next. 20% of the goods had been sold by 31st March and another 50% by 15th April. These sales are not included in the above sales. Means If nothing is sold out of this 8,000 rupees, total 8,000 rupees are deducted. But out of 8,000 rupees, 20% already sold. Look at the calculation here. Out of 8,000, already 20% sold, means 1,600. Remaining we have 6,400. And again 50% goods sold on 15th April. 50% not on 6,400, 50% on 8,000. So 4,000 rupees sold. Remaining unsold goods are 2,400. Now we are having this 2,400 worth of goods physically. We are not the owner. So that minus. We are not the owner now. If we are the owner, we have to show these goods in our books, but we are not the owner here. So that we should not show this 2,400 goods. Now look at the statement. Very, very important, students. Okay. So first you have to go through this table. Then you can understand why we are doing all these things. Next, backward reconciliation also I have given a clear cut table here. So go through this table once. Next, first we start with the stock on 15th April. What are the things we are adding? Tell me. Sales. Look at cost of sales. Sales are 41,000 minus sales written 1,000. Remaining sales are 40,000. What is the profit here? 20% on sales profit. So 8,000. This is our cost. This much of goods we are adding back. Next, cost of goods sent on approval basis. Cost of goods sent on approval basis. Tell me, out of 6,000, sir, how do we get this 4,800? Look at total goods sent 10,000 minus 4,000 goods already he returned na, means remaining 6,000 into how much profit we added? 20%. Profit 20% means remaining for 80% cost. So 80%, 4,800. Even though we are not holding the goods, but we are the owner. We are the owner, so we have to show these goods as our goods. Next, less. Purchases during 15th April to 31st March, means 1st April to between 1st April to 15th April. How much goods we have purchased? 5,034 minus. Just a minute. This 5,034 we have to write here. 5,034. Next, we are having consignment goods, because consignment goods are not our goods. You can look at here. This is backward reconciliation. This is backward reconciliation. Look at. Deduct any goods held on consignment basis. Backward reconciliation. Deduct any goods held on consignment basis. That is what we are doing. On consignment basis, how much worth of goods we are having? Total received 8,000, sold 20,000, and also sold 50,000 on 15th April, by 15th April. Remaining goods we are holding only 50% plus 20, 70% gone, only 30%. 8,000 into 30%, 2,400. Total 7,434. From 86,800, you deduct 7,434, we get 79,366. This is the value closing inventory on 31st March 2022. And this much of goods we show in the trading account credit side 79,366, balance sheet asset side 79,366. Now you can apply the same knowledge of this table, forward reconciliation and backward reconciliation, to n number of problems. But while reading the point, be careful whether it is inflow of goods or outflow of goods. Whether we are the owner of goods or somebody is the owner of goods. If somebody is the owner of goods, then that goods are deducted. If we are the owner of goods, even though we don't have the position, we have to add back them to our inventory. Okay, this is inventory taking, students. I have explained basic concept and one problem. Now by applying this concept, you can apply this concept to the remaining problems, so that you get a thorough knowledge on the concept of inventory taking. So in inventories chapter, total we have majorly two concepts. One, inventory taking. Second one, adjusted selling price. Sometimes they give you problem on inventory ledger, preparation of inventory ledger. If you get a problem on preparation of inventory ledger, then that becomes very easy. Adjusted selling price, as I have explained, go through that. Inventory taking, you have to be very careful. Right now, next we start our capital and revenue expenditures and incomes, followed by depreciation chapter. Okay, now we start our next chapter. Hello students, previously we have discussed inventories chapter. Now we are going to discuss capital and revenue items, capital and revenue expenditures and receipts. So what is the importance of this chapter? First one, you may get 2 to 4 marks from this chapter in the form of true or false statements. Second, based on this chapter, the next chapter is depreciation and amortization. This chapter is also very important. To understand depreciation and amortization, you need to understand the capital and revenue expenditures and receipts. Forget about receipts, capital and revenue expenditure, especially capital expenditure, you need to understand. Third, based on this chapter, see, when we prepare financial statements or final accounts of sole proprietorship, there you, and at the same time, not only financial statements of sole proprietorship, any form of organization, financial statements, it may be whether it may be NPO or partnership or company, whatever it may be, the distinction between capital and revenue items are very important. That's why I am discussing this chapter. So we can complete this within 15 to 20 minutes. Okay, now observe carefully. First we discuss what is capital expenditure, revenue expenditure. Capital expenditure and its treatment, revenue expenditure and its treatment, capital receipt and its treatment, revenue receipt and its treatment. Okay, before that, first look at here. Business, when we start business, we incur various expenditures and we receive various receipts. What is the meaning of expenditure? Expenditure is nothing but any amount paid or payable. Any amount paid or payable by the business for obtaining any asset or goods, assets or goods or services. To put it simple, I have purchased a building. For that I have to pay amount. If I purchase it on credit, then it is payable. Then it becomes a liability for me. Suppose I have purchased goods. For that I have to pay amount, na? Or if it is on credit, then amount is payable. I have received services of employees. For that I have to pay some amount, na? Or if the salaries are due payable, then it becomes a liability for us. Means any amount paid or payable by the business for obtaining any asset or goods or services is termed as expenditure. And this expenditure we can categorize into capital expenditure and revenue expenditure. So what is the meaning of capital expenditure? Any expenditure incurred on purchase of asset or its improvement. Any expenditure incurred for obtaining any asset or improving the asset is termed as capital expenditure. To put it simple, out of the expenditure, I repeat, out of the expenditure, if we get benefit for more than one accounting period, I will give you one example or two examples. Let us take, suppose I have purchased furniture. For what purpose furniture is purchased? First of all, is it expenditure or not? Yes sir, purchase of furniture is expenditure. For which purpose this furniture is purchased? Is it for sale purpose or is it for usage in the business purpose? Sir, it is used in the business, sir. By using this, what you can do? You can generate revenue, sir. And the expenditure which we have incurred for purchase of furniture, this benefit we get more than one accounting period, that means more than 1 year or more than 12 months, because the furniture we use in the business for a longer period of time, and this furniture will give us long term benefits. At the same time, building, I have purchased a building and this building I will use in the business. It gives benefits to me for a longer period of time, that means more than 1 year or 12 months. To put it simple, any expenditure, the business incurred expenditure, out of this, if business gets benefit for more than one accounting period or more than 1 year or more than 12 months, those expenses are categorized into capital expenditure. Generally, the business will incur expenditure on assets or improving the assets. Suppose I have building. It has only ground floor plus first floor. Now what I am doing, I am constructing one more floor on the building. So it is nothing but my capital expenditure. I am improving the asset, existing asset I am improving. On the other hand, revenue expenditure is nothing but any expenditure incurred by the business, out of which if the business gets benefit within one accounting period, we have incurred expenditure. Out of this expenditure, we should get some benefit. Na? Yes, sir. If that benefit expires within 1 year or within 12 months or within one accounting period, that is called revenue expenditure. Revenue expenditure. Take for example, rent. I have utilized the premises and I paid rent. The benefit of rent will expire within 1 month because rent is paid for every month now. If I want to use building, I have to pay next month rent. This benefit is expired within 1 year. Within 1 year. At the same time, I am paying salaries. I receive services from employees and I am paying salaries to them. The benefit out of this expenditure, that is salary, will expire within 1 month. Na? Means less than 1 year. Yes, sir. All these expenses are called revenue expenditures. And what is the accounting treatment for capital expenditure? The accounting treatment for capital expenditure is, first, suppose I have purchased a building. I have purchased building. Then what is the entry we record for purchase of building? Tell me. Building account debit. Building account debit. What is the entry we record? Building account debit to cash or bank account. This is the entry we record. Yes, sir. Building is asset. At the end of the year, all assets are taken. All assets are taken on the assets side of balance sheet. Assets side of balance sheet. This building is shown on the assets side of balance sheet. Observe carefully. This is the accounting treatment for capital expenditure. In the place of building, you may visualize any asset. Furniture, plant and machinery, motor vehicles, whatever it may be. But here, as we use assets for a longer period of time, that means every year we are utilizing the assets. So out of this expenditure, some benefit will get expired now. Benefit will expire every year. Let us say I have purchased a building by paying 10 lakhs rupee. I have purchased a building by paying 10 lakhs rupee. I am expecting the building lifespan. The building lifespan is 10 years. I am expecting that the building lifespan is 10 years. That means I am expecting this building is used for 10 years. Means the total 10 lakhs rupee, is my expenditure. The useful life is 10 years. So every year some 1 lakh benefit gets expired now. Every year 1 lakh benefit gets expired. Observe carefully. This is called benefit expired. Out of 10 lakh rupee, how much benefit expired in the first year? 1 lakh. 1 lakh benefit expired. And what is the remaining amount? 9 lakh rupee benefit we have not received. This is called unexpired benefit. If you observe, the expired benefit is taken to the profit and loss account debit side. Is taken to the profit and loss account debit side. And unexpired portion is taken to the assets side of balance sheet. Unexpired benefit is taken to the balance sheet asset side. Observe carefully. This is capital expenditure treatment. This is capital expenditure treatment. On the other hand, revenue expenditure. First of all, let us say we have paid salary. We have paid salary. What is the entry we record for payment of salary? Salary account debit to cash or bank account. I have paid salary. First, debit salary account. At the end of the year, and the benefit of salary, let us say we have paid 1 lakh rupee salary. The benefit of payment of salary expired within one accounting year or within 12 months. Then This is transferred to the profit and loss account debit side. This is transferred to the profit and loss account debit side. Observe. Profit and loss account debit side. Because benefit expired now. Ultimately, if you observe, capital expenditure, what we are doing during the current year, we are estimating that how much benefit expired in the current year and how much benefit not expired. Expired benefit is taken to the P&L account debit side. Unexpired benefit is taken to the balance sheet asset side. Whereas revenue expenditure in the year of incurrence, the total amount is taken to the profit and loss account debit side. Ultimately, whether it is capital expenditure or revenue expenditure, both are transferred to the P&L account. But capital expenditure is transferred over a period of time. This concept is called depreciation. It is nothing but systematically we are allocating the capital expenditure over the useful life of the asset. This is the total amount of capital expenditure 10 lakhs. This 10 years is the estimated useful life of the building. What we are doing, we are allocating this 10 lakhs rupees, this 10 lakhs rupees to the P&L account over the useful life of the asset, that is 10 years. Systematically we are allocating the capital expenditure over a period, over the useful life of the asset. This concept is called depreciation. That is our next chapter. Okay, so this is the accounting treatment for capital expenditure and revenue expenditure. In the examination, they give you one statement. That means they give you some expenses and they will ask you, this expenditure is capital expenditure, true or false, and this expenditure is revenue expenditure, true or false. In that way they ask. Now look at, we try to solve one problem on the concept of capital and revenue expenditure. Observe, in the material I have clearly explained with some examples what is capital expenditure and its characteristics. You can just go through that. Okay, now look at illustration 1 carefully. Observe, state with reasons whether the following statements are true or false. First one, overall expenses of second hand machinery purchased or revenue expenditure. See, second hand machinery, it is an asset for us. To put the asset into usable condition, because it is a second hand machinery, to put the asset into usable condition, we need to incur some expenses on its overhauling, means some repairs and maintenance, repairs expenses. Okay, and these expenses must be capitalized. These expenses must be capitalized. So this is not our revenue expenditure, this is our capital expenditure. So the given statement is false. Here you have the answer, you can verify it. Next, money spent to reduce working expenses is revenue expenditure. See, generally in our day-to-day business in our day-to-day life of the business will incur so many expenses. All these expenses can be categorized into working capital. Day-to-day business, working capital. To reduce this working capital, we have incurred some expenses. Because of this expense, our working capital gets reduced now. So this expenditure is treated as capital expenditure, not revenue expenditure. So the given statement is false again. Next, legal fees to acquire property is a capital expenditure. Yes, it is true now. Why? Because I have purchased a building. For purchase of building, I have paid some legal expenses in the form of some documentation charges or stamp duty or any proper expenses incurred. These are treated as capital expenditure. So the given statement is true. Next, amount spent as lawyer's fee. This is very, very important. Amount spent as lawyer's fee to defend a suit claiming that the firm's factory site belonged to the plaintiff land is capital expenditure. See, if you observe here, third one, look at legal fees to acquire property is a capital expenditure. Yes, but here already the factory site belongs to us, but somebody occupied this factory building. Now we have filed a suit against them. For that purpose, we are incurring some lawyer's fees. We are plaintiff now. Now tell me, because of this expense, will you get any extra benefits? No, because the building belongs to you. You don't get any extra benefit now. So this expense can be categorized into revenue expenditure. So the given statement is false. Next, amount spent for replacement of worn out part of machine is capital expenditure. If you observe, we use the machinery, plant and machinery to run the business. some parts of the machinery automatically they own out. In that case, what we do, we have to replace them. It's a part of maintenance expenditure, na? It's a part of maintenance cost. So the maintenance cost is categorized as revenue expenditure, not capital expenditure. So the given statement is false. Next, expense incurred on the repairs and whitewashing for the first time on purchase of old building or revenue expenditure. Suppose we have purchased an old building. To put the old building into usable condition, what we do, we incur some expenses. We incur some expenses on old buildings. Let us say, for example, for repairing small repairs and whitewashing expenses. All these are termed as capital expenditure, but they said it is revenue expenditure. It is false. Next, expenses in connection with obtaining a license for running the cinema is capital expenditure. Yes, see, we have constructed a cinema hall. We need to take license now. The initial amount whatever we have paid, that is our capital expenditure, because without license it is not possible to run a cinema. That's why the initial expense of license, initial expenditure incurred on obtaining license is a capital expenditure. From the next year onwards, we have to renewal this license fee. We have to pay renewal amount, and this renewal amount becomes revenue expenditure for us. So the given statement is true. Seventh one, true. Clear? Next, eighth one, amount spent for the construction of temporary huts which were necessary for construction of the cinema house and were demolished when the cinema house was ready is a capital expenditure. If you observe, when we construct a big apartment or big building, what we do is first we construct a temporary hut to store the material, to store the material or to store the material. After construction of the building, what we do, we demolish the temporary huts. But these temporary huts are necessary for construction of cinema house na, and on constructing these temporary huts we have incurred already some amount na. Yes sir, in that case this expenditure is termed as capital expenditure. So eighth one is correct. Next, observe carefully. Next concept is receipts. Receipt is nothing but any amount received by the business, by selling goods or services or assets or obtaining sources of finance. Nothing but, suppose my business is purchase of furniture and sale of furniture. Sale of furniture, I receive income. This is my revenue receipt. This is my receipt. I have asset. The asset becomes outdated or old. I sold this machinery and I received amount. It's a receipt for me. And I have taken a loan from bank. It's a source of finance for me. I have provided some services to my customers or clients. I have received income. This is receipt for me. So receipt is nothing but any amount received by the business by providing goods, by selling goods, or by providing services, or by selling assets, or any source of finance. These receipts can be classified into two types: capital receipts and revenue receipts. Capital receipts are nothing but these are non-recurring in nature. These receipts we will not receive frequently. Whereas revenue receipts can be classified as these receipts we receive frequently, means by selling goods or by providing services we receive amount na. This is our revenue receipt. What is the entry for receiving revenue receipt? Simple, cash or bank account debit to that income, particular income account. Capital receipt also the same. Suppose if we sold asset, then what is the entry we record? Cash or bank account debit to asset account. If we borrow loan, what is the entry we record? Cash or bank account debit to loan account. These are capital receipts and revenue receipts. Revenue receipts are straight away taken to the profit and loss account credit side, but capital receipts are straight away not taken to the credit side of profit and loss account. Why? Because capital receipts, what we do is, suppose some 10 lakhs rupee worth of asset, just a minute. Yes, observe here carefully. Here I have asset. This is cost of asset 90,000, but 90,000 worth of asset we sold for 92,000 rupees. 92,000 is revenue capital receipt for us. Observe here, 90,000 worth of asset we sold for 92,000, so we have gained 2,000 rupees profit, and this 2,000 rupees profit is taken to the profit and loss account credit side. Total revenue receipt is not taken to the profit and loss account credit side. Only the profit is transferred to the profit and loss account credit side. This is the accounting treatment. All revenue receipts are taken to the profit and loss account credit side. Do remember. Look at one small problem on this concept. Observe, state with reasons whether the below items relating to the business of AB Limited are capital or revenue receipts. First one, a machine with a book value of 10 lakh is sold for 12 lakh. The total 12 lakh is capital receipt for us, and the profit of 2 lakhs we transfer to the P&L account credit side. Next, premium amounting to 1 lakh received on issue of shares. We have issued shares. See, in company accounts you get this concept. We have issued shares at more than the face value. Whatever 1 lakh we receive, this is our capital receipt. Okay. Next, an amount of 20,000 received from goods sold in cash. We sold goods and received 20,000 rupees. This is revenue receipt for us. Next, an amount of 5 lakh received on the maturity of fixed deposit from bank. We have fixed deposit in the bank. On the maturity of fixed deposit, we received 5 lakhs rupees. It is our capital receipt. Also, interest 40,000 was received in addition to the maturity amount. 5 lakh rupee is capital receipt for us and 40,000 is revenue receipt for us. 40,000 is transferred to the profit and loss account credit side. Very, very important. Okay, this is our capital receipt and revenue receipt. Capital expenditure, revenue expenditure. Capital receipt, revenue receipt. Out of this, capital expenditure is very, very important from depreciation chapter point of view, from final accounts point of view. All these four classifications are very, very important. Is it clear, students? Now we start our discussion with depreciation and amortization. Very, very, very important chapter. Very most of the students, they feel some difficulty in depreciation chapter, where we'll discuss in that chapter. Hope you are following. Yes, sir. Hello, students. Previously we have completed our discussion with the capital and revenue, expenditures and receipts. Now we start our discussion with another important chapter, that is depreciation and amortization. This chapter is very, very important from examination point of view as well as from practical point of view. You may ask, sir, shall we discuss accounting cycle once? Yes, sir. First one, identify the transaction, record the transaction in the journal, post them into ledger. After that, prepare trial balance. After that, prepare financial statements. Sir, during this accounting cycle, where is the concept of depreciation and amortization, sir? This concept is not there in your accounting cycle. But then why we are learning, sir? Why? Because this depreciation and amortization concept comes only at the end of the financial year. During the financial year, we will not discuss about the concept of depreciation and amortization. Only at the end of the financial year, we talk about the depreciation and amortization. Why, sir? Why? Because previously we understood the business will incur various expenditures. The business incurs various expenditure on purchase of assets or goods or services. Here we talk about the expenditure incurred on purchase of asset. Here we talk about expenditure incurred on purchase of asset. Observe carefully. Here business will purchase various assets. Assets are purchased by the business to use them in the business to generate the revenue. So business will purchase different types of assets. We can classify them as tangible assets and intangible assets. Sir, what are the tangible assets? Tangible assets are nothing but those assets which have physical existence, means which we can see and touch. Intangible assets, they don't have any physical existence, but even though they don't have any physical existence, but they have some real value. These are called intangible assets, but it is not possible to they don't have any physical existence now, so that it is not possible to touch them or feel them. Okay, now whatever the expenditure the business incurs on purchase of these assets, whether tangible or intangible, we can classify them into capital expenditure. At the end of the year, and here we are using the assets in the business. Our matching concept says the business generate revenue. To generate revenue, what are the various expenses incurred by the business? Match it. Means all revenues or all expenses must be matched with the revenue. Then only you can get true profit or loss. Here, at the time of calculation of profit or loss, generally we considered salaries paid, rent paid, purchases amount, and other direct expenses, interest paid, commission paid, loss on sale of asset, all these things we are considering. Yes, sir. Then what about the expenditure incurred on tangible assets or intangible assets? Why? Because these assets also helping us to generate revenue now. So whatever the expenditure we have incurred on the assets, that expenditure also must be matched with the revenue. Hope you are following. Yes, sir. But capital expenditure gives enduring benefits to us. Enduring benefits means long term benefits, ongoing benefits, more than one financial year or more than one accounting year or more than 12 months. Yes or no, students? So here our duty is to calculate how much benefit derived, how much worth of benefit or how much value of benefit derived from the asset during this particular period, and that expired benefit is matched with the revenue. That is what we do in the entire chapter of depreciation. Very, very important. So at the end of the year, we calculate the expired benefit of capital expenditure, that is in the form of depreciation. And unexpired benefit is shown on the assets side of balance sheet. Expired benefit is taken to the profit and loss account. Unexpired benefit is carry forward to the next years. Hope you are following. Yes. So our entire chapter of depreciation and amortization follows this concept. The word depreciation is applicable on tangible assets. These tangible assets we can also call it as PPE, property, plant and equipment, or property, plant and equipment, PPE. And the word amortization is applicable on the intangible assets. I repeat, the word depreciation is applicable on tangible assets, nothing but PPE, property, plant and equipment, and the word amortization is applicable on intangible assets. Is it clear? The word amortization, the concept of amortization is just similar to depreciation. The concept of amortization is introduced in the new syllabus. Old syllabus we don't have this concept of amortization, but new syllabus they have introduced. Is this clear, students? First, to ascertain the depreciation or to know the expired benefit of the expenditure, we need some factors. Directly it is not possible to calculate. So that first we should calculate cost of property, plant and equipment. Okay, here if you can observe, what are the various factors we take in measurement of depreciation means, first cost of asset. How much expenditure incurred on the cost of asset, this we need to refer. Next step, estimated useful life. For how many years you are expecting to use this asset. After that, scrap value means after its estimated useful life, how much amount you are expecting. Suppose I have furniture and the furniture useful life is 10 years. After 10 years, if I scrap it or if I sell the furniture as scrap, how much amount we could realize. Generally, the scrap value is taken as 0. Why? Because after 10 years, who knows how much amount we could realize by sale of this furniture or by scrapping this furniture. That's why majorly these three factors are very, very important. Anyway, the scrap value becomes 0. You take any problem, by utilizing these three factors, we calculate depreciation. After calculating depreciation, how do you record this depreciation in the books of accounts? Two things. First, you measure how much of depreciation you want to provide or how much benefit expired. First thing. Second thing, how do you record this depreciation in the books of accounts? Our entire chapter of depreciation and amortization revolve within these two concepts. First, how to measure depreciation. Second, what is the accounting for depreciation? Hope you guys are following. Yes, sir. Now, we start our discussion with the meaning of property, plant and equipment. In general language, whatever the asset purchased by the business, if it has some physical existence, tangible fixed assets, they will be considered as property, plant and equipment, to put it simple. But the meaning given by AS10 property, plant and equipment is property, plant and equipment are tangible items that are held for use in the production or supply of goods or services. Suppose we have purchased a machinery. By utilizing the machinery, I will produce goods. For what purpose I am using? For production purpose. I have purchased furniture. For what purpose? For doing my business purpose, or for rental to others or administrative purposes. Next, are expected to be used for more than a period of 12 months. Whatever the asset we purchase, that we expect to use it in the business for more than 1 year or 12 months. Next, cost of property, plant and equipment. In the journal chapter, you have observed that what is the cost of property or cost of any asset. Cost of any asset comes, we can say that direct purchase price. Suppose I have purchased furniture by paying 10 lakhs. It is my direct purchase price. In addition to this price, I have to pay, I have to incur some additional expenses. Sir, what are the additional expenses, sir? I have to bring the furniture from the place of purchase to my business place. For that, I have to pay some carriage or freight or any other amounts, insurance charges, transit insurance. I have to incur all these expenses now, and I have to pay some taxes now. All these are part of my cost of property, plant and equipment. But in the examination, they give you only two things. Suppose if you buy any machinery or any plant, you take any plant or machinery, purchase price, let us say purchase price is 10 lakhs. Transportation charges we have paid some 10,000 rupees. And this plant and machinery we have to install in our premises. Yes, sir. For installation, 5,000 rupees expenses incurred. In this case, what is the total cost of plant? 10 lakhs, 10,000, 15,000. 10 lakhs, 15,000 is our cost of plant. This is considered as cost of plant or value of asset. Is it clear? Except this, they will not ask any other things. Only they will give you cost this much, installation expenses or erection charges this much. You have to add all the expenses. Suppose if they give you second hand machinery, in that case what we do? Second hand machinery cost plus any repairs incurred on the machinery plus any overhauling expenses. All these expenses constitute cost of asset. Relating to cost of property, plant and equipment, this much of knowledge is enough. Coming to the concept of depreciation here, already we discussed. When a fixed asset is purchased, it is recorded in the books of account at its original or acquisition or purchase cost. Yes, sir. However, fixed assets are used to earn revenues, yes, or save cost for several accounting periods with the same acquisition cost until the fixed asset is sold or discarded. As per Schedule 2, under the Companies Act 2013, depreciation, they are giving the meaning. Already in the chapter of capital and revenue expenditures and receipts, I have explained what is the meaning of depreciation. Depreciation is a systematic allocation of capital expenditure over the useful life of the asset. Generally, the term depreciation is used. In general terms, the word depreciation is used as decrease in the value of book value of asset. What is the meaning of that? Decrease in the book value of asset. Why the book value of asset decreases? Why because we are utilizing the asset now. I have purchased furniture for 10 lakhs. I have used for 2 years. If you sell this furniture in the market, will you get same 10 lakhs rupees? No. The value of asset decrease. Why, sir? What are the causes for decrease in the value of fixed asset? Why? Because wear and tear. There are internal causes and external causes also. We are using the asset so that the asset value gets decreased, wear and tear. Depletion. The word depletion is used for wasting assets or natural resources. When natural resources are extracted, automatically their quantity gets reduced now. The value of the value of that mine, suppose take some quarries or mine, the value of mine or quarry gets decreases. Next, lack of proper use or maintenance. Suppose I have purchased a machinery, but the machinery is not maintained properly. Automatically the machinery gets breakdown, or its useful life gets, or its efficiency gets decreases. Next, external factors. These are beyond our control. Obsolescence. Due to technological changes, we frequently change the machinery. Suppose Earlier I have a machinery which can produce 10,000 units in a month. But due to technological changes, there is a new machinery introduced in the market which can produce 1 lakh units per month. What I will do if my demand is more? If the demand for the product is more, then obviously I will go for new machinery. The old machine gets outdated. Next, afflection of time. Even though the asset is not used properly, or even though the asset is not used, or the asset is kept idle, the asset is kept idle. By passage of time, the value of asset also gets decreased, and time factor also. These are the causes for depreciation. This is important for 4 marks. Causes of depreciation. Next, come to the concept of factors in the measurement of depreciation. What are the things we consider while calculating depreciation? Already we understood cost of asset, estimated life of the asset, and residual or scrap value of asset. Cost of asset we should calculate. Estimated life, in the problem they give you estimated life. Practically you need not to estimate the life of the asset. Companies Act 2013 gave the estimated useful life of the asset, but cost of asset you should calculate. Next step, methods of recording depreciation. Suppose, let us take for example, cost of asset is by using our common sense, cost of asset is 10 lakhs, okay, and estimated useful life is, let us say, 10 years, and scrap value, assume scrap value is 0. Scrap value is nothing but scrap value or residual value, nothing but after 10 years of useful life, if we sell the asset, how much amount you could realize? Let us say it is 0. Then what is depreciation per annum? Depreciation, generally depreciation is calculated at the end of the year, means per annum. The formula for depreciation is simple. What is the cost of asset? Tell me. The cost of asset is 10 lakhs, sir. The cost of asset is 10 lakhs, sir. Minus what is the residual value? 0, sir. Divided by what is the estimated useful life? 10 years, sir. This 10 lakhs minus 0 is 10 lakhs. This is called depreciable amount. This is called depreciable amount. Depreciable amount in the sense how much amount you have to depreciate. How much amount you have to depreciate, that is nothing but depreciable amount. Okay, so 1 lakh rupee per annum. So per annum 1 lakh rupee depreciation is provided, whether you use the asset or not. Whether you use the asset or not, 1 lakh rupee depreciation is provided, means every year the asset value in the sense how much expenditure you have incurred, 1 lakh. Every year out of this expenditure, 1 lakh amount of expenditure is transferred or written off by transferring to the P&L account, irrespective of its usage. This is the concept of depreciation. Now we have calculated depreciation. How much? 1 lakh rupee. How do you record this 1 lakh rupee in the books of accounts? At the time of purchase of asset, what is the entry you have recorded? Asset account debit to cash or bank account. Now depreciation is provided. Yes, sir. How much depreciation you calculated? 1 lakh. 1 lakh. How do you record this 1 lakh? Simple. Observe. That is nothing but methods of recording depreciation. Generally we have two methods. For recording depreciation. First, depreciation directly charging to the asset account. This is called method 1. This is very simple. Second, provision for depreciation or accumulated depreciation account is maintained. This is very, very important, and most of the students, they get some confusion in the provision for depreciation account. That is due to lack of concept. That's it. First, we discussed directly charging to asset account. Depreciation amount directly we charge to the asset account. How, sir? First, during the financial year, what we do? We purchase the asset, we use the asset. The concept of depreciation comes only at the end of the financial year. Only at the end of the financial year. Yes or no, students? Yes, sir. So during the financial year, what might be the transaction? First, we purchase the asset. What is the entry for purchase of asset? Asset account debit to bank account. Any expenses incurred on buying the machinery, these are additional expenses which we have incurred. All these are capitalized. Add to the asset account. Same, asset account debit to bank account. Any installation expenses paid. Same, installation expenses also added to asset account debit to bank account finally. These are the entries. In the examination, directly we write only one entry. All expenses we add and debit to the asset account debit to bank account. At the end of the financial year, what we do? At the end of the financial year, we have calculated 1 lakh depreciation. Yes, sir. So, for charging depreciation, what is the entry? Depreciation is expense for us, non-cash expenditure. Do you remember? Depreciation is non-cash expenditure. Entry, depreciation account debit to asset account. Depreciation account debit to asset account. Sir, why asset account is credit? Why? Because our asset value gets decreased. Book value of asset decreased. Asset account here debit at the time of purchase. Now its value gets decreased. That's why asset account credit. Over. Now depreciation is expense for us. At the end of the year, we transfer this depreciation to the profit and loss account. For closing the depreciation, profit and loss account debit to depreciation account. That's it. Simple. Suppose if you follow second method, provision for depreciation account or accumulated depreciation account, only a thin line of difference. During the year, these entries are same. During the year, these entries are same. At the end of the year, we are recording for depreciation. What is the entry? Depreciation account debit to asset account. Under here, what we are doing? Directly depreciation amount is charged to the asset account. Means, if you observe asset account here, this entry, how do you post? Tell me. By asset account credit side, by depreciation. Means the depreciation amount directly we are charging to asset account. Observe. Means depreciation amount directly we are writing in the asset account. Because of this, what happens? Our asset value gets decreased. We have a concept called historical cost concept. Under this concept, depreciation is, the asset is shown on the asset side of balance sheet at its original cost or historical cost. By charging depreciation to the asset account here, by charging depreciation to the asset account directly, what is happening? Asset value directly decreased. To overcome this difficulty, what we are doing? We are not charging this depreciation directly to asset. Now what we are doing? We are not charging depreciation directly to the asset account. Means depreciation account anyway debit. But this time we will not credit asset account. In the place of asset account, what we do is we simply create a new account called provision for depreciation. That's it. Provision for depreciation. In the place of asset account, what we are doing? We are crediting provision for depreciation. Means we are accumulating provision for depreciation or accumulated depreciation. Clear? So every year how much depreciation we provided, that we are showing in a separate account. Provision for depreciation account. Clear? Now at the end of the year, the entry is common. Profit and loss account debit to depreciation account. Profit and loss account debit to depreciation account. But here you need to understand one small concept. What is that, sir? Here we have asset account. Here we have asset account. Let us say asset account debit 1 lakh purchased. Under first method, depreciation is directly charged here to the asset. First method. Let us say depreciation is 10,000. Here asset value is how much? What is the balance? Balance of asset is 10,000. And this 90,000. And this 90,000, what we are doing? We are showing it on the asset side of balance sheet. This is first method. Now observe carefully and understand carefully second method. Second method. Under second method, we prepare asset account. Asset account is showing how much balance? 1 lakh. Under second method, depreciation is not directly charged. I repeat, under second method, depreciation is not directly charged to the asset. In that place, what we are doing? We are creating one new account that is called provision for depreciation account. This account is valuation adjustment account. Okay. Observe now. Look at. We have recorded this entry now. What is the entry? Depreciation account debit to provision for depreciation account. So credit side, by depreciation assume 10,000. Look at here, asset account showing debit balance 1 lakh. Against to that, the accumulated depreciation is 10,000. Now here asset account is showing how much balance? By balance carried down 1 lakh. Provision for depreciation account, it is showing credit balance. It is never closed, do remember, unless the asset is sold. So this also shows credit balance. To balance carried down 10,000. Now what we do? Asset account and provision for depreciation account both are shown in the balance sheet. Asset account is showing debit balance, so that asset 1 lakh. Provision for depreciation is showing credit balance, so that liabilities side 10,000. Look at the presentation here. Asset account is showing 1 lakh balance. Provision for depreciation is showing 10,000 balance. If you observe the net amount, this is the cost of asset. This is the depreciation provided till now. Minus, what is the net amount of asset value? 90,000. For presentation purpose, what we can do is, we can also show like this. Asset 1 lakh minus provision for depreciation 10,000. What is the remaining value of asset? 90,000. Two types of presentation. This is first type of presentation. This is second type of presentation. But observe carefully the first method and second method. Asset account here directly showing 90,000, but here asset account indirectly showing 90,000. This is only the thin line of difference. Observe. Thin line of difference. Hope you guys are following. Yes, sir. Now look at. These are the two methods we have for recording depreciation. Now, when it comes to methods of providing depreciation, we have various methods of providing depreciation. Methods of providing depreciation is nothing but calculation of depreciation amount. I repeat, methods of providing depreciation is nothing but calculation of depreciation amount. We have different methods, but when it comes to our lecture, we discuss only commonly used methods. Straight line method and diminishing balance method. These two methods we discuss. First, come to straight line method. Under straight line method, depreciation is calculated by using this formula. Observe, depreciation is equal to cost of asset minus estimated scrap value divided by estimated useful life of the asset. By using straight line method, this is what we calculate. And if you observe here, in our calculation also, basically we followed the same. Cost of asset 10 lakhs minus scrap value 0 divided by estimated useful life. Straight line method. This is very simple to calculate. Hope you guys are following. So just observe the entries once again. If you can observe the entries once again under two methods. When depreciation is directly charged to asset account, then what is the approach we follow? If depreciation amount is not directly charged to the asset account, in that case we have to create one new account. That new account is called provision for depreciation account. Clear? Now, if you are thorough with these entries and this straight line method, then we try to solve one simple problem. Look at the problem here. Very simple problem, observe carefully. I will give you the problem solving technique also. How the depreciation problems are solved. Look at. Now we try to understand how the problems of depreciation chapter to be solved. Here I will discuss a small technique of solving problems on depreciation. See, generally I have already told you, we discuss commonly used methods here: straight line method or double diminishing balance method or WDV method. Now look at here. After reading the problem or while reading the problem itself, you have to try to make a note of these points roughly. Very important, students. Observe carefully. Look at, I am taking here reference of problem number 1. I am taking reference for problem number 1. Read problem number 1. See, Jain Brothers acquired a machine on 1st July 2021 at a cost of 14 lakh and spent 1 lakh on its installation. Fine. The firm writes off depreciation at 10% per annum of the original cost every year. The books are closed on 31st December every year. Fine. This is the information we have. Required, show the machinery account and depreciation account for the years 2021 and 22. 2 years now? Yes. From this information, what are the various points we have to note? Observe here. First and foremost point is identify what is the method of depreciation. In this problem, SLM. In the remaining problems, it may be WDV or any other problem, other method. Second, what is the rate of depreciation? 10%. In this problem, 10%. Remaining next problems are examination problem, whatever it may be. Next, books closing date. On which date we are going to close the books of accounts? Why? Because generally they will ask machinery account for at least 2 years or 3 years. In some problems they may ask for 1 year. At least you should know on which date we are closing the books of accounts. So books closing date also very important. Next, for how many years account is prepared? It may be machinery account. Most of the cases they give you machinery account or plant account or any asset account or motor truck account. For how many years we are going to prepare this account? 2021 to 2022. This is the basic information. For how many years you have to prepare the account? 2 years. Now what we have to do is year wise collect the information. Year wise 2021. First we have to start the machinery account for the year 2021. Okay. First 2021, either the machinery account started with the opening balance or we start the machinery account with purchase of asset. Some problems they give you opening balance directly. On so and so date, the machinery account is showing this much of balance. In that case, you have to start your account with the opening balance. But in this problem, we have purchased asset on 1/7/2021. And here dates also plays an important role. Look at first what happened. Machinery purchased for 15 lakh. You may ask, sir, 15 lakh, how sir? 14 lakh is the cost plus 1 lakh spent on its installation. Total 15 lakh. 14 plus 1 lakh, 15 lakh. Date also write down. During 2021, what happened? Also write. At the end of the year, 31st December, provide depreciation. During the year, no additional purchase of asset. During the year, already here I have discussed. During the year, what are the entries? At the end of the year, what are the entries? In our problem, during the year, we have purchased machinery. Over. Now go to at the end of the year. What is the closing date of books of accounts? 31st December. Calculate depreciation. Calculate depreciation. In the year of purchase, we have to be very careful. In the year of purchase, we have to be very careful for calculation of depreciation. Why? Because here the asset is purchased on 1/7/2021, but books of accounts are closed on 31st December. In the year of purchase, we calculate depreciation from the date of purchase to the date of closing the books of accounts. From 1/7/2021 to 31st December 2021, how many months? 6 months. For the first year, we calculate depreciation for 6 months and we record the entry. Hope you are following. Yes, sir. Next, after recording entry for depreciation, what is the next step? Balance the account. Here they have asked to prepare two accounts. One, machinery account. Two, depreciation account. Machinery account is balanced. Depreciation account closed. Why? Because depreciation is transferred to the P&L account. Yes. So 2021, these are the steps we have to follow. Now go to 2022. 2 years they have asked now. 2022. 2022 year, the machinery account starts with the opening balance. Write down the opening balance. Two balance brought down. Again check during 2022 what happened. There may be two possibilities. One, purchase of asset. Two, sale of asset. During 2022, there may be two things happen. Only two possibilities. One, purchase of new asset or sale of existing asset. But in this problem, nothing is happened. So, straight away go to at the end of the year. In this problem, no new purchase of asset, no sale of old asset. Straight away go to at the end of the year. What is the end of the year? 31st December. On 31st December, what we have to do? We have to calculate depreciation. From second year onwards, we charge depreciation for full year. We charge depreciation for full year. Why? Because we have asset from the beginning of the year. But in the first year, we have asset only from 1/7/2021. Is it clear? Okay, sir. Depreciation calculated and entry also recorded. Now, at the end of the year 2022, at the end of 2022, balance the account. Here two accounts we have to prepare. One, machinery account. Second, depreciation account. Machinery account is balanced. Depreciation account is closed. Our problem also completed. So within 1 minute, if you can write this information in short form, no confusions. However the problem it is, whatever the problem it is on depreciation, you make information like this or you write the information like this, you will not miss even a single transaction. Okay, I will show you for one more problem also. Illustration 7 I will show you. Look at illustration 7. Here you will get complete information. Illustration 7, look at. This is just for understanding the sequence or flow of solving the problem. Read illustration 7. A firm purchased on 1st January 2020 certain machinery for 5,82,000 and spent 18,000 on its erection. 5,82 plus 18, 6 lakhs rupees. On 1st July 2020, another machinery for 2 lakhs was acquired. Yes, okay. On 1st July 2021, the machinery purchased on 1st January 2020 having become obsolete was auctioned for 3,86,000. On the same date, fresh machinery was purchased at a cost of 4 lakhs. Fine. Depreciation was provided annually on 31st December at the rate of 10% per annum on written down value. Prepare machinery account. Sir, I understood. Last 3 lines, sir. Last 3 lines I understood, sir. But above 4 lines, I am unable to understand, sir. Something I can understand, but what is this? Most of the students, they will get confused. They start getting confusion from now onwards. First 4 lines. What they are saying? So and so date we purchased one asset. So and so date we sold the asset. On the same date again we purchased the asset. And so and so. What is this? That's why this information you convert into year wise to get the clarity. Okay. Now look at how we convert this information into our usable condition. Look at first. What is the first step? Method. WDV method. Rate of depreciation 10%. Books closing date 31st December every year. For how many years account is prepared? 2020 to 2021. Means 2020-21. For 2 years account is prepared. For 2 years account is prepared. Sir, they did not mention the number of years, na sir. Yes, but look at the asset purchase date 2020. Look at the next year date, 2021. 2021. So they are saying 2020, at the same time they are saying 2021, and they said 31st December they are closing the books of accounts. Means 31st December 2020 they will close for 1 year, 31st December 2021 they will close for other second year. Hope you are following. Now observe carefully. 2020 what happened? If you want to start machinery account for 2020, you have two options. One with opening balance or with a new purchase of asset. In the problem, they did not mention that this account is showing so and so opening balance. No, on 1st January 2020, we purchased asset for 5,82 plus 18,000. Look at on machinery 1. Machinery 1 purchased on 1/1/2020 for 6 lakhs. We record the entry straight away on 1/1/2020. Machinery account debit to cash or bank account. Over. Again, during the year, what happened? Look at the problem. On 1st July 2020, this also comes under same financial year. Yes, sir. Another machinery purchased for 2 lakhs. So, on machinery 2, this is machinery 2 students. Machinery 2 purchased on 1/7/2020 for 2 lakhs. Okay. Next, what happened during the same year? Nothing happened. After 1st July 2020, straight away they jumped to 1st July 2021, means next financial year. But now first we have to complete 2020, go to at the end of the year, calculate depreciation at the end of the year for machinery 1 and machinery 2 by following WDV method. When you have more than one machinery, it is always suggestible to prepare separate working note for calculation of depreciation like this. Not like this, just a minute. This is illustration 7 now. Yes, illustration 7 working note. Like this, machinery 1, machinery 2, machinery 3. Hope you are following. Next, what happened? At the end of the year, balance the account. Here we are preparing only machinery account so that this is balanced, not closed. So 2020 completed. Go to 2021. 2021 starts with opening balance. Now, whatever the closing balance we have on 31st December 2020, that becomes the opening balance. Right, sir. Now check what happened in 2021. So 2021, on 1st July 2021, machinery purchased on 1st January 2020, we sold, sir. Means, to put it simple, machinery 1 is sold on 1/7/2021 for 3,86,000. This is one transaction. Whenever we sell machine, I repeat, whenever we sell machine, we need to account for three things. One, first, calculate depreciation on machinery sold till from 1/1/2021 to 1/7/2021. Because 1/1/2021 is the book's opening date. 1/7/2021 is the asset sold date. That means in the year of 2021, we have used the asset for 6 months. Calculate depreciation for 6 months. One transaction. Second, we sold the asset for 3,86,000. Record the entry for this. Third, we have sold the asset. Now, whenever we sell asset, calculate profit or loss on sale of asset. This is unavoidable. Whenever we sell asset, calculate profit or loss on sale of asset. Calculate profit or loss on sale of asset. This is another. So don't forget, whenever you sell asset, don't forget to record these three transactions. Yes, sir. This is completed, sir. Next, machinery 3. On the same date, what happened? Tell me. And on the same date, fresh machinery was purchased at a cost of 4 lakhs. Yes, sir. This is one more transaction. Yes. Machinery 3 is purchased on 1/7/2021 for 4 lakhs. Record the entry. So during the year, one asset sold, one asset purchased. Next, what happened? Go to at the end of the year. End of the year. Calculate depreciation. Actually, we have 3 machines now. Machine 1, 2, 3. Machine 1 is sold. How many machines left? 2 and 3. Calculate 2 and 3. Depreciation. From this working note. Here you can calculate. Okay. Next. At the end of the year, balance the account. Here machinery account is prepared now. Just balance the account. Over. Like this, you can solve any type of problem. First, basic information, 4 things. What is the method of depreciation, rate of depreciation, books closing date, and for how many years account is prepared. Next, if it is for 1 year, you write the information for 1 year only. You write the information like this. Believe me students, you will not miss even one single transaction. Everything goes correctly. Clear? This is our problem solving technique for depreciation chapter. Hope you guys are following. Yes. Now look at, we try to solve the problems. Now look at illustration 1. Already we have read this illustration 1 and we made a small note. Preparation of this note is suggestible students. After that it is up to you. Now look at here, I have recorded already the information. Now 2021, look at what is the first transaction. Machinery purchased for 15 lakh. So on 1/4/2021 we record the entry to bank account 15 lakh total. Next, at the end of the year, now we provide depreciation. Here in this problem, we directly charge depreciation to the asset account. Entry, depreciation account debit to asset account. So by depreciation 75,000. At the end of the year, we balance the accounts. Machinery account is balanced, depreciation account is closed. So balancing, the balance is nothing but 14,25,000. This becomes opening balance here. Depreciation account debits at 75,000 and at the end of the year this account gets closed. Second year, what happened? Second year nothing happened, that means no new asset is purchased. 2022 starts with opening balance, no new asset is purchased or asset is sold. At the end of the year, calculate depreciation. We are following original cost method now or double SLM method. Always we calculate depreciation on its original cost. What is the original cost of asset? 15 lakh. 15 lakh into 10%, 1,50,000. Second year depreciation also 1,50,000. First year 75. Second year 1,50,000. So here also 1,50,000. At the end of the year, balance the account. Asset account, what is the balance? 12,75,000. Depreciation account gets closed. Hope you are following. Now look at the second problem. Second problem, the method of depreciation is diminishing balance method or WDV method or written down value method. Written down value method or reducing balance method. Okay. Observe carefully. Under WDV method, depreciation is calculated on the reducing balance. In the first year itself, in the first year, we calculate depreciation on the original cost. I repeat, in the first year, we calculate depreciation on the original cost. When it comes to first year, there is no difference between SLM method and WDV method. I repeat, when it comes to first year, there is no difference between SLM method and the WDV method. When the difference starts from second year onwards. From second year onwards, if you follow SLM method, we continue charging depreciation on original cost. But under WDV method, we charge depreciation on the written down value. That means first year, let us say first year asset is 15 lakh minus first year depreciation is 75,000. 15 lakh minus 75,000. What is the balance here? 14,25,000. If it is SLM method, we charge depreciation on 15 lakh. If it is WDV method, we charge depreciation on 14,25,000. This is only the difference between SLM and WDV. Remaining everything is same. Okay. Now look at. For second problem also, we have to make a note. Look at like this. Method of depreciation WDV. Method of depreciation WDV method. Rate of depreciation 10% same. Books closing date 31st December. And for how many years account is prepared? 2021 to 22. 2021, what happened? Same, machinery purchased. At the end of the year, calculate depreciation and balance the account. Look at 2021 once. Asset is purchased 15 lakh to bank account. Depreciation 75, 14 lakh 7. First year same. First year same. When it comes to second year starts with opening balance now. Second year starts with opening balance 14,25,000. Second year depreciation is calculated on the written down value 14,25,000 into 10%, 1,42,500. Like this. Balance. That's it. Completed. Next, come to illustration Okay, look at illustration 3 once. Yeah, this is sum of yes digit method. Okay, fine. This is machine or rate method. Now come to problem number 7. Before discussion of problem number 7, we discuss a small concept of asset is sold. When the asset is sold, then what is the accounting treatment? Very important. Compulsorily you get this concept in the problem. Whenever any asset is sold, already we discussed in our problem solving technique that whenever any asset is sold, we have to do three things. First, calculate depreciation till the date of sale of asset. Second, record the entry for sale of asset. Third, calculate profit or loss on sale of asset. First one as usual we know. Second one also record the entry for sale of asset. Sale of asset entry, cash or bank account debit to asset account. Very simple. Third one is very important. That is calculation of profit or loss on sale of asset. Look at. What is the entry we record for profit or first calculate like this. Look at the example here. The book value of asset 50 lakhs. Depreciation is charged at 10%. On 1st July 2022, the asset is sold for 32 lakhs. See, from 1st January to 1st July, how many months? 6 months. For 6 months, calculate depreciation on 50 lakhs. Look at 50 lakhs is the book value of asset. Less depreciation till the date of sale. This is our first point. Calculate depreciation till the date of sale for 6 months. This is the WDV of asset. WDV or book value of asset as on the date of sale. Means 47 lakh 50,000 worth of asset we sold for 32 lakh. Means it is loss for us. How much is loss? 15 lakh 50,000 is loss for us. So here we record entry for depreciation, we record entry for sale of asset, we record entry for profit or loss. This is the concept here. Look at first. We have two methods of charging depreciation. Here is a important factor. Method 1, method 2. In case of method 1, what is the accounting treatment? In case of method 2, what is the accounting treatment? Method 1, depreciation directly charged to asset account. Method 2, provision for depreciation account is maintained. First we discuss method 1. Entry. First provide depreciation. Yes, depreciation account debit to asset account. If method 2 is followed, depreciation account debit to provision for depreciation. Next, receipt of sale proceeds. Entry. Cash or bank or party account debit to asset account. Second method also same entry, no change. Profit or loss. How can we compare profit or loss? Book value of asset is compared with the sale value. If book value is more, loss. If sale value is more, profit. Then if it is profit, entry asset account debit to profit or loss account. If it is loss, entry profit and loss account debit to asset account. But the difference between method 1 and method 2 comes here. This is very important. Observe carefully. This one is very important. To compare the book value of asset with the sale value, first you should know the book value. How do you get book value of asset? How do you get the book value of asset? Book value is equal to cost of asset minus depreciation till sale. Book value is nothing but cost of asset minus depreciation till the date of sale. Under method 1, directly we are charging depreciation to the asset account, so that the asset account shows directly book value. But when it comes to method 2, here depreciation is accumulated in a separate account known as provision for depreciation account. When you look at the asset account shows cost value. But what we need? Book value. Cost of asset. From this what we have to deduct? Depreciation. But the depreciation is in which account? Provision for depreciation account. Now what we do is, the depreciation which we have accumulated till the date of sale, that is transferred from provision account to asset account. Provision account to asset account. In that case, what is the entry we record? Provision normally shows credit balance transfer. Provision for depreciation account debit. To which account we are transferring? Asset account. To which account we are transferring? Asset account. This is the additional entry which we need to record in case of method 2. Students will get confusion here. How much depreciation is charged? Whatever the asset you sold, on that particular asset, till now how much depreciation is accumulated, transfer that amount only. This is the extra entry we should record. Apart from this, everything is simple, right? Now look at, we try to solve one problem. Illustration 7, observe carefully. Yeah, illustration 7. Already we have read the illustration 7 and we made a record, that means note of all these things. Clear? Now look at 2020. Okay, what is the method of depreciation? WDV. Rate of depreciation 10%. Books closing date 31st December. And for how many years account is prepared? 20 to 21. At the time of discussing of this problem solving technique, we have read illustration 7 now. Now we continue the same. And already we have recorded 2020 what happened one by one. 2021 also what happened one by one. Now look at first 2020 what happened. Machinery 1 purchased on 1/1/2020. For that, what is the entry we record? Observe, machinery account debit to bank account 6 lakhs. This is the first and foremost entry. Next one, second, what happened? Machinery 2. If you record this, you need not to refer the problem once again. If you make a record of this, you need not to refer the problem once again. From this itself, you can straight away record the entries. Machinery 2 purchased on 1/7/2020 for 2 lakhs. Record the entry. Machinery account debit to bank account 2 lakhs. Over. During the year, nothing has happened. So calculate at the end of the year depreciation on machinery 1 and machinery 2. What is the method of depreciation? WDV. First year, in the first year, there is no difference between SLM and WDV. Right. Now calculate depreciation in the form of working note. Machinery 1, machinery 2, machinery 3. 3 machines we have now. First, cost of machinery, first machine 6 lakhs, second machine 2 lakhs. Depreciation calculate for 2020. Machinery 1, for how many months we calculate? It is calculated from 1/1/2020 to 31st December, 1 year. Second, machinery purchased on 1/7/2020. From 1/7/2020, you calculate depreciation till 31st December. Till 31st December. Hope you guys are following. Yes, sir. Like that, depreciation is how much? When you are writing depreciation, don't write individually, write down combinedly. Total depreciation here 60,000 plus 10,000. Total depreciation for the first year 2020 70,000. Entry depreciation account debit to asset account. Depreciation account debit to asset account. So by depreciation 70,000. Balance the account 8 lakhs minus 70, 7 lakh 30. Come to the next year, it starts with opening balance 7 lakh 30. 2021 what happened? Observe, 2021 started with opening balance. 2021 started with opening balance. Right. Now on 1/7/2021 we sold an asset. Now first calculate depreciation from 1/1/2021 to 1/7/2021. We are following WDV method. What is the WDV as on 1/1/2021? 5 lakh 40. On 5 lakh 40 you calculate depreciation for 6 months. How much? 27,000. Record the entry. Depreciation account debit to asset account to 27,000. First one completed. Second one, we sold the asset. Entry cash or bank account debit to asset account. For how much amount we sold? For 3,86,000. So 3,86,000. Next, calculate profit or loss. For that you check, compare book value. See 5,40,000 WDV on 1/1/2021. From this we have deducted depreciation till the date of sale. 5,13,000 is the book value of asset. 5,13,000 is the book value of asset. This much worth of asset we sold for 3,86,000. Means loss for us. What is the entry for loss? Profit and loss account debit to asset account. Profit and loss account debit to asset account. So by profit and loss account. In this problem, this calculation is very, very important. So 3 things completed. First, calculate depreciation till the date of sale. Second, calculate, record the entry for sale of asset. Third one, calculate profit or loss. Over. Now, On the same date, what happened? We purchased another asset for 4 lakhs. Entry, machinery account debit to bank account. Over. At the end of the year, now nothing. During the year, everything completed. Now come to at the end of the year, calculate depreciation on machinery 2 and machinery 3. Machinery 2 and machinery 3, calculate depreciation. Machinery 2 WDV 1,90,000. On this 10%, 19,000. Machinery 3 value 4 lakhs. Machinery 3 is purchased on 1/7/2021. From 1/7/2021 to 31st December, 12 months, sorry, 6 months. Calculate depreciation for 6 months, 20,000. At the end of the year, total depreciation for machinery 2 and machinery 3 is 19,000 plus 20,000, 39,000. Depreciation account debit to asset account. So by depreciation, 39,000. After this, balance the account. Over. This is the opening balance for third year completed. Hope you guys are following. Yes. Now the remaining problems are same. Every problem, you apply this concept to n number of problems. Basic concepts you need in your mind. This working note plays very, very, very important role, students. Very, very important role. Is it clear? Yes, sir. Now look at the next one. The next important, okay, we try to solve one more problem on provision for depreciation. Yeah, look at illustration 8. Look at illustration 8. This is very, very important. Yeah, illustration 8 is very, very important. Look at, because here we solve problem by using provision for depreciation account and without using provision for depreciation account also. Here I will explain with using provision for depreciation account. First, read the problem. On 1st April 2019, Subra Limited purchased a machinery for 12 lakhs. Okay, this is the first transaction. Record the entry. Machinery account debit to bank account 12 lakhs. Completed first entry. Next, on 1st October 2021, a part of the machinery purchased on 1st April 2019. Observe, from 1st April 19, they directly jump to 1st October 2021. 1st October 2021. Yes, sir. Now, what's the requirement? Observe. The requirement is prepare machinery accounts for the year ending 31st March 2020 to 22. 2020, 2021, 2022. For 3 years, machinery account is prepared. What is the method of depreciation? Basic questions, WDV. What is the rate of depreciation? 10 months, 10% per annum. For how many years machinery account is prepared? For 3 years. What is the books closing date? 31st March. Basic information collected. Yes, sir. You start. Now, we are in the first year 2019-20. You have to make a record. 1920, what happened? 1920, we have purchased a machine for 12 lakhs. During the year, nothing happened. At the end of the year, calculate depreciation. 12 lakhs into 10%, 1,20,000. We are following which method? Provision for depreciation. Entry. Depreciation account debit to provision for depreciation account. This method is provision for depreciation account is not maintained, but we have to follow provision for depreciation account. Observe carefully. Machinery account debit 12 lakhs. For the depreciation, what is the entry we record? Depreciation account debit to provision for depreciation account. That's why here depreciation is taken to the provision for depreciation account, 1,20,000. Hope you guys are following. Yes, sir. Next one. Next, 1920 completed. 1920 completed. Now come to 2021. 2021 financial year, what happened? 2021 financial year, nothing happened. Why? Because 1st October 2021 falls under 2021 to 22 financial year. 2021 to 22 financial year means during 2021 financial year, nothing happened. So that directly at the end of the year, we go to calculation of depreciation. Observe carefully. Here, observe. Second year. For the first year, 1920, balance the account. Asset account is showing its original cost. On this asset, depreciation is there in provision for depreciation account. Provision for depreciation account, 1,20,000. Hope you guys are following. Yes, sir. So 1 year is completed. 1 year completed. The same will become opening balance. By balance brought down 1,20,000. Clear? Come to second year. What is the WDV of asset? Here I have calculated, prepared one working note. Look at First machinery purchased on 1/4/2021. 1/4/2021. Okay. Next, just a minute. Total asset is how much? 12 lakhs na? Fine. Second year, 12 lakhs minus 1 lakh 20. 12 lakhs minus 1 lakh 20. How much? 10 lakh 80,000. On 10 lakh 80,000, we calculate depreciation. Because WDV na? WDV na? On 12 lakhs is the asset cost. Minus depreciation 1 lakh 20. So 10 lakh 80,000 is the WDV of the asset. On this 10%, 1 lakh 8,000 entry. Depreciation account debit to provision for depreciation account. Provision for depreciation account credit with 1 lakh 8,000 observe. Again 2021 financial year completed balance. Total depreciation 2 lakh 28,000 observe. Over. This 2 lakh 28,000 becomes opening balance on 1/4/2021. 2 lakh 28,000. That's it. Now 21-22 financial year, what happened? Look at 21-22 financial year. A part of the machinery purchased on 1st April 2019 for 80,000 was sold for 45,000. Very important calculation. Actually on 1st April 2021 we purchased machinery worth 12 lakh, but out of that one part of the asset, some part of the asset we sold it for 80,000. Part of the asset we sold it for 80,000 rupees. Part of the asset we sold it for 80,000 rupees. Means now we should calculate how much depreciation on 80,000 rupees of asset, plus is it profit or loss on sale of asset. Is it profit or loss on sale of asset? That we need to calculate. Here the problem comes. That's why the working note what I have did is I have separated 80,000 worth of asset plus remaining asset 11 lakh 20,000. Total 12 lakhs. What I did is I have separated 80,000 rupees asset and 11 lakh 20,000 rupees asset for ease of calculation. Right? Now I need 80,000 rupees of asset WDV. How much on the date of sale? 1st October 2021. 1st October 2021, what is the book value of asset sold? My question is simple. On 1st October 2021, what is the book value of asset sold? To calculate this, we need this first column calculation. Look at what is the cost? 80,000. Depreciation for 1920, 10%, 8,000. WDV 72,000. We have provided depreciation for 2021, 10%. 7,200. Remaining WDV 64,800. 64,800. Hope you guys are following. Yes. Now in the year 21-22, we sold the asset on 1st October 21. Means during 21-22 we used the asset for 6 months. For 6 months. What is the WDV? 64,800. 64,800 into what is the rate of depreciation? 10% into 6/12. How much? 3,240 is the depreciation. First record the entry for 3,240. Record the entry for 3,240. Observe. Yes. Depreciation account debit to provision for depreciation account on 1/10/2021. 3,240 completed. Now the question comes. Whenever any asset is sold, listen carefully. Whenever any asset is sold, it is suggested to prepare a separate account known as machinery disposal account. Again, students get confusion here. Machinery disposal account. Why? To ascertain the profit or loss separately. Why? Because this machinery account contains total 12 lakh rupee worth of asset. Out of this 12 lakh rupee asset, we sold 80,000 rupees worth of asset. Yes, sir. Then calculate profit or loss without disturbing this machinery account. To calculate the profit or loss, we are going to prepare a separate account called machinery disposal account. Very important account. In this machinery account, what we do is debit side we write asset account, asset value. Credit side we write till the date of sale, how much depreciation is provided. Till the date of sale, how much depreciation is provided. And sale of asset. Sale of asset. If you observe in illustration 7, what we did, whenever in illustration 7, when asset is sold, we have provided depreciation here itself, and we have written entry for sale of asset here itself, and we calculated profit or loss here itself. Everything happened in the machinery account itself. But now what we are doing, we are separating this information. From machinery account, and we are taking the same information to separate account. This is called machinery disposal account. If you can't understand, listen 2-3 times, no problem, but understand the concept. That's it. Okay, now look at machinery disposal account. Debit side, what we have to do, see, to calculate profit or loss, you need to verify the book value of asset with the sale value. Where is the book value of asset? Book value of asset is nothing but what? Cost minus depreciation. Observe machinery disposal account. Cost 80,000. Depreciation 18,440. What is the book value? Tell me. 80,000 minus 18,440. 61,560 is the book value of asset. This book value we are comparing with 45,000 minus 45,000, and we got a loss of 16,560. Completed. Here the question comes, sir, to the machinery disposal account, how this 80,000 comes? How this 18,440 comes? Here the point. 80,000 is the cost of asset. This is there in the machinery account. Na? 80,000 cost of asset is there in the machinery account. So from machinery account 80,000 we are transferring to machinery disposal account. What is the entry? Machinery disposal account debit to asset account. Because here asset is showing debit balance. Now we are transferring credit. 80,000 observe. Entry. Asset disposal account debit to asset account. Asset account credit side 80,000. Disposal account debit side 80,000. On this asset, till the date of sale, how much depreciation provided? Sir, look at this working note. Sir, on this asset we provided depreciation 8,000, 7,200, 3,240. Okay, where is this depreciation? In the provision for depreciation account, sir. Okay, bring the depreciation from provision account to asset disposal account. For that, what is the entry? Provision account is showing credit balance, transfer debit. So provision account debit to asset disposal account. How much? 18,440. How this 18,440 come? This first column. Clear? Next. Now asset is sold na. Normally what is the entry we record? Cash or bank account debit to asset account. But here asset is sold, entry cash or bank account debit to asset disposal account 45,000. By balancing this machinery disposal account, we get a profit or loss because debit side is more na. When debit side is more than credit side, it's a loss for us. Then what is the entry we record? Asset disposal account, sorry, profit and loss account debit to asset account. Asset account is credit by profit and loss account. With this, October 2021 completed. 1st October 2021 completed. Right, now come to, and a new machinery at a cost of 1,58,000 with was purchased and installed on the same date. Again it is a new machinery. Entry machinery account debit to bank account. Machinery account debit to bank account 1,58,000. Clear? Now at the end of the year calculate depreciation. Depreciation is calculated on WDV method. Yes sir. 12 lakhs out of 12 lakhs rupees asset, 80,000 asset gone. Remaining asset 11,20,000. Remaining asset. Already on this 11,20,000, 1920 depreciation provided. 2021 depreciation provided. What is the WDV? 9,07,200. Now provide depreciation for 21-22. 90,720. New asset 1,58,000. Purchased on which date? 1st October. Just a minute. Purchased on which date? 1st October. From 1st October to 31st March, 6 months. So calculate depreciation for 6 months. 1,58,000 into 10% into 6 months, 7,900. So what's the depreciation for third year? 90,720 plus 7,900. Entry. Depreciation account debit to provision for depreciation account. By provision for depreciation account 98,620. Over. Now at the end of the year, balance the accounts. Asset out of 12 lakhs, 80,000 gone. Remaining 11 lakh 20 plus 1 lakh 58. Total 12 lakh 78,000. Previously total depreciation is 2 lakh 28,000. Current year we provided depreciation on sale of asset, remaining asset. On sale of asset, the depreciation, the accumulated depreciation is transferred to the disposal account. Remaining depreciation 3,11,420. This is our calculation. So I suggest to prepare this working note. If you prepare this working note, now here you get every detail. Depreciation you can get, profit or loss on sale of asset you get, and total accumulated depreciation information also you can get here. So when you have more than 2 assets, 2 machineries, then it is suggestible to prepare this working note. So here what we discussed, tell me. SLM method we have discussed, WDV method also we have discussed. How do we solve the problems? Next, when provision for depreciation account is maintained, then what is the accounting treatment? When asset is sold, then what is the accounting treatment? When the asset is sold, then we maintain machinery disposal account, then what is the accounting treatment? We have understood all these things. Hope you guys are following. Right. The next concept comes revision in the estimated useful life. Revision in the remaining methods are very simple, students, that you can read later. Okay. Revision in the estimated useful life. Observe carefully. Yes. Revision in the estimated useful life of the property, plant and equipment. See, generally at the time of purchase of asset, what we can do is we estimate the useful life of the asset. After completion of every year, what we have to do is we have to revise the estimated useful life of the asset every year. Suppose initially I have estimated the asset life is 10 years. After completion of 3 years, what is the remaining estimated useful life? 7 years. But what I will do is in the 4th year, I will revise the estimated useful life as 5. As per original estimation, what is the useful life? 7 years. 10 years total, 3 years completed, 7 years. But now revised 5 years. Revised 5 years. Observe carefully. Yes, sir. In that case, what is the accounting treatment? That is the concept of revision of estimated useful life of property, plant and equipment. Observe carefully now. We'll take a small problem here. Illustration 11, observe. Illustration 11. A machine costing 6 lakh is depreciated on straight line basis. Assuming 10 years working life and nil residual value, then per annum depreciation is how much? 6 lakhs divided by 10 years, 60,000 is the depreciation per annum. The estimated of remaining useful life after 3rd year. After 3rd year means 10 minus 3. Remaining useful life 7 years. Was reassessed at 5 years. Here the concept comes. 3 years we have depreciated the asset. 3 years, how much depreciation completed? How much depreciation provided? 60,000 per annum into 3 years, 1,80,000 depreciation is provided. Remaining amount is how much? 4,20,000. 6 lakhs minus 1,80,000 depreciation already provided. Remaining amount is how much? 4,20,000. Actually, this 4,20,000 is depreciated over 7 years. 7 years as per original estimation. But now the revised estimation is 5 years. Means this 4,20,000 rupees we have to depreciate within 5 years. In that case, we have to calculate revised depreciation. We have to calculate revised depreciation. So 4,20,000 divided by 5, it comes 84,000 per annum. This is a simple problem. If you get this type of problem now, you get easily 4 to 5 marks. Just check the problem once again. Illustration 11 and 12 similar. Just observe. So this is our depreciation and amortization, student. Remaining concept here I am unable to cover due to time constraint. So you can, most of the cases you get straight line method or WDV method. That too, provision for either provision for depreciation account or uh, normal directly charging depreciation to asset account plus asset disposal account. More enough knowledge for from examination point of, I think I have given enough knowledge to solve the problems in the examination. Is it clear, students? That's it. We meet again in the next video. Till then, bye bye everyone.